Hi all, this is Rastrith and today we are starting with marathon of your paper number 12, Management Accounting. Okay, sir, what can we expect from this marathon or how many hours it will be? It will be hardly around 10 to 12 hours. Okay, sir, what are the things we can expect from this? Uh, what to tell? A review or a revision of your all the concepts will be covered in this. Yes, sir. Okay. Whether the question and answer solving will be done, the answer is no. But question discussion will be done, the answer is yes. So, sir, I'm watching it for the first time. I don't know what the management accounting is. I don't know what the CMA course is all about. Can I watch this and clear my management accounting paper? The answer is I don't know. According to me, no. Okay, so if you have already studied once, then only if you are watching this, then it would be great. Okay, so sir, all the chapters will be covered in this based on the timeline, but all the major chapters will be covered. See, you have total 10 chapters. Basically, chapter number 1 will fetch you around 5 to 10 marks theoretically, and it is a theory based, right? So, sir, so we are doing it or no? Yes, we are doing this for sure. And there is one more important chapter which carries around 10 marks in your, paper, and which is one of the easiest chapter, that is ABC. And you have decision making tool, which is one of the biggest chapter, which carries around 30% of your weightage. Standard costing, one of the easiest and majorly skipped chapter. Yes, so that is standard costing. Are we going to cover that, sir? Yes, we are going to cover this chapter in depth for sure. Okay, many questions we will discuss. We'll look into many questions, many concepts, etc. So it will be formula based, sir. The answer is no. We are going to learn the concepts, then we are going to solve the questions. So if you have already skipped the standard costing, don't worry. I'm going to make it simple for you guys. And forecasting, budgetary, one of the marks wise it is getting more weightage, but concept wise it don't have much things. So that also we are going to discuss. We have divisional performance measurement, which carries 10 marks, and responsibility accounting and decision theory. So these two chapters majorly will be of theoretical in nature, that is introduction to management accounting and responsibility accounting. That of course we are not going to discuss in much depth and all, but how much ever is required we are going to discuss. So much all other things we will try to discuss as in depth as possible. Okay, so with that, let's not waste much time. We'll get into the marathon. So first I am starting with your first chapter or first module, that is introduction to management accounting. That is all about what do you mean by management accounting, correct? Or what this subject is all about. That is first unit we are going to discuss is conceptual understanding. So before understanding what is management accounting, let's try to understand what is accounting. Accounting is nothing but people keeping the record of each and everything and analyzing it, interpreting it, summarizing it, and end of the day communicating it to the end users. Basically keeping the record of the things. So keeping the record of the things, sir, everything, the answer is no. Only quantitative things, not qualitative aspects. Only the things are recorded in quantitative terms. So only the items which can be recorded in quantitative terms, that will form part of your accounting. So accounting is all about recording those quantitative things. We are going to classify into different things, then we are going to summarize it, then we are going to interpret, analyze, then we will communicate it to the end users. That is accounting. So you told, sir, you are going to communicate it to the end users. Now the question for us is, who are the end users? It could be a owners or investors. It could be a management altogether. It could be a creditors. It could be a regulatory agencies like SEBI, etc. It could be a government. It could be a potential investor, that is the future investors, your employees and researchers. All these could be a user of this. Here one point you have to keep in mind, management. That is, even management uses the accounting data. Okay, why the management will use the accounting data, sir? To make the decisions. Management is going to use the accounting data to make the decision. That is all about your accounting. And accounting, you can tell there are three branches. What are those, sir? Financial accounting, cost accounting, management accounting. Financial accounting, cost accounting, management accounting. What do you mean by financial accounting, sir? Recording the financial aspects, recording the historical financial aspects to give the or to communicate the end results to the end users. That is your financial accounting. Whereas cost accounting is keeping the record of cost items. You might have already learnt in your first group cost accounting. Management accounting is keeping the record and summarizing those record and communicating it to the management to make a decision. That is your management accounting. That is collecting the data, summarizing the data and communicating it to whom? Particularly to the management. And why to the management, sir? To make the decision. So for decision making, whether accounting is important, of course, yes. Based on that data only, we are going to take certain decisions. So that is your management accounting. See, management accounting comprises of two terms. One is management, the other one is accounting. What is management, sir? Management is nothing but running the organization. Management is nothing but running the organization. That is your management. Basically, management, you can see it in two terms. One is managing aspect, that is running the organization. The other one is the people who run the organization. They are also known as management only. So the group of people who run the organization is known as management. Also, the process of running the organization is also management. So here, which is the one, sir? Here it is a process. That is the activity of running the organization. It is known as management. So to run the organization, we are going to give certain information, no? Or we are going to collect certain information. That thing is known as management accounting. That is, management accounting is a accounting that is producing a useful information for a management, that is people with the task of running the business. In this sense, management accounting includes production of all information useful in running the organization. So, sir, fine. So accounting, you told only quantitative aspect, no? Only quantitative aspect, no? So in management accounting also only quantitative aspects will be covered? The answer is no. Because you only think only quantitative aspects will be enough to make a decision? Of course, no. Along with the quantitative aspects, you need qualitative aspects also. So always remember, management accounting is not only depending upon, or management accounting, it won't only comprises of quantitative aspect, also it should include a qualitative aspect. That is the report which you give to management, that should include a quantitative as well as qualitative aspects also. So what are the information will be there in the management accounting, sir? Financial information, that is quantitative in nature. Also non-financial information also will be there. Accurate it could be, or it could be broadly correct, depending upon the management requirement. If they want it as accurate, then you are going to give accurate information. Sometimes they don't want accurate information. They want some numbers which are not accurate, but which are almost related. That kind of things. That is, it could be broadly correct. It could be on an actual basis, or it could be estimated for the future. That is, these numbers also will be there. It could be based on the past, or it could be relating to future. It could be completely detailed, or it could be very in aggregated form. It could be in the spoken form, it could be in the written form, like tables, numbers, that also could be there. However, it will be most of the time the management information system, MIS reports, that will be in the written form only. It could be relating to the profit or loss, it could be relating to the cost or income, it could be relating to volume, it could be relating to quality indicators, trends, etc. Okay, these are the certain things which management accounting will be comprising of. It's not that it should be always and always in the financial terms, need not be. It could be in the non-financial also. They always want it to be accurate, need not be. Some broad information is also fine. They want a huge file, need not be, they might be in need of precise document also. So these are the certain things. Now, management will have certain positions, like you can divide it into 4 points. Senior managers, mid-level managers, lower level managers, and executive directors with the management responsibilities. That is, senior managers means as a corporate, these people will be working like general manager, your CFO, CEO, all these people will be working as a top management, senior management, also known as top layer management or top level management, where they will be taking a decision for the company as a whole. Coming to the mid-level managers, the company could be divided into certain strategic business unit, SBUs, or you can tell that could be divided into different entities. Now the middle level managers are responsible for that entity. For example, if you take a Tata, now the CEO of Tata Sons will be looking after, they will be considered as a senior managers. But in Tata, we will have Tata Motors, Tata Steels, right? So now these people will be middle level management. That is, they will be taking care of their particular business line, whereas lower level managers will be taking care of their functions. For example, finance manager will be taking care of finance things, HR manager will be taking care of HR things, like that. Sales manager will be taking care of sales thing, like that. Okay. Executive director is, you will be given some responsibility to execute, you will execute that. You are executive director. Okay. So these are the certain levels of the management. What is the view of CIMA? That is Chartered Institute of Management Accounting. So according to CIMA, management accounting is nothing but application of principles of accounting and financial management. So it is applying the principles of accounting as well as principles of financial management for what, sir? To create, protect, preserve and increase the value of stakeholders. So to what? To create, to protect and to preserve the value of stakeholders. Who are stakeholders? The people who are interested in the organization. So stakeholders means not only the shareholders, sir. The answer is no. Whoever is interested in the organization, they will be known as stakeholders. To protect their value, to preserve their value, to create the value to them, it is nothing but application of principles of accounting and financial management. To create the value to them, to protect their value, to preserve their values. Okay. Okay, sir. Are they only relating to financial organization? No, it could be relating to stakeholders of financial organization. I mean, for profit organization, or relating to not for profit organizations. Okay. So this is the view of CIMA. Coming to scope of management, that is depth of management. What are the aspects covered in the management accounting? It is financial accounting is covered because it gives you a information, although it's a historical information, you need those information for the sake of decision making. So it consists of financial accounting, it consists of cost accounting, that is nothing but, cost accounting is nothing but various techniques or collection of data relating to costing, correct? So that is also very important because in management accounting, you are going to use lot of techniques of cost accounting. Budgeting and forecasting, that is involved because you are not only going to look at the past data, you have to take a call, you have to make a decision. For that, you want a future data also. So that is also involved in management accounting. Cost control procedures, that is your main intention is to control the cost. Your main intention is to reduce the cost. So that is also involved. Reporting to the final management because they have to take a call, no? So that is also involved in this. And certain methods and procedures will also be involved. That is, study all those methods and procedures which will help the concern to use its resource in the most efficient and economical manner. And tax accounting will be there because as a management, you can't only look into these general aspect, you should be very particular about the tax accounting also. Otherwise, you might end up spending a lot of money on tax. So your whole profit might get, evaporated through tax. So that is also very important. That will be covered here. Internal financial controls will be covered here. Interpretation will be done here. Certain office services, that is to maintain and control the office service of some organization, management accounting would be required. Management accounting require that. Evaluating the performance of the management is also one of the major scope of management accounting. Sir, how the management accounting evolved? From the beginning only did we have the management accounting what we have today? The answer is no. You can divide the growth of the management accounting into 4 phases. Stage 1, stage 2, stage 3, stage 4. Prior 1950 you can call it as stage 1. 1950 to 1965 you can call it as stage 2. 1965 to 1985 you call it as stage 3, and 1985 afterwards you can call it as stage 4. That is what we are right now. So in stage 1 what it was, sir? In stage 1 our work was very simple. It was all about determining the cost and controlling financial control. Okay, our work was just determining the cost, how much cost we incurred, and controlling the financial aspects. Only that much was our management accounting scope. Then in the stage 2, that is in 1950 to 1965, it changed a bit into providing the information to the management for the planning and controlling. So in the second stage, it got evolved into not only determining the cost, also providing information to the management to plan and control. Stage 3, that is 1965 to 1985, those 20 years, it was not only giving information to the management, it was also about reduction of waste of resource in business processes. We tried to reduce the wastage the more and more. So the more and more the reduction in the weightage, the more and more the control in the cost. So that purpose was there in the third stage. And in the fourth stage, it's not only about organization, it is all about creating a value. It is all about creating a value to the organization, to the stakeholders, to the customers. That is creation of value through effective use of resource. Okay, these are the 4 stages. So there were certain traditional techniques. Now there are certain new techniques. Like traditional techniques, like earlier it was financial statement analysis. That is what happened that we used to analyze. Cash flow analysis, that is where did cash move, from where we got cash, where cash went. Marginal costing, that we will understand. Absorption costing will understand. Standard costing will understand. Opportunity cost will understand. Budgeting will understand. CVP analysis will understand. Activity based costing understand. These are the traditional techniques. Whereas now new techniques are like target costing. Usually what we will do? Normal cost plus profit, right? Cost plus profit, that is we'll calculate how much cost we incurred. For that we will add how much ever profit we expect. Together we'll find a selling price. That was traditional costing. But now it is target cost. What it is, sir? First we'll fix the selling price. Based on that we'll find out how much profit we are expecting. Now the balancing figure will be cost. Now this cost we try to make sure whatever actual cost we incur, that is as per the planned cost. This is target cost. Earlier cost plus profit, then we used to find a selling price. Now what we will do? First we'll fix the selling price, then we find out how much profit we have to earn now. So balancing figure is cost. Now we will try to keep our cost as planned. Now we have just in time. Earlier we used to keep stock and all. Now it is just in time. That is whenever we need a stock, we are going to get it from our supplier. Majorly used by the Japanese companies. Total quality management, that is you are trying to provide quality to your like customers, your stakeholders, to everyone. You are trying to give total quality management to everyone. Theory of constraints, that is the resources are not abundance. That is resources are scarce, like there is a scarcity of resource. Now which resource, using which resource, how to make the maximum profit, that is theory of constraint, also known as bottleneck theory, that we are going to learn anyhow. We are going to look at a questions also, few questions also based on that we'll look in further chapters. Value chain analysis, here what we will do, we'll see what are the different activities we are doing, and based on that we will decide which are the activities are adding up the value to the final product, which are not adding up. The activities which are not adding any value to the final product, that activities we will just take it out. I mean, that activity is not necessary at all. Simply that's an add-on to the cost. So we'll eliminate those activities. That is your value chain analysis. Next is benchmarking. That is, we'll select one industrial leader and what they are doing we'll check, and what we are doing we'll check, and why they are going right, why we are going wrong we will check, and we'll try to go in par with that industrial leader. SWOT analysis. That is strength, weakness, opportunity, threat analysis. That is, we are going to check what are our strength, what are our weakness, what are our opportunity, what are our threats. Strength and weakness is internal, that is ours. Opportunity and threat is what the market, the external market is throwing at us. Now, using the strength, how can we encash our opportunity, and how to make sure this weakness won't become our threat, or using strength, how to overcome our weakness and threat. All these analysis we will do. That is known as SWOT analysis, or strength, weakness, opportunity and threat analysis. Balance scorecard is, now try to understand, nowadays a company is, or an organization, concentration is not only on making a profit, it should be on certain other things also. That is your balance scorecard that we are going to see in decision making, evaluation chapter. There I will explain. Okay. Next is Kaizen costing. That is continuous improvement. That is a Japanese term, Kaizen. Usually what we will do, sudden improvement we will concentrate, correct? And we will stop there. No, Kaizen costing tells, boss, sudden improvement is not required. Slowly we'll improve. No worries. But I want a continuous improvement. Slowly we improve, no problem. But there should be a continuous improvement. In improvement, the pause should not be there. Each and every year, at least 1% is also fine. Small improvement is also fine, but there should be an improvement. That's what the Kaizen is all about. Yes. Now, in Unit 2, we are going to learn how the management accounting is related with cost accounting as well as financial accounting. Or are the financial accounting and management accounting is same? Are the cost accounting and management accounting is same? Are we going to discuss on that? First, we are going to see how the financial accounting is different from the management accounting, or how the management accounting is different from the financial accounting. First, what are the purpose? That is, why financial accounting is there, why management accounting is there. See, financial accounting is all about recording, classifying, analyzing, summarizing the financial transaction, only and only financial transaction, which means non-financial transactions, although it is very important for decision making, it won't be considered at all. For example, let's say some pandemic comes, non-financial in nature, qualitative. In financial aspects, we won't consider it at all. But for decision making, don't you think it's very important? Of course, it is very important. So that is your financial accounting. That is, it is only about recording, classifying, summarizing, interpreting and communicating the financial informations. Whereas management accounting is all about helping the management to make the effective decisions. That is, management accounting helps the management make effective decisions about the business. Application. So, application of the financial accounting is that for the preparation of financial statements to communicate it to the end users. Whereas application of management accounting is in making the proper strategies to tackle the competitors, to make the best decisions. Scope of the financial accounting is pervasive, but not as much as the management accounting. I mean, it's a very huge, but not as in depth as a management accounting. The management accounting scope is much in broader. Information type. In the financial accounting, only quantitative information will be provided. In the management accounting, both the quantitative as well as qualitative information is provided. Interdependence. Financial accounting is not at all depend on the management accounting. However, management accounting takes the certain things from the financial accounting to arrive at certain decisions. So management accounting uses financial data, but financial information don't use management data. So it is not dependent on the management accounting, but management accounting is basically decision making accounting and depends on information created by the financial accounts as well as cost account. Statutory requirement, people, it is compulsory for the companies to keep the financial accounts. It is compulsory for few entities to maintain their financial account. It's not an option. But when it comes to management accounting, it is all left to the management to make the management accounting or no. So there is no statutory requirement. Format, financial accounting has a specific format based on the accounting standards, based on the laws, whereas management accounting don't have any specific format. It is based on the requirement of the management, how they expect the data should be. Users, majorly all stakeholders, but when it comes to management accounting, users are restricted only and only to the management. Verifiable, the information presented is verifiable, that is you can verify those information with the actual data, whereas these are predictive in nature. In management accounting, whatever we give the data, that is completely predictive in nature. I mean, of course, few past data will be there. Based on that, we will predict some future data, because decision making is all about future, not past. Now, how we are going to compare the cost accounting and management accounting, sir? Cost accounting revolves around computation of the cost, control of the cost, reduction of the cost. Sir, what do you mean by control of the cost and reduction of the cost? Both are not same. The answer is no. Why, sir? Cost control means, people, you will set some target. Let's say my cost should be rupees 10. Now it is rupees 12. My cost should be rupees 10. Now I try to bring my cost to rupees 10. Once I bring my cost to rupees 10, that done. My work is done. I am not going to try to reduce further. That is cost control. That is setting a standard, achieving the target, finish. Whereas cost reduction is all about continuous improvement. First, let's say we achieved now 10. Now again we will set our standard to 8. How to make this 10 to 8? Once we make it 8, then our target is rupees 7. That is how to make it 7. Like that, we try to reduce it further more and more and more by keeping the same quality. That is your cost reduction. That is, cost control stops once it is achieved, but cost reduction is a continuous program. Whereas management accounting is all about helping the management in making decision. Application, that is, cost accounting prevents a business from incurring a cost beyond budget because it controls the cost. Whereas here it gives the picture to the management to take the certain decision. Whereas cost accounting is all about computation of the cost, computation of the selling price, etc. Whereas management accounting is all about making all the decisions. So cost accounting will be based on only quantitative aspects, whereas management accounting is based on both quantitative as well as qualitative. So cost accounting is one of the many subset of management accounting, whereas management accounting is universal set. Inside management accounting, all these aspects will come. So decision making, the task of decision making is very less, whereas in the management accounting, decision making is the key. Statutory requirement, as per Companies Act, if you are a company and if you are having turnover of some extent, you have to maintain your cost accounts, but there is no statutory requirement for the management accounting, as I told already. So dependency, cost accounting is not dependent upon the management accounting. However, management accounting takes the certain data from the cost accounting, so it is dependent and used by management, shareholders and vendors, whereas it is used only and only by the manage. Okay. Yes. Now we are going to discuss about what are the functions of the management accountant. That is, as a management accountant, what are the works to be taken care of, right? So first one is planning and accounting. As a management accountant, they should account the required information and they should plan accordingly for the long-term points as well as short-term aspects. So you should plan accordingly. You should help in making a decision. Next is controlling. That is, you will have a standard cost, you will have a budgetary control, which means you predicted some data. Now you will actually incur some cost. Now you will compare both and you will find out why that is happening, and you are trying to control that particular aspect. If you don't have budget, if you don't have standard cost, then you can't control it all. So your work is one more thing is, that is controlling the cost. Then reporting, that is you should report to your superiors to help them in decision making. Whatever the observations of yours, you should report it to your superiors, and you will try to coordinate. You will try to coordinate between financial team or financing team as well as management, because they are concerned only about the financial aspect, but management accounting is all about financial as well as non-financial aspect, and trying to coordinate between the top management and these numbers. Communication, again, you have to communicate the results etc. to your superiors or top management, and you should evaluate the financial point of view of the organization. You should interpret how it is going, and you should help the management in making a decision, and you should administer the tax. You should come up with analysis on what the tax laws are there, how to make sure the tax what we are paying is less, all those things. Evaluation of external effect, that is sometimes government might come up with new policy etc. So how it is going to affect our organization, that evaluation you should do, that reporting you should do, and you should help the management in making the decision. And economic appraisal, that is again whenever the government comes up with a new aspect and all, how the economy will move, what are the expectations on the economy, whether it will go upward or whether it will go downward. So all this information you should give it to the management to make sure the proper decision are taken care. And asset protection is that you are going to keep the control over each and every asset of the organization, so that asset protection is possible. Either you can go for an internal financial check, you will go for an internal audit, all these aspects you are going to check to make sure assets are protected. How the role of the management accountant is changing in the modern business environment. Now it's a global competition. Earlier, for example, if you're an Indian company, you used to compete in India, so whole economy used to be same. But now it has become a global competition. It's not only about the Indian economy, it's all about global economy. So if you want to compete, if you want to be a big, you have to, of course, you have to globalize. I mean, you have to go outside the country in which you are operating, and you should explore more and more. Now that globalization is playing a very major role. So now you can't be thinking only of one economy. You have to think of many geographies, many economies. Changing product life cycle. It's not like earlier. Now the choice of the customer changes very fast. Now the customer expects the things in a very faster manner. So you can't keep on giving the same thing again and again and again and again. Each and every day requires throws a challenges at you at bringing the new innovations into your things. So now life cycles of the product is not that simple. It is very short, not like earlier one, right? So changing product life cycle, you should be very competitive in your work. Advances in the manufacturing technology. Now it's all about you giving a quality to your customers, because many competitors are there. So to give a quality, you should have a top-notch manufacturing technologies. And nowadays, it's not a paper pen, etc. Now it's all about information technology. You might have heard about artificial intelligence, all these things. So e-commerce, e-business, all these aspects has come now, because of which you should be very updated with the information technology. And environmental and sustainability issues, now it has become a compulsory. You can't do whatever you want. You can't release your pollution to the environment. So you should not only think from your financial point, you should think from environment point also. You should keep your environment safe. You should keep your environment clean. So that also matters now, because it is the regulation these days. It's not a choice. Earlier it was a choice. We keeping our economic environment clean, etc. Now it is a regulation. You have to clean. You can't release the carbon things more than what is allowed to you. Now it is deregulation, privatization is happening, because of which that also you should keep in mind. That is, the government owned companies, now it has become a private owned companies. I mean, they are just deviating there, or they are just diluting their equity. The government is diluting their equity, the government is diluting their ownership, and private players are becoming owners of such organizations. So deregulation and privatization is happening. You should keep an eye on that. And now it is not only about you making a profit, it's about creation of value in the environment, creation of value to your customers, creation of value to your employees, creation of value to your stakeholders. So now the focus is on creation of values, and now the market has become customer oriented. That is, what customer want, that you are going to give, not that what you can give. No, what customer want, that we will give, not what we can give. Okay, so that has become a customer oriented. So this was all about the module number 1, that is introduction to management accounting. And remember one thing, as there are MCQs, it is also plays a major role. So before going to examination, go through these ones. Okay, sir, previous day of examination, should I go through this chapter? The answer is no. Please don't keep all this chapter for previous day of your examination. Okay, and one more thing, guys, out of your second group, this is one of the easiest paper and one of the scoring paper. Easily you can score 70 to 80. Easily. If you work properly, you can easily score 70 to 80. So keep this thing in mind. You should use that previous day of examination very, very, very properly. You can't waste that. Okay, use it thoroughly and make sure you get a maximum out of it. Okay, so this is all about your chapter number 1, that is, which carries almost 5 to 10 marks in your examination. Yes, now we are starting with second chapter, that is activity based costing. Okay, second chapter, that is nothing but activity based costing. Sir, are we going by unit wise? No, we are going to look after this concept in general terms. I mean, look at this concept at general term, and straight away we are jumping to few questions. We'll look at few questions and we'll proceed to next chapter. So before I explain you what is ABC or activity based costing, first I will explain how the earlier traditional costing used to work, how the activity based costing will work, and we'll look at the few questions. Okay, try to understand. Cost of the organization is there, no? Cost of the organization on the basis of nature or on the basis of elements, we used to divide into 3. That is material cost, employee cost, other expenses. Okay, material cost, employee cost, other expenses. What do you mean by this, sir? Whenever we purchase any product or whenever we purchase any object, material, that we consider it as a material cost. Whenever we spend on our employees, anything it is, on employee benefit expense, any expense we spend on our employees, we call it as employee cost. And anything we spend other than for material and employees, we will call it as other expense. So the amount which we spend on any material objects, that is called as material cost. Amount which we spend on our employees, that will be called as employee cost. The amount which we spend on other than for the material and employee, that we call it as other expense. This could be further divided into 2 each. That is direct material, indirect material. Okay, direct material, indirect material, direct employee cost or direct labor and indirect employee cost, direct expense, indirect expense. I mean, other expense could be divided further into direct expense, indirect expense. So what do you mean by this, sir? Direct material, direct employee cost and direct expense are those material, employee and other expenses respectively which can be traced in the final product. The cost of which could be traced in the final product. Those things will be known as direct material, direct expense, and direct employee cost. For example, if you take this mobile as a final product, now you know that how many cameras are there? There are 3 cameras are there. How many flashlight is there? 1 flashlight is there. How many panel is there? 1 panel is there. How many screens are there? 1 screen is there. So how many batteries are there? 1 battery is there. Which means in the final product, you can trace all these materials, right? How much panel is there? How many screens are there? How many cameras are there? All these things you can find out, trace it. And also, let's say to assemble this mobile, we are giving 100 rupees to a labor. So how much cost involved to assemble this mobile? 100 rupees. That also we know. And there could be certain other expense. For example, this is a patent. This is a patented. So as a patent, we are paying them per mobile 500 rupees. Now per mobile, how much is the patent cost? 500, which can be traced. So all these direct material, direct expense, and direct employee cost, we call it as a prime cost. We call it as a prime cost, and it can be traced in the final product easily. That's why it's called as direct. Now, indirect material, indirect employee cost, and indirect expense are those expenses which we incurred. However, it cannot be traced in the final product. For example, whenever this mobile manufacturing was happening, don't you think the fuel is used? Don't you think the power is used? Yes. So those are also material only, objects only. Now, can you tell how much fuel is used, how much power is used per mobile? You don't know. You can't trace it. Also, don't you think while production of this mobile, to the managers we paid a salary, to the CEO we paid a salary, to factory manager we paid a salary, to the foreman we paid a salary? Yes sir, we paid. Can you tell how much is the manager's salary to produce one mobile phone? You don't know, because they are paid on a monthly basis. Okay, you cannot trace. At the same time, you might have paid a factory rent, you might have incurred a depreciation on your machinery, you might have paid a interest. Correct? All these things, can you trace into the final product? The answer is no. So all these are the expenses which you cannot trace. All these indirect things are expenses which you cannot trace. Together we call it as overheads. Together we call it as overheads. Okay. So prime cost done sir, overheads done sir. Now we want to find out the cost of the mobile phone. We want to find out the cost of the mobile phone. How to find it out sir? Only prime cost should we consider? No sir. Why? Because cost of the mobile is not only the prime cost, also overhead is involved. Indirect expense also required. No. Without paying the managers, can you produce? Of course no sir. Without having the factory, can you produce? No sir. If you have the factory, don't you think we should pay the rent? Yes. So try to understand, even overhead is a cost. Now my question is how to ascertain per mobile how much is the overhead we should charge. To mobile, how much overhead we should charge. How to ascertain? So people, to ascertain per unit how much overheads, that is indirect expenses, should be charged, we have two methods. One is absorption method. The other one is activity based costing. Absorption method is also known as traditional approach or traditional method. Okay, absorption method is also known as traditional method. Okay sir, great. How does traditional method will work, or how the activity based costing will work? First I will explain you how the traditional method will work. Later we can go for the activity based method. See, in traditional method what we will do is, we'll estimate the overheads. How much could be our total overheads? That is, during the year, how much overheads are we going to incur? let's say we are going to incur around rupees 5 crores. We are going to incur around rupees 5 crores. Now, in traditional approach, what we will do is we will have some prime factors, and on that basis we used to apportion it to the or absorb it to the final product. Absorbing means charging to the final product or recovering from the final product. Okay, absorption means charging it to the final product or recovering from the final product. How we used to do, sir? Traditionally, what we used to do is either we used to take the direct material, either we used to take the direct labor, or we used to take the prime cost, right? Or we used to take the labor hours, we used to take the machine hours. Okay, either we used to take the direct material, we used to take the direct labor, we used to take the prime cost, we used to take the labor hours, we used to take the machine hours. How, sir? I will tell. Let's say in that year where we are expecting our total overhead is to be 5 crore, let's say direct material required is 50 crores. Direct material required is 50 crores. Direct labor is required is 30 crores. Direct labor cost is 30 crores. So prime cost, let's not complicate by taking direct expense. I'm going to just take it as 80 crores. Labor hours, we are expecting to work around 1 lakh hours. I mean, we are expecting to work 1 lakh labor hours in that particular year, or we are expecting to work around 5 lakh machine hours. Okay, this is the data. Try to understand. In that year we are planning to, we are thinking that our direct material cost will be 50 crores, our direct labor cost is 30 crores, our prime cost is 80 crores, and labor hours we are going to work is 100 hours and 100,000 hours, and machine hour is 500,000 hours, or 1 lakh and 5 lakh respectively. Okay, sir. Now one mobile is going to consume rupees 5,000 direct material. Okay, it is going to consume rupees 3,000 direct labor cost. Okay, or let's say 6,000 direct labor cost. One mobile is going to consume 6,000 direct labor cost. Okay, sir. So it's going to be prime cost per mobile would be around 11,000. Labor hour, one mobile needs, let's say 1 hour. Generally speaking, I'm not calculating and writing, some random numbers I'm writing. So labor hours required per mobile is 1 hour. Machine hour required per mobile is, let's say, 4 hours. Labor hour required per mobile is 1 hour. 1 hour. Labor hour required per machine, machine hour required per mobile is 4 hours. Traditionally, what we used to do, sir, we used to take one of this. For example, we used to take overhead as a percentage of direct material. Overhead as a percentage of direct material, that used to be the absorption rate. We used to calculate absorption rate. How, sir? Listen here. Overhead is how much, sir? 5 crore. Okay. Direct material is how much, sir? 50 crore. Now, absorption rate is percentage of direct material. We are considering absorption rate is as percentage of direct material. So this is nothing but 10%. This is nothing but 10%. So what we used to do is, how we used to absorb the overhead to mobile is, how much is the direct material per mobile? 5,000 rupees per mobile, 5,000. So overhead is 10% of direct material. So 5,000 into 10%, we used to absorb around rupees 500 as a overhead per mobile. This we used to absorb as a percentage of direct material. As a percentage of direct material. Okay. Or sometimes we used to consider percentage of direct labor also. Okay, sir. Used to consider percentage of direct labor. Yes. How, sir? See here. Very simple. How much is the overhead? Again 5 crore. How much is the direct labor? 30 crore. Correct? Which is basically 1 by 6, which means around 13.33 percentage. 13 point or 1 by 6 is, I think 16.67, no? Yeah, 16.67 percentage. So, if at all we consider it as a percentage of direct labor, what we used to do is overhead as per second assumption will be direct labor is 6,000. Yes, sir. Into 16.67 percentage, which used to be 1,000 rupees. So we used to absorb 1,000 rupees of the overhead per mobile as per second method. Third method, I mean, we usually used to consider it as a percentage of prime cost. Usually used to consider it as percentage of prime cost. How, sir? Try to understand. Percentage of prime cost. 5 crore is the overhead. Prime cost is 80 crore. So how much it will be? 5 divided by 80. Around 6.25 percentage. 6.25 percentage. So overhead used to be, in this case, 11,000 is the prime cost. So 11,000 into 6.25 percentage, which we used to absorb it as rupees 687.5. Which we used to absorb it as 687.5. Next, sometimes we used to consider it as a labor hour basis also. What do you mean by that, sir? We used to consider overhead cost per hour, per labor hour. Now we are considering labor hour. So it is rupees 5 crore divided by how many hours of labor we are assuming, sir? We are assuming 1 lakh hours. So per hour how much it will be, sir? Per hour it will be 500 lakhs divided by 1 lakhs, which is rupees 500. Rupees 500 per hour. Correct? Now let's say it consider 3 labor hours, or let's say it consider 1.5 labor hours. To produce one mobile, we need 1.5 labor hours. Now, absorption, how we used to do? Per hour 500, and each and every mobile is taking 1.5 hours. So, we used to absorb overhead as rupees 750. I mean, we used to add it to the cost. We used to absorb, we used to recover from the mobile phone. Overhead charges 750. Done, sir. Next. If at all it is a machine hour, sir, then how much it will be? 5 crore divided by how many machine hours? 5 lakh machine hours. Yes, sir. So how much it will be? 500 divided by 5 lakhs, which is rupees 100 per hour. Correct? Which is rupees 100 per hour. So we used to absorb the overhead on the machine hour basis as one mobile is taking 4 hours of machine. So we used to absorb it as rupees 400 per mobile. Sir, everything you used to consider? The answer is no, not everything, not everything. We used to consider either one of this method. This is traditional. This is traditional. Hope it is clear how the traditional used to work. Okay. Now, I am going to tell you how the activity-based costing will work. How the activity-based costing will work. I will tell. What we will do is, this overhead of 5 lakh is there, no? This overhead of 5 lakh, sorry, 5 crore. This overhead of 5 crore, we are going to divide it into different cost pools. I mean, we are grouping this cost. We are grouping this cost into different things. For example, one overhead is relating to packing. One overhead is relating to packing, and that is, let's say, around rupees 1 crore. Okay. The other is machine setup cost. machine setup. To that it is, let's say, around 2 crore. Machine setup is around 2 crore. And the other is, let's say, calling. Relating to calling, we used to, let's say, we used to spend around 1 crore more. Okay, 1 crore more. And assisting, relating to assisting users, let's say we used to spend around again 1 crore. Yeah, again 1 crore. Now, like this, we are going to split it. So, on the basis of activity, we are going to divide our overhead. We are not going to take the general overhead. We are going to divide our overhead on the basis of activities. Okay, sir. Then we'll calculate cost drivers. What do you mean by cost driver, sir? The activity which is responsible for incurrence of that cost. Activity which is, this is cost pool. This cost pool, that is grouping the cost into different activities. Now, activity which is responsible for incurrence of that cost is known as cost driver, which means if you incur more, if you do that activity more, you will incur more cost. If you do that activity less, you will incur less cost. Now, that activity is known as cost driver. Now, we'll consider the cost driver. Let's say for packing, cost driver is number of packages. Cost driver is number of packages. For machine setup, let's say machine hour. For machine setup, cost driver is machine hour. For calling, let's say cost driver is number of calls. Okay. And for assisting, let's say labor hour. Simple. They will give which is the cost driver, or they will give hint regarding what is cost driver. But let it be. I'm just taking example. Now, in that year, we did, let's say, we did around 1 lakh packages. We did around 1 lakh packages. We used around, let's say, 4 lakh or 5 lakh it was. We used around 5 lakh machine hours. We used around 5 lakh hours of machine. We did around 2 lakh calls. We did around 2 lakh calls in total, and labor hours was 1 lakh. Yes, labor hours was 1 lakh hours. Now what we will do is, we will find out cost per cost driver. We'll find out cost per cost driver. Cost per cost driver. So 1 crore for 1 lakh packaging. So for one packaging, how much, sir? Rupees 100 per package. Right? Rupees 100 per package. 2 crore for 5 lakh hours. So 2 crore for 5 lakh hours. How much for the? How much for the per machine hour, sir? That is rupees 40 per hour. Okay. Calling, sir. 1 crore for 2 lakh callings. So per calling, you can tell it as rupees 50 per call. Correct. 1 crore for 1 lakh hours of labor. So per hour, you can tell it as rupees 100 per hour. Rupees 100 per hour. Done. Yes, sir. Now, let's say one mobile phone. One mobile takes one package. One package. 4 machine hours. 4 hours of machine work. Let's say 2 calls. 2 calls and 1.5 of labor hours. 1.5 of labor hours. Now what we will do is, instead of taking it in a blanket rate, we used to take no blanket rate, either on the basis of prime cost, direct labor or direct material, or labor hour or machine hour. What we will do is, on the basis of activities we'll take. package, one package, and per package how much it is? 100. So I will take it as overhead relating to package, 100 will be charged to mobile. Overhead relating to machine setup, per hour it is 40 rupees. We are using 4 hours of machine. So per unit we are going to charge 160, which is relating to machine setup. Overhead related to machine setup. Now calls related, per call it is rupees 50. We are using 2 calls for that, one mobile. So we are going to charge overhead relating to calling as rupees 100. Labor hours, we are using 1.5 labor hours, which is relating to assisting, and 1.5 hours of assisting is required, per hour 100. So we are going to charge around 150 to this. Together we are going to charge the overhead as 260, 360, 410, rupees 510 per mobile. Rupees 510 per mobile. This is how we are going to do it in a ABC. So what we will do, we'll divide that overhead cost into different cost pools. Then we will find out which is the cost driver for that cost pool. That is what makes it increase or decrease. So then we will find out cost per cost driver. Then we will find out how much cost driver is required per unit, and we will multiply cost per cost driver into number of drivers. Finish. This is all about the activity based costing, one of the simple method, one of the simple chapter also, and which carries lot of weightage. So we'll quickly look into few questions. Okay. Here in the traditional method, see what used to happen. Total cost center overhead. Cost center means the center to which the cost is allocated. Cost center, who is responsible? The center, the department which is responsible for incurrence of cost, that is cost center. We produced 13,800 units. Labor hours used is 27,000. Machine hour is 34,500. Direct wages is 17,250. Direct material cost is 49,680. Prime cost is 66,930. Traditionally, what we used to do, this 62,000, either we used to calculate per unit how much. How, sir? 62,100 divided by 13,800 we used to do, and per unit we used to tell rupees 4.5 per unit direct straight away. Okay. Or we used to calculate how much is 62,100 divided by 27,000, which used to come to rupees 2.3 per hour. So we will calculate per hour how much, and we will calculate how much labor are used for the final product. So we will multiply rupees 2.3 into number of hours. This is labor hour based. Machine hour, what we used to do, sir? 62,100, okay, divided by 34,500, which will come to rupees 1.8 per hour. So we know that now overhead to be absorbed on the machine hour basis is 1.8 per hour. So we'll calculate machine hour per unit, and we'll multiply 1.8 into machine hour. Direct wages, we used to, it is 17,250. So it will be 62,100 divided by 17,250. So which will come to 3.6, which means 360%. Which means if the direct labor involved is rupees 100 in the final product, overhead to be absorbed is rupees 360. That is 3.6 times of direct labor. We'll do like this. If it's a direct material, then 62,100 divided by 49,680, which is 1.25, which means 125%. Which means if the direct material in the final product is involved is 200, then overhead to be absorbed is 200 into 125%, which is around rupees 250. Prime cost basis, that is 62,100 divided by 66,930, which will come to around 92.78%. So if the prime cost involved in a final product is, let's say, around 300, then it will be around 300 into 92.78 or some percentage, whatever we got. Okay, which will be around 280 you keep. rupees 280. Like this we used to compute, which traditionally. Okay. Which means we weren't considering why that overhead is incurring, whether for that particular product what we are doing is right or wrong. For example, that in that overhead there could be machine setup cost. In that one product might not be using machine at all. There will be different kind of product. In that one product is not using machine at all, but still we are going to allocate it, which is wrong. So what we did, we came up with activity based costing. So what we will do? What we will do is nothing but we'll divide the 62,100 into different cost pools. Then we'll find out why that cost pool is there. Who is the culprit of that cost? Which means cost driver. Which is the cost driver? Then once we compute cost driver, per cost driver, how much is the cost and how many cost driver is involved in that particular product? Simple. See here, there is one more illustration. See here, a company is manufacturing two products, product A and product B. Okay, annual output of the two products are 10,000 and 20,000. So A is how many units, sir? 10,000 units. B is how many units, sir? 20,000 units. Total annual overhead of the company is 3 lakhs. So annual overhead of the company is how much, sir? Rupees 3 lakhs. The machine hours required for the product A is 20,000 hours. Great. Product B is 10,000 hours. Machine hour requirement is 20,000 for A, 10,000 for B. Great. Then the overhead absorption rate under traditional method using machine hour will be how much, sir? Total machine hour? 30,000 hours. Correct. So 3 lakh is the overhead divided by 30,000, which means per hour it is rupees 10 per hour. Correct. Rupees 10 per hour. Now per unit, how many machine hours is used? Try to understand. A, we produce 10,000 units by using 20,000 hours, which means 1 unit require 2 hours. 1 unit requires how much? 2 hours per unit. B, we produce 20,000 units by using 10,000 hours of machine. Now, 1 unit requires how many hours? 0.5 hours per unit. So, absorption rate will be here 2 hours we are using. Per hour it is absorption rate is rupees 10. So, it will be rupees 20. Here we are using 0.5 hours and rate is rupees 10. So, it will be rupees 5. So, 20 and 5 will be the overhead cost per unit. This is our traditional approach. Now, we'll see few things in the activity based costing. Okay. See here. ABC company manufactures 3 products, A, B and C. Data for the period just ended is as follows. Production, we are producing 20,000, 25,000 and 2,000. Okay. Sales price is 20, 20 and 20. Great. Material cost per unit is 5, 10, 10. Labor hour we used is per unit 2 hours for A, 1 hours for B, 1 hour for C. Labor is paid at the rate of rupees 5 per hour. That could be computed easily. Correct? Done. Overhead for the period is as follows. Total overhead is 190,000. That is divided into 4 activities or 4 cost pools. What are those, sir? Setup cost, receiving cost, dispatch cost, machining cost. Overhead is 190,000. That is divided into setup cost, receiving cost, dispatch cost, machining cost. Cost driver data is given. Machine hours per unit 222. Number of setups per unit 10, 13, 2. Sorry, this is not per unit. Number of setups is not per unit. Number of deliveries received 10, 10 and 2. Number of orders dispatched 20, 20, 20. Okay. 20, 20 and 20. Great. Now, calculate the cost and profit per unit, absorbing all the overhead on the basis of labor hours, which means traditional approach. How to compute it, sir? Total cost is how much? Total overhead is 190,000. Okay. How many labor hours did we use? Try to understand. Very simple. Try to understand. We are producing how many units of A, sir? 20,000 units of A. And how many hours of labor we used? 2 hours, which means in total labor hours used for product A is 40,000. Correct. Labor hour used for B is 25,000 into 1 hour, which is 25,000. Labor hour used for C is 2,000 into 1 hour, which is 2,000. Together, it is 67,000. 67,000 hours. 67,000 hours. And how much it would be, sir? How much it would be? 190,000 divided by 67,000 will give you around rupees 2.84 per hour. 2.84 per hour. So overhead is how much, sir? In the first case, we are using 2 hours of labor per unit. So per unit overhead will be 2.84 into 2, which is 5.68. In the second case, we are using 1 hour, so 2.84. In the for the product C, we are using 1 hour, 2.84. 5.68, 2.84, 2.84. Great. Now, sir, this is traditional approach. They are asking you to calculate cost. Total cost will be what, sir? Material cost is how much? Rupees 5. Labor, for A, for B, for C. Rupees 5, rupees 10, rupees 10. Labor cost will be how much, sir? 2 hour into rupees 5, which is rupees 10. 1 hour into rupees 5, rupees 5. 1 hour into rupees 5, rupees 5. Overhead will be how much, sir? Overhead is, we calculated already, 5.68, 2.84, 2.84. Done, sir. So total cost will be how much, sir? Total cost of A will be 20.68, B will be 17.84, C will be 17.84. Selling price will be how much, sir? 20, 20, 20. So profit or loss, sir? Product A is a loss, 0.68. Product B is a profit, 20 minus 17.84, 2.16. 2.16. This is as per which approach? Traditional approach. As per traditional approach, this is how you did. Okay, sir. Great. Now, as per the ABC, how we are going to do, sir? Try to understand. Setup cost is there. So what could be the cost driver, sir? Cost driver could be number of setups. Cost driver could be number of setups. Okay. Done. Receiving, sir, for the receiving, it could be number of deliveries received. Number of deliveries received. Dispatch, sir, number of orders dispatched. Machining, sir, machine hours. Machining is machine hours. Okay. Now, how much is the total number of setups? Total number of setups is 10 plus 13 plus 2, which will come to 25 setups. 25 setups. So per setup, how much is the cost? That is, cost per cost driver is how much? Per setup, cost is 90,000 divided by 25, which will come to 3,600 per setup. 3,600 per setup. Okay, fine, sir. Next is receiving. How many number of deliveries are received, sir? 10, 10 and 2, which will come to 22. So 22 deliveries received. So per delivery, how much, sir? 30,000 divided by 22, which will come to 1363.63 per delivery. Great. Dispatch is how much, sir? Number of orders dispatched, which is 60 orders. Correct? So per order, how much, sir? Per order, how much, sir? 15,000 divided by 60, which is 250 per order dispatched. per order dispatched. Machining how much, sir? Number of machine hours, that is 6 hours. If you do 55,000 divided by 6, the answer will be wrong. Then you will be like, sir, our institute didn't give marks. Try to understand. This is machine hour per unit. Machine hour per unit, which means you are not using the same number of machine hour for all the products. What do you mean by that, sir? How many units of A is produced, sir? 20 units, 20,000 units. Per unit, how many machine hours is used? 2 hours. So 20,000 into 2 hours is 40,000 hours. Okay. 25,000 into 2 hours is 50,000 hours. Okay. 2,000 into 2 hours is 4,000 hours. Total machine hours is how much, sir? 94,000 hours. 94,000 hours. And machining per hour is how much, sir? 55,000 divided by 94,000, which will come to 0.59 per machine hour. 0.59 per machine hour. Now, how to calculate overhead per unit, sir? Try to understand. How many setups are done for product A? 10 setups, correct? Okay, 10 setups into how much is the overhead cost per setup? Per setup cost is 3,600. 3,600. So, setup cost relating to product A is 36,000. I am computing for A first. Setup cost relating to A is how much, sir? 36,000. Done. Next is what, sir? Next is receiving. On the basis of number of deliveries received. For product A, we received 10 deliveries, which means 10 deliveries. Per delivery, it is 1,363.63, which is basically 13,636.3. I'm ignoring 0.3. Next is your dispatch. 250 per dispatch. How many dispatches are done for product A in total? 20 dispatches. So 20 orders dispatched into per order dispatch. How much it is? Per order dispatch it is 250. So 20 into 250. So which will come to around 5,000. And next what we have, sir? Machining. How many machine hours are used for product A? 40,000 hours are used. And per hour how much, sir? 0.59. So 40,000 hours into 0.59, which is 23,600. So total overhead relating to A is 36,000 plus 13,636 plus 5,000 plus 23,600, which will come to rupees 78,236. This is relating to A. Now, how many product of A is there, sir? 78,236 divided by how many units? 20,000 units. So 78,236 divided by 20,000. So per unit, 78,236 divided by 20,000. Per unit overhead is 3.91. Per unit overhead is 3.91. So A, if you consider, direct material cost is 5 rupees plus direct labor cost is 2 hours of 5 rupees each, 10 rupees, and overhead is rupees 3.91. 3.91. So it is nothing but rupees 18.91, which means total cost is 18.91. So profit will be 1.09 because selling price is 20, no? So profit will be 1.09. If you see in the traditional, A was giving us a loss of 0.68. If you do it on the ABC basis, it will give you profit of 1.09. Like that you are going to do for B, you are going to do for C. That's it. See here. Like this. Simple. Okay. This is your ABC. So in ABC, the important factor lies in finding out what is the cost driver. What is the cost driver? Okay, that's what it's all about. So one of the easiest chapter where you can easily get a marks. So do practice all the sums. I mean, whatever I told now, that itself will be the, I mean, max to max. Other than that, there is nothing is there. So much whatever like we did now, that only we have to practice more and more and more. So in that, all the concepts are covered. With that, we complete our ABC, also one of the easiest chapter, yet carrying a lot of. Yes. Now before going to next chapter, let's complete and come this particular small chapter, that is chapter number 9 or module number 9, that is responsibility accounting. Okay, very small chapter for MCQs and all, very important. So what do you mean by responsibility accounting, sir? Try to understand. Now let's say organization, cost of the organization is increasing, or revenue of the organization is decreasing, or in total profit of the organization is decreasing. We'll be having one budgeted data, and these are the actual data. Now whom to be held responsible? When this thing occurs, which team or which department or whom to be held responsible? So it will be a difficult task, no? So what we are going to do is, we are going to divide our organization into different centers. So basically responsibility accounting is nothing but one of the management control system. One of the management control system to keep people accountable, to keep the department accountable for the deviations or for the variations. Okay. So what is it, sir? Very simple, people. What we are going to do is, we are going to divide the organization into different departments, different segment or certain things. Basically we call it as centers. The organization is divided into different centers. Okay. Now we are going to check what that center is responsible for. For example, production department, purchase department, no, HR department, finance department. All these departments are not at all related to sales. Now due to the mistake of sales department, punishing these people also is very wrong, no? For example, this time we are unable to make the profit as we expected. Now these people made sure that whatever cost target we had given, their cost is within that only. But our sales department, they did some nonsense stuffs, different marketing, because of which our revenue falling. Because of the revenue fall, our profit is falling. So as a MD, we are telling, as our company is not making enough profit, no one is going to get a promotion. It will be very wrong to these people, because these people are already started working hard, because of which the cost is less. Now to avoid all these things, to make sure who is responsible for what, who is accountable for what, to draw that boundary, what we are going to do is, these things and all we are going to consider it as a cost center. Like this, we are going to divide it into centers. What are the different centers, sir? We are going to divide the responsibility center into cost center, revenue center, profit center, investment center. We are going to divide the centers into cost center, revenue center, investment center, profit center. What do you mean by cost center, sir? These centers managers, these departments, these centers will be held responsible only and only for the incurrence of the cost. That is, these people are zero bothered about revenue. These people are zero bothered about revenue. These people's responsibility is, these people are there, no? their responsibilities or these managers' responsibilities, boss, we are going to give you some target. Yes, for the cost. You should make sure that your department cost will not exceed more than this. That is what your responsibility is. You are least bothered about how much sales we are making. Coming to the revenue center, like a sales department, these team or these managers are responsible for, these management are responsible for generating revenue. They are least bothered about incurrence of cost. How much cost we are incurring, least bothered. Your work is what? We have given you some revenue target. You should achieve that revenue target. If you achieve it, you are getting an incentive. If you don't achieve it, then we are going to take control over your department. That is your revenue center. Profit centers are there. These profit centers are like, let's say Tata Group. In that one company is there. That is profit center now. What do you mean by this, sir? That company is responsible for cost as well as revenue. No? As a company, they want to give a profit, which means the manager who are responsible for both revenue as well as cost, or the department which is responsible, the center which is responsible for both revenue and cost, we call it as a profit center. And there is some center called as investment center. Their work is very simple. They should make sure the investments what we are going to make, the money, the capital where we are going to put, that gives us expected return on our investment. For example, we are expecting 15% return on our investment. Now, where to invest, how to invest, all those things left to the investment managers or the management of the investment center. They should make sure that the money what we are investing will give us a return of at least 15%. This is our investment center. Sir, to implement this responsibility center, how the structure should be? Structure of the organization should be very clear. There should be a proper responsibility drawn. There should be proper division of the centers. All these things should be there. And once that is done, we are going to compare the actuals with the budgeted, and based on that, report should be done. Based on that, proper report should be done, and it should be given to that particular responsibility manager as well as to the top management. What are the certain prerequisites, sir, to make the responsibility center? One is divisional structure. There should be a proper divisional structure. Next, there should be a goal setting. That is, for the centers we should tell, for revenue, this much revenue you should achieve. Profit center, this much profit you should achieve. Cost center, this much cost you should achieve. For the investment center, this much returns on our investment is expected, like that. Managerial involvement. You should involve the managers in this all activities. Plus, you should make sure whoever the manager is involved, their responsibility is restricted only to the responsibility. For example, if you are involving one manager who is responsible for cost, you are going to involve them only to the cost, and also they are responsible only to the cost. Timely reporting. You should make sure you give a report on a timely basis to that particular responsible manager as well as to the top management. Okay. So, preparation of responsibility report. Responsibility report is nothing but you are going to find the standards or budgeted data. On that you are going to compare the actual data. So, you are going to decide budgeted and actual are there, no? Why the variation is coming, how it could be avoided, like this. The report, when you report you are going to prepare for the sake of management, that is known as responsibility report. Okay. So, what are the characteristics should be there, sir? It should align with the organizational chart. That is, for the different managers, it should align with the responsibility chart. That is, there will be hierarchy, no? There will be hierarchy of the managers, no? Top level manager, middle level manager, lower level manager. So, the report should be according to that. The flow of report should be according to that. And timeliness and regularity should be there. clarity and simplicity should be there, which means there should be no jargon and all. It should be clearly mentioned what it is. It should be clearly mentioned, and appropriate level of detail should be there. For example, for a top level management, you can't give full in-depth report, right? Because there will be lot of things to take care. So because there will be, let's say, 10 divisions. Now 10 divisions report, if you give big reports for the management, it will be, I mean, top management, it will be difficult. Instead, you should give small reports of each and every division, which will become normal report. But when it comes to that particular divisional manager, they want to know more about that particular department. They want a clear idea about that particular division. So for them, you should give vast report, proper report. Got it? So that is appropriate level of detail should be there, and comparative analysis should be there. That is what was our standard and what is our actual achievement, and also analytical approach. That is, you are not just giving a data to those particular managers. You should analyze the actual data. You should analyze, interpret, and you should communicate it to the final managers. And you should not only include monetary metrics, you should also include physical. In unit basis also, you should include it, and you should highlight the inefficiencies, if any, or efficiencies, if any. These are the certain things to be done. So what are the impact of the responsibility accounting on the managerial decision making? Sir, it identifies the trends and deviations in the real time. That is, immediately you can identify what is the trend of the organization, how it is going towards on the real time basis, immediate basis. You can implement the corrective actions. You can focus on the controllable factors. That is, the factors which you can control. Factors you can divide into controllable, uncontrollable. For example, government policies, uncontrollable. Your organization policies, controllable. Make data-driven decision. That is, you cannot just hit some randomly or hit blindly. What you should do is, along with the data, you should talk. That is, you should make a data-driven decision. Whatever decision you have taken, that is based on the data boss. You should do that way. These are all about the responsibility accounting, one of the small chapter. Make sure this also you don't keep for the last day of your examination. Okay, make sure you won't keep for the last day of your examination. Finish it early only. Yes. Yes. Now we are starting with next chapter, that is marginal costing. So first, what could be the meaning of marginal costing? That we are going to discuss. Marginal costing. Before going for chapter number 3, that is marginal costing, we have to understand what exactly is marginal cost. Marginal cost. Marginal cost is nothing but, people, the extra money or extra cost you incur to produce one more extra unit. That is, if to produce 100 units, if you are spending 10,000, to produce 101 unit, if you spend 10,050, now this 50 is there, no? 50 rupees. This 50 rupees will be known as marginal cost. So, sir, somewhere we have learned that the change in the units and change in the cost is there, no? So, change in the cost due to the change in the units happens only because of variable cost. Yes. So, can you tell marginal cost as variable cost? The answer is yes. So, marginal cost is nothing but variable cost. So, what is marginal costing, sir? Marginal costing is nothing but, people, technique. Try to understand. It's not the method of costing. It's not the method of ascertaining the cost. It's a technique. It's a technique. Technique of what, sir? Technique of using marginal cost for decision making. For decision making. That is, we are going to use we are going to use marginal cost or a variable cost for the sake of decision making. That is known as marginal cost. That is known as marginal cost. Okay. So what do you mean by this, sir? Here, for the sake of decision making people, fixed cost will be ignored. Fixed cost will be ignored. Why, sir? Because fixed cost is already incurred. Yes, fixed cost is already incurred. Then what is the point in considering it for the decision making? For example, now you want to find out whether to further produce the product or no. Okay, or further process the product or don't process. Fixed cost is already incurred. Now, if you further process also, fixed cost will be same. If you don't further process also, fixed cost will be same. Then there is no point in considering the fixed cost for the sake of decision making. So in marginal costing, what we are going to do, sir, we are going to ignore the fixed cost. And in marginal costing, you are going to remember one format, golden format, that is this. Sales will take. From that, if we reduce the variable cost, you will get something called as contribution. From the contribution, if you reduce the fixed cost, you will get profit. This thing you have to remember. That is, you will consider the sales. From the sales, if you reduce all the variable cost, either it could be direct like material, labor and other expense, or it could be indirect like variable overheads, selling and distribution, production, administration, whatever it could be, whatever the variable cost it is. If you reduce sales minus variable cost, you will get something called as contribution. What do you mean by contribution, sir? Then contribution is nothing but people difference between your revenue and variable cost which is available to recover your fixed cost and to give you profit. That is the portion of the sales after reducing a variable cost, which is available for recovery of your fixed cost and profit. That portion of sales we are going to call it as a contribution. Hope it's clear. In the marginal costing, more than profit, this contribution will be given a more importance for the sake of decision making, because here in marginal costing, it is pretty clear that fixed cost is already incurred. It has nothing to do with the decisions. So we are going to ignore the fixed cost for the sake of decision making. Okay. Yes. Now, this is the one thing. Now, sir, contribution, can we represent in percentage, sir? Yes, contribution could be represented in percentage. What it will be known as, sir? It will be known as contribution percentage. Sometimes we also call it as variable cost. We also call it as PV ratio. Profit volume ratio. PV ratio. Contribution percentage is also known as PV ratio. Sir, how to arrive at it this, sir? Very simple, people. Contribution divided by sales will be known as PV ratio. Contribution divided by sales will be known as PV ratio. For example, if the sales price is 100, variable cost is 60, then contribution will be 40. Yes, sir. Now, rupees 40 divided by rupees 100 into 100 will give you how many percentage, sir? It will give you 40%. Now, this 40% is known as what, sir? PV ratio or contribution percentage. This 40% is known as PV ratio or contribution percentage. Okay, sir. And one more point you have to remember, that is, this 60 is there, no? Rupees 60, variable cost. This also could be represented in percentage then that percentage will be known as variable cost percentage. That percentage is known as variable cost percentage. That is nothing but variable cost divided by sales into 100. Here how much it will be, sir? 60 divided by 100 into 100, which will come to 60 percentage. Which will come to 60%. And also one more point you can remember, that is sales minus variable cost is equal to contribution. Yes, sir. So can I write it as sales is equal to contribution plus variable cost? Yes, sir. Now, if sales is considered as 100%, let's say contribution we know it as 40%, then variable cost will be how much, sir? Pretty simple, people. Variable cost percentage is nothing but sales percentage, or sales, basically sales is 100, no? Sales is considered as 100%. So, sales percentage, 100% minus contribution percentage. Minus 100% minus contribution percentage will give you variable cost percentage. At the same time, 100% minus variable cost percentage will also give you contribution percentage. This thing should be remembered. And one more thing is there, sir, important thing, when the variable cost per unit will vary. Try to understand, people. Let's say you are selling 100 units, okay, and you are selling 80 units. Selling 100 units, selling 80 units. Now try to understand, when you sell 100 units also, per unit it is rupees 60 only. When you sell 80 units also, per unit it is rupees 60 only. However, total will change, sir. Total variable cost will change. If you produce 100 units, your total variable cost is rupees 6,000. If you sell 800 units, your total variable cost will be rupees 4,800. Total variable cost will change. Per unit, it won't change. Okay, sir. Sir, we are selling 100 units only. Okay. Same, sir. We are going to consider two things. We are selling 100 units only in the two situations also. But in the first situation, our sales cost was 100. Selling price was 100. In the second situation, we reduced it to 90, sir. Now, what is the variable cost? First situation, we know that 60%, which will come to 60. Second situation, it will be 90 into 60%, sir, which will come to rupees 54. If you do this, it will be wrong. Why, sir? You told that variable cost varies with the sales. Yes, variable cost varies with the sales because number of units varies. When the number of unit varies, cost increase or decrease happens. That's what the variable cost is. Variable cost has nothing to do with the selling price. Try to understand. Variable cost is directly related, directly proportional to the units sold. Sell more unit, more variable cost. Less unit, less variable cost. Total variable cost, not per unit. However, you sell at whatever the selling price, variable cost has nothing to do. Try to understand. Because, let's say, to sell this mobile phone, let's say we are incurring rupees 20,000 as a variable cost. Okay. Now, we are selling this mobile phone at rupees 40,000. Okay, sir. We are incurring a variable cost at 20k. Now, for the marketing purpose or to stock clearance purpose, we started selling this mobile at 30,000. But still, whatever the component went inside, everything will remain same only, no? Whatever the component went inside, whatever has happened, everything remains same only. So, moral of the story is, variable cost, what you should pay for this mobile is 20,000 only. So, this one more point you have to remember, that is, variable cost won't vary with the change in the selling price. Selling price and variable cost has no relevance. Keep that thing in mind. Okay. Yes, sir. Then what else, sir? Now, one more concept. How is it? I will take some example. Let's say we are selling 100 units. Okay, sir. Per unit selling price is rupees 1000. Selling price is rupees 1000. Variable cost per unit is, let's say, rupees 700. Variable cost per unit is rupees 700 and fixed cost is, sir, can you tell fixed cost per unit? The answer is yes, you can tell fixed cost per unit. But will it vary with the same proportion? The answer is of course no, because the more and more you produce, fixed cost, total fixed cost remains same. Yes, sir. You produce how much ever the quantity you want. Total fixed cost remains same. The more you produce, per unit cost will decrease. The less you produce, per unit cost will increase. But total fixed cost remains same. So let's say our fixed cost is 15,000. Our fixed cost is 15,000. What would be the profit, sir? What would be the profit under marginal costing? Pretty simple. Sales minus variable cost. You will call it as what? You will call it as contribution. We will call it as contribution. From that, if you reduce the fixed cost, you will get something called as profit. You will get something called as profit. Okay, sir. Sales is how much, sir? Sales is 100 into rupees 1000, which will come to rupees 1 lakh. Yes, sir. Variable cost is how much, sir? 100 into rupees 700, which will come to rupees 70,000. Yes, sir. So contribution is how much? Contribution is 30,000. Okay. Fixed cost is how much, sir? Fixed cost, they are telling it as people 15,000. Correct? So now 15,000 will be my profit. 15,000 will be my profit. This is how we are going to determine the profit. Also, how much is the PV ratio, sir? PV ratio is pretty simple. Contribution is 30,000. Sales is 1 lakh. So PV ratio is 30%. What is the meaning of that, sir? 30% of the sales price will be available for the sake of recovery of finished goods and fixed cost, and whatever the extra amount remaining in contribution will be treated as a profit. Clear? Yes, sir. Now one more concept is there, that is called as break even. Break even point or break even sales. It could be in rupees or it could be in units. It could be in rupees or it could be in units. Before rupees and units, sir, you first know what is break even. Correct? Try to understand, people. Break even is the situation. Break even is the situation, or break even sales is the sales at which profit is equal to 0. So, sir, loss can be anything? The answer is no. That is the situation in which there will be no profit or no loss. So, profit is literally 0. Not even negative, not even positive. That is, break-even point is such situation. At that sales, at break-even sales, I mean, if you make some sales, your profit will be 0. Your profit will be 0. That amount of sales will be known as break-even sales. If you sell more, sir, if you sell more, you will make a profit. If you sell less than break-even, you will make a loss. At break-even, if you sell the same amount of break-even, if you sell, then you are not going to make either profit, not going to incur either loss. Is it, sir? How to arrive at that, sir? There are formulas. People will buy at the formula, but today, now I will tell how the formula is derived. And also, we are not going to use formula. You don't feel like, Okay, this is how the formula. I mean, once you understand why the formula has come, you don't have to by heart it. See how the formula is derived, sir. Sales, do you know? You don't know. Sales, do you know? You don't know. Okay. Variable cost, let's say it is 40%. Variable cost is 40%. Fixed cost is, or let's say take it in amount. Let's take it in amount. Okay. Sales quantity, you don't know. That is, if you sell how many units, you are going to make no profit, no loss. That itself is called as break-even point in terms of units. That you don't know. Okay, that you don't know. Variable cost, let's say rupees 500 per unit, or let's say rupees 600 per unit. Selling price, let's say rupees 1000 per unit. Okay, selling price is rupees 1000 per unit. Fixed cost is, let's say 20,000 rupees, 20,000. Now the question is, if you sell how many units, you are going to make no profit, no loss. Very simple. Sales, let's take break-even sales or break-even point as X. Let's take break-even point as X. That is, how many units to be sold, we don't know. So sales will be how much, sir? 1000 rupees into number of units to be sold, that is X. Can I tell it as 1000X? Yes, sir. So can I tell break-even sales in rupees is nothing but 1000X? Yes, sir. Break-even sales in rupees is 1000X minus variable cost. Minus variable cost. Now, variable cost is how much, sir? Variable cost is 600 per unit. Number of units you are going to sell is X. So that is 600X. Now, it will be contribution. Contribution is how much, sir? 400X. Contribution is 400X. From that, if you reduce fixed cost, 20,000, I told you one thing, that is at the break even, profit is known. What are you talking, sir? Profit is known? Yes. At the break even, profit is 0, no? Yes, sir. So, can I tell it like this? 400X minus 20,000 is equal to 0. Yes, sir. 400X is equal to 20,000. Yes. X is equal to 200 divided by 4, which is 50 units, because X is in terms of units now. So if you sell 50 units, you are going to make no profit, no loss. How did you arrive at 50, sir? How did you arrive at 50? Very simple. X is equal to 20,000 divided by 400. X is equal to 20,000 divided by 400. X is what, sir? X is break-even point in terms of quantity, units, correct? Is equal to 20,000 is what, sir? 20,000 is people. 20,000 is fixed cost. 20,000 is fixed cost. And 400 is what, sir? 400 is contribution per unit. That's what, no? 400 is contribution per unit. This itself is the formula for break-even point in terms of quantity. This itself is the break-even point in terms of quantity. Now let's say, sir, situation is this. What is it, sir? They have given, sir, nothing. They have given nothing. They have given PV ratio. They have given PV ratio is 40%. PV ratio is 40%. Okay. Fixed cost is, let's say rupees 20,000. Fixed cost is 20,000. Now they are asking you to calculate the break-even sales, of course in rupees, because units is not given at all. Now how will you calculate, sir? If the PV ratio is 40%, can I tell variable cost is 60%? Yes, sir. You can tell it as 60%. Now try to understand sales, that is break-even sales. I am going to consider it as A. Break-even sales, I am going to consider it as A. Now can I tell sales is nothing but A? Yes, sir. Minus variable cost. Variable cost is how much, sir? 60% of sales. Can I tell it as 0.6A? Yes, sir. You can tell. No worries. Now, because of this, contribution, can I tell it as 0.4A? Or straight away, can I tell contribution is 40% of sales? Yes, sir. Minus fixed cost they have given. Fixed cost is how much, sir? 20,000. Now, profit at break even is 0. That's what we consider. We are considering A as break even sales. So, profit at A is 0. Now, A is question mark. Can I tell it as 0.4A minus 20,000 is equal to 0. 0.4A is equal to 20,000. A is equal to 20,000 divided by 0.4. Therefore, A is equal to how much, sir? A is equal to 20,000 divided by 4. Should be 1 lakh. 20,000 divided by 0.4. Sorry, 50,000. A is equal to rupees 50,000. What is the meaning of this, sir? Meaning of this is, if you make a sales of 50,000 rupees, if you make a sales of 50,000 rupees, you are going to make no profit, no loss. No profit, no loss. Now, what is this, sir? Break-even sales in rupees. How did you arrive at it? Break-even sales in rupees. What you did, sir? You took 20,000. 20,000 was what, sir? Fixed cost. Divided by 0.4 was what, sir? 0.4 is nothing but PV ratio or a contribution percentage. So if you divide fixed cost by PV ratio in percentages, you will get the sales, break-even sales in terms of rupees. If at all you divide fixed cost by, if at all you divide fixed cost by contribution in terms of rupees, then what you will get, sir? You will get break-even point in quantity. That is it. And also, one thing you have to remember here, people. One thing you have to remember here. I will show you one thing. Now, 50,000 we got, no break-even sales. Can I take it like this? Sales is nothing but 50,000. Yes, sir. Variable cost, how much they are telling, sir? Variable cost, they are telling it as 60%. So, 60% of 50,000 is nothing but 30,000. Yes. Now, contribution is how much, sir? Contribution is 20,000. Contribution is 20,000. From this, if you reduce the fixed cost, how much is fixed cost? 20,000. You will get a profit. Which is 0. So this is break even. Now in this break even, can you observe one thing? What is it, sir? The observation is contribution at the break even. At break even, contribution will be equal to fixed cost. At break even, contribution will be equal to fixed cost. This thing you have to remember. And also remember, break even point will change because of the change in the selling price, not in the sales quantity. Because try to understand, if the selling price changes, variable cost remains same only. For example, now 1000 is selling price. Variable cost, let's say 600. Now contribution is 400. Now the selling price reduced to 900. That doesn't mean that variable cost will reduce. No, So variable cost remains 600 only. So contribution is 300. In the first scenario, people, in the first scenario, PV ratio is 40%. In the second scenario, PV ratio is 33.33. So PV ratio will affect the break even, no, because denominator is PV ratio or contribution itself. So automatically remember one thing, whenever the selling price changes, break even point changes. Whenever the selling price changes, break even point changes. Remember this particular point. Now, one more concept is there, that is known as margin of safety. Margin of safety, MOS. Sir, what is that, sir? Before that, try to understand. Let's say, again, selling price is rupees 1000. Okay. Sales quantity, let's say 900 units. Fine. Variable cost around rupees 600 only I will take. Fine. Now calculate the profit. Calculate the profit. Also calculate break even point. Okay. Calculate profit and calculate break even point. So listen here. Let's say sales is nothing but 900 into 1000, which will come to 90,000 minus variable cost. Variable cost is how much, sir? 900 into 600, which will come to 54,000. Yes. So you will get a contribution. Contribution is how much, sir? Contribution is 36,000. Let's say fixed cost is around 20,000. Fixed cost is around 20,000. So minus fixed cost, you will get profit of how much? 16,000. Profit is how much? 16,000. Now, how much will be break even point, sir? In terms of rupees, let's say that as X. Okay. Variable cost is how much? When the selling price 100, variable cost is 600, which means variable cost is 60% of sales. I'm going to take it as 0.6x. So you will get a contribution of 0.4x minus 20,000 will give you a profit of 0. So x is how much, sir? Nothing but 0.4x is equal to 20,000. X is equal to 50,000. Rupees 50,000. Okay. Now, sir, actual sales is 90,000. Okay. Break even sales is 50,000. Yes. Sir, difference between actual sales and break even sales, what we call it as, sir? Difference between actual sales and break even sales, we call it as margin of safety. We call it as margin of safety. So what is margin of safety, sir? Margin of safety, that is nothing but actual sales minus break even sales. In our case, it was 40,000. This 40,000 was what, sir? This 40,000 was margin of safety, or you can tell it as sales is equal to margin of safety plus break even sales. Sales is equal to margin of safety plus break even sales, or margin of safety is difference between sales and break even sales. Okay. Sir, only one thing, or this is the only one way we can do, or is there any other ways? Yes. Listen. One more thing you have to remember here. Try to understand. Break even sales was how much, sir? Break even sales was rupees 50,000. Yes. Actual sales was how much, sir? Actual sales was rupees 90,000. Great. Because of which margin of safety is how much, sir? Margin of safety is 40,000. 1000. Now one thing you have to carefully observe here. Selling price was 1000, correct? Variable cost was rupees 600, correct? So contribution is 400, yes sir. So PV ratio is, can I tell it as 40%? Yes. PV ratio is 40%. And how much was the profit we got when the sales is 90,000? When the sales was 90,000, profit we got was 16,000. Profit we got was 16,000. Now try to understand one thing. People. Up to 50,000, profit was 0. Up to 50,000, profit was 0. Over and above, when you make the sales of over and above 50,000, that thing will be known as over and above the break-even sales. Whatever the sales you will make, that will be known as margin of safety. Look at the magic over here, people. I will take the marginal safety, that is 40,000, into, I will do the PV ratio, that is 40% of this. I will get rupees 16,000. Sir, what is this, sir? Very simple. Up to 50,000, whatever the sales is there, up to this 50,000, whatever the sales is there, no, everything will be towards recovery of fixed cost. I mean contribution of that, because variable cost anyhow you have to incur, you incurred, and fixed cost you recovered, and you made a profit as 0, which means up to 50,000 you have already recovered a fixed cost. So after 50,000, whatever the sales you make, out of that sales, if you recover variable cost, whatever the contribution will be remaining, that contribution need not to recover a fixed cost, because up to break even it is already recovered. So over and above break even sales contribution will directly contribute towards profit, which means this 40,000 margin of safety is 60%, that is nothing but variable cost, which will come to 24,000, is went out to recover variable cost. Variable cost is recovered. Now 16,000 is left. Now in that 16,000, no need to recover the fixed cost, because fixed cost is already recovered in the break-even sales, people. So try to understand. At margin of safety, contribution will directly contribute towards the profit. So that's what we have done. We computed a contribution of margin of safety, that is 40,000 of sales into 40%, which will come to rupees 16,000. So that contribution itself is a profit. So can I tell this as margin of safety? Yes, sir. Can I tell this as PV ratio? Yes, sir. Can I tell this as profit? Yes, sir. Can I tell margin of safety is nothing but profit divided by PV ratio. Profit divided by PV ratio will give you margin of safety. That clear? Hope it is clear. These are the certain aspects you have to remember. Certain things are what, sir? Nothing. At break even point, profit is equal to 0. Break even point could be in rupees, or break even point could be in units. And one more thing you have to remember is, at break even, contribution is equal to fixed cost. So accordingly, in terms of rupees, how can you get it, sir? Very simple, fixed cost divided by PV ratio. Yes. And in terms of unit, how you can get it, sir? Fixed cost divided by contribution per unit. contribution per unit. You will get a break-even point. And we learnt about margin of safety. That is nothing but sales over and above the break-even sales. Sales over and above the break-even sales will give you a margin of safety. And one more way of computing margin of safety is profit divided by PV ratio. Profit divided by PV ratio. These are the certain aspects you have to keep in mind regarding marginal costing. And of course, one more concept is there, that is marginal costing in comparison with the absorption costing. That is, our traditional absorption costing is there, no? That and marginal costing, how it is different. How it is different, that we are going to see. For that, we have to see the income statement as per marginal costing, income statement as per absorption costing. Then I will show you how it is done. Okay. So, look here. Sir, how the marginal costing is different comparison to absorption costing. Try to understand, people. First, I will explain you absorption costing. What we used to do, we used to take the prime cost. Yes, sir. To the prime cost, we used to add the factory overhead. We used to add the factory overhead. Yes, sir. We used to add the factory overhead. Factory overhead, whether we used to divide between variable and fixed cost, the answer is no. We weren't separating variable cost and fixed cost. We used to consider both variable cost and fixed cost. So variable as well as fixed, both factory cost or manufacturing cost we used to consider. So for that, we used to add the opening WIP, reduce the closing WIP to arrive at a cost of production. Correct? I mean, of course, we used to add certain administration expense if it is related to production, research and development expense, your quality control, all those things. Yes, we used to consider, I mean, we used to get cost of production. Now, to the cost of production, I mean, if you divide cost of production by the produced number of units, you will get the cost per unit. Yes. Okay. To the cost of production, if you add opening stock of finished goods, you will get cost of goods available for sale. From that, if you reduce the closing stock, you will get cost of goods sold. You will get cost of goods sold. Now, if at all, from the sales, if you reduce the COGS, what you will get, sir? You will get a gross margin or gross profit. From that, if you reduce other non-operating or other operating expense, basically, which is not at all related to the production, indirect expenses, administration, selling and distribution, basically, fixed as well as variable, both. If you reduce, you will get or for the cost of goods sold, if you add these two items, we will get a cost of sales. Correct? And we used to get a profit by reducing cost of sales with the sales. However, one thing you have to remember, I explained you while doing ABC analysis, that is something called as absorption. One thing you have to remember, people, yesterday I told you 50 lakh, correct? Overhead, I think I told 50 lakh or 5 lakh, somewhere there only. Also I told 50 lakh as expected overhead. 50 lakh as expected overhead, which means not actual overhead. I told it as expected overhead, which means not actual. It could vary. Overhead could vary. I told expected overhead. So always remember absorption is done on the basis of budgeted figures, and not the actual figures. Absorption is done based on the budgeted figures and not the actual figures. So how the absorption is done, sir? Absorption is done like actual units produced or actual hours into budgeted recovery rate or budgeted absorption rate. Try to understand. Try to understand this. Absorption will be done to the actuals, that is actual units or actual hours worked on the basis of budgeted rates. On the basis of budgeted rates. So there is a possibility of under recovery or over recovery, or under absorption or over absorption. What do you mean by this, sir? Under absorption means you incurred more, you recovered less. Actually you incurred more, but you recovered less. Over absorption means you incurred less, but you recovered more. You incurred less, but you recovered more. Sir, what is it, sir? Can you tell it clearly? Listen here. Budgeted production we are planning for 1 lakh units. We are planning for 1 lakh units. Budgeted overhead, budgeted fixed overhead, let's say we are thinking of rupees 10 lakhs. Okay, budgeted overhead is rupees 10 lakh. So what is the absorption rate? What is the absorption rate per unit? 10 lakh divided by 1 lakh, rupees 10 per unit. Correct? Rupees 10 per unit. But actual overhead incurred is nothing but rupees 11 lakh. Actual overhead incurred is how much, sir? Rupees 11 lakh. Actual production is 90,000 units. Actual production is 90,000 units. So how much is the overhead absorbed, sir? Overhead absorbed is 90,000 units. Per unit we are recovering 10 rupees. So overhead recovered is 9 lakh. Overhead recovered is how much, sir? 9 lakh. Okay. Actual overhead is how much, sir? 11 lakh. Now this 2 lakh is what, sir? Under recovery or under absorption. Under recovery or under absorption. So which means you incurred a cost of 11 lakh, but you showed that 11 lakh expense as 9 lakh, which means that is also expense only. Now what you should do, sir? You should add it to the cost, that is add 2 lakh as a under absorption. Add 2 lakh as a under absorption, because here while taking you took only 9 lakh, not 11 lakh, but actually we incurred how much, sir? 11 lakh. Okay, done. What is over recovery, sir? Same example. Let me tell you, actual production is 120,000 units. Actual production is 120,000 units. Now try to understand. How much you recovered, sir? 120,000 units into rupees 10, which will come to 12 lakh. You recovered how much, sir? 12 lakh. You incurred how much, sir? 11 lakh. So what you did, sir? 1 lakh extra we recovered. 1 lakh extra we absorbed. So that is called as over absorption or over recovery, which means actual cost is how much, sir? 11 lakh. But you treated cost as how much, sir? 12 lakh, which means while valuing your inventory or while finding out your cost of production, although you incurred 11 lakh, you treated it as 12 lakh. No, the answer is yes, which means 1 lakh extra expense you showed. Now what you do, sir? You reduce 1 lakh extra. You reduce 1 lakh extra. Okay. That is, then you will arrive at a actual cost. That actual cost will be reduced from the sales to arrive at a profit. This is absorption costing. If you understood, great. If you didn't understand, don't worry. We'll look into one illustration. Then you will get a clear picture of it. Okay, sir. Then how is this different from the marginal costing, sir? Always remember, I told you one thing. For the marginal costing, any fixed cost is irrelevant for computation of cost. So either, although it is relating to manufacturing overhead, fixed manufacturing overhead, although it is relating to manufacturing, fixed manufacturing overhead shall be ignored while computing cost of production. Once we arrive at a contribution, then only all the fixed cost will be reduced. See here. This is marginal costing. See, direct material, direct labor. Yes, prime cost. To the prime cost, we are not going to add full manufacturing overhead. We are going to add only variable manufacturing overhead or variable factory overhead. So we will get a cost of production. Try to understand. To arrive at a cost of production, we are not going to add fixed manufacturing overhead, but in absorption costing we do. But at what value? Absorbed value. Okay, great, sir. Then what we will do, sir? For this, we will add the opening stock, we will reduce the closing stock. What we will get? COGS. Now to this COGS, from this to this cost, again we will add what, sir? Again we will add variable administration and selling and distribution. I mean, other than manufacturing overhead, whatever the variable is there, no, that also will treat it as a cost. Now we will get total variable cost. That if you reduce from the sales, you will get a contribution. From this contribution, all the fixed cost, including manufacturing overhead, including fixed manufacturing overhead, shall be reduced while arriving at a profit. So always remember one thing. The value of the stock as per absorption costing and marginal costing will vary because in the absorption costing, cost of production includes fixed manufacturing overhead, which means that is added in the cost of product. However, in the manufacturing overhead, in the marginal costing, fixed manufacturing overhead is not considered to value the inventory, cost of production. So it consists of only variable. That is the reason why it varies. So this is how the marginal income statement will be, marginal costing income statement, and absorption costing income statement will be. So now quickly we'll look into your few illustrations. Okay. So look at this question. Okay. ABC Limited has production capacity of 5 lakh units per annum at its full capacity. Okay. So it has how many units capacity? 5 lakh at its full capacity, that is 100%. Company's cost structure is as follows. Variable production cost is 32. Variable selling cost is 9.6. Fixed production cost is 30 lakh. Fixed selling expense is 20 lakh. During the year ended 31st March 2022, company worked at 80% of its capacity, which means they were able to produce 4 lakh units. That is 5 lakh into 80%. Production, they only have given 4 lakh. Sales, rupees 64 per unit. And they were able to sell 3,87,500 and opening stock was 50,000, which means try to understand, out of 4,50,000 goods available for sale, they sold 3,87,500, which means they sold 62,500. They sold 62, closing stock is 62,500. Fixed production expenses are absorbed on the basis of capacity. So it is on the basis of capacity, and fixed expense is recovered on the basis of period, which means 1 year 20 lakh, every year you are going to recover 20 lakh. But fixed expenses are absorbed on the basis of capacity. Okay. So you are required to prepare a statement of cost and profit for the year ended 31st March on the basis of marginal costing, on the basis of absorption costing. First, let's see on the basis of marginal costing. Straight away what we are going to take? We are going to take sales as 64 rupees into 3,87,500. Before that, let me calculate a absorption rate of production overhead, that is rupees 30 lakh yes, divided by 5 lakh units, which means per unit it is rupees 6 per unit, correct? 6 per unit. Sir, actual overhead they haven't given. Then when the actual overhead they haven't given, then we will consider this 30 lakh itself as actual overhead. Sir, if the 30 lakh is actual overhead, then there will be no under or over absorption, no sir. The answer is no. There will be under and over absorption. Why sir? Because while calculating rate, we thought that we are going to produce 5 lakh units. Yes sir. But actually we produce 4 lakh units. Yes. Which means 1 lakh units overhead is not absorbed. So there will be under absorption in the given question. See, I will tell. Listen here. So sales will be how much, sir? 3,87,500 into 64, which will come to 2,48 lakhs. From that, I will reduce first variable production cost, that is rupees 32 per unit. So how many units you are producing? You are producing 4 lakh units. You should consider that because there is a stock in this. So less variable 4 lakh into 32, during the year you incurred 128 lakh as a variable cost. So that itself will be the COP because it is valued only at variable cost. So you add opening stock, and that also they haven't given a rate, so we are going to consider the same rate, 32 per unit. So you'll get 16 lakh. From that, reduce the closing stock, that is I calculated and kept here, no, somewhere. How much will be the closing stock? That is 62,500. Yes, 62,500 into 32, which was 20 lakh. So your variable cost of production was 124 lakh for the goods sold or units sold. To this, I am going to add other variable overhead, that is selling expense, only to the relating to sold units, that is 387,500 into rupees 9.6, which will come to 3720. Now we got total variable cost that I am going to reduce from the sales. We'll get a contribution. From the contribution, reduce the overheads on the basis of incurrence because we are not absorbing. So 30 lakh and 20 lakh, which will come to 50 lakhs. So you will get a profit under marginal as 3,68,000 or 36,80,000. I am not calculating it now. I mean, it should be 36,80,000. Okay. Absorption method, how it will work, sir? Sales will be same. Yes. Minus from sales, what and all we should reduce? You should reduce both the variable cost of production as well as fixed cost of production to compute the cost of production. So try to understand how much was the variable cost of production, sir? 32. Yes. Into 4 lakh. Correct. Fixed cost of production, how much you should take, sir? 4 lakh into how much was the absorption rate? 6 rupees, which will come to 24 lakhs. So see here, absorption costing 1,28 lakh is variable overhead and fixed overhead is 24 lakhs. So you will add the opening stock. I mean, all you have to do is you add this divided by 4 lakh. That is, then you will get per unit how much. So that you multiply it with the opening stock, that is 50,000, and closing stock, that is somewhere around 62,500. This total cost is cost of production divided by number of units produced. You will get per unit how much. That you multiply to the opening stock as well as closing stock. You will get some amount. Now this is your production cost or COGS basically. More than production cost, you can tell it as COGS. To the COGS or from the COGS, you are going to reduce the other expenses. That is selling expense you are going to reduce, variable as well as fixed. Correct? So from the sales, if you reduce these COS, you will arrive at some profit. And I told you actual overhead cost is how much, sir? Actual overhead cost is 30 lakh. How much you absorbed, sir? You absorbed 24 lakh, which means 6 lakh you haven't shown as an expense. 6 lakh you haven't shown as an expense. Now treat it as an expense, which means reduce it from the profit. So you are going to reduce 6 lakh from the profit. You will get profit under absorption. This is how you are going to do. Now quickly we'll see overall marginal costing, few illustrations. Okay. Yes. Now quickly let's discuss few illustrations. So illustration number 5. See here. You have given the following information for the coming year of the factory. Fixed expense is expected to be 4 lakh and the selling price is 20 and the variable cost is 10. So you can tell contribution is how much? Rupees 10. Correct? So can I tell PV ratio as 50%? Yes, that is 10 rupees divided by 20 rupees into 100. PV ratio is 50%. Budgeted output is 80,000. They are asking you to calculate break-even point in rupees and margin of safety in rupees. So listen here. Let's say first we'll calculate right now whatever is there, no? For that, how much is the profit? How much is the profit available? That we will calculate. Based on that, we can compute break-even sales and margin of safety. So listen here. Sales is how much, sir? 80,000 units into rupees 20. So 80,000 into 20 will come to 16 lakhs. Okay. Variable cost is how much, sir? 80,000 into 10, which will come to 8 lakhs. Contribution is 8 lakh. Fixed cost is 4 lakh. Therefore, profit is how much, sir? Right now, profit is 4 lakh. Great. One thing. Next, let's take break-even point as, so break-even sales, we don't know. They're asking that also. So break-even, let's take it as X. Okay. Variable cost is how much, sir? Variable cost is 50% of sales, that is 0.5 X. So contribution is 0.5 X. Fixed cost is 4 lakh. Therefore, profit under BEP is 0, or you can tell that BEP contribution is equal to fixed cost. So X is equal to, people, 4 lakh divided by 0.5, which will come to rupees 8 lakhs. Rupees 8 lakh. So break-even sales is how much, sir? Break-even sales is 8 lakh. Actual sales is how much, sir? Actual sales is 16 lakh. Therefore, margin of safety will be how much, sir? Margin of safety also will be 8 lakh. Also, margin of safety you can compute. Margin of safety you can compute by dividing the profit by PV ratio. Profit is 4 lakh. PV ratio is 50% or 0.5 you can tell. So you will get it as again 8 lakhs. So this is how you computed break-even point and margin of safety. Very simple question. Going to the next question. Look here. From the following information, calculate the amount of profit using marginal cost technique. So fixed cost is 3 lakh. Variable cost is 5. Selling price is 10, because of which contribution is rupees 5. Selling price is 10. So PV ratio is how much, sir? PV ratio is 50%. Output level is 1 lakh. What they are asking? Calculate the amount of profit. One of the simple question. Sales will be how much, sir? 1 lakh into 10, which will be 10 lakh, minus variable cost will be how much, sir? Variable cost is 5 per unit. So 5 into 1 lakh, which will come to 5 lakh. Yes. So contribution is how much, sir? Contribution is 5 lakh. From that, reduce the fixed cost 3 lakh. You will get a profit of 2 lakh. Simple. You will get a profit of 2 lakhs. This is how you arrived at 2 lakh. Look at the 7th question. From the following, find out the break-even point. Fixed expense is how much? 1 lakh. Selling price is 20. Variable is 15. So break-even point, whether they are not telling in units you want or in amount you want, we'll calculate both. Sir, are we going to use the formula? Anything is fine. But one thing you have to remember, that is at break-even point, contribution will be equal to fixed cost. Correct, sir? Contribution per unit is how much, sir? Rupees 5. Contribution per unit is rupees 5. Let's say, and PV ratio is how much, sir? PV ratio is 5 by rupees 20, 25%. So try to understand at break even, let break even be X. Number of units sold be X. and contribution per unit is 5 is equal to fixed cost 1 lakh. Therefore, X is equal to 1 lakh divided by 5, which is 20,000. So now 20,000 units. 20,000 units. If you multiply rupees 5, then you will get break-even sales. Or you can compute it as, let break-even sales be A. Okay, sir. Break-even sales, we took it as A. Break-even sales or sales into PV ratio is contribution. So PV ratio is how much, sir? 25%. So 0.25 is equal to 1 lakh. Correct? A is equal to 1 lakh divided by, sorry, here we have to multiply 20,000 into 20, okay? Because selling price, no? Sorry, not 5, 20 you have to multiply. Here, A is equal to 1 lakh divided by 0.25, which will come to 4 lakh. So in amount, break-even point is 4 lakh. Look at the 8th one. From the following information, calculate PV ratio, break-even point, and also if the sales price is reduced to 80, calculate the new break-even. Okay. What information they have given, sir? They have given total sales as rupees 5 lakh. They have given rupees over here. So rupees 5 lakh. Selling price is 100. Variable cost per unit is 60. Fixed cost is 120. What they are asking you? They are asking you to compute PV ratio. They are asking you to compute break-even point. Variable cost will be how much, sir? Variable cost is 60. Selling price is how much? 100. Therefore, contribution per unit is how much? 40. So PV ratio will be how much, sir? 40 divided by 100 into 100, which will come to 40%. So PV ratio is 40%. Break-even point they are asking. Break-even point will be how much, sir? Let's take it as X. Okay. Break-even sales as X. Variable cost will be, if the PV ratio is 40%, then variable cost percentage will be how much, sir? 60%. So 0.6x. So 0.4x is contribution. From that, if you reduce 120,000, which is fixed cost, you will get 0. Correct? Break even. So 0.4x is equal to 120,000. X is equal to 120,000 divided by 0.4, which will come to 3 lakhs. Rupees 3 lakh. Sir, what if they want it in a unit, sir? Very simple. Let the unit be U. Number of break-even point to be sold in units be U. So sales will be 100 U. Variable cost will be 60 U. Contribution will be 40 U. Fixed cost is 120,000. It will give you 0 profit. So 40 U is equal to 120,000. U is equal to 40 divided by 120,000, which is 3,000. Correct? Yeah. 3,000 units. In units, it is the thing. Now they are asking break-even point if the selling price is reduced to 80. What about the break-even point when the selling price is reduced to 80? Try to understand. Now sales, try to understand. Selling price is how much, sir? 80. Variable cost will be how much, sir? Variable cost won't change along with the selling price. So it will remain 60 only. So rupees 60. Therefore contribution is 20. PV ratio will be how much, sir? 20 divided by 80 into 100, which is 25%. PV ratio is 25%. Variable cost percentage is 75%. Now sales, if you take it as Y minus variable cost will be 0.75Y, your contribution will be 0.25Y minus fixed cost, which is 120,000. Correct? You will get a profit as 0. So 120,000 divided by 0.25, Y will be how much, sir? Y will be 120,000 divided by 0.25, 4,80,000. 4,80,000. That is break-even sales in rupees is how much, sir? 4,80,000. Sir, in units how much, sir? Let it be B. Correct? Selling price is how much? 80B. Okay. Variable cost is how much, sir? 60B. Contribution is 20B. And fixed cost is 120,000. Profit is 0. 20B minus 120,000 is equal to 0. B is equal to 120,000 divided by 20, which will come to 6,000 units. So units wise, it is 6,000. 6,000, 4 lakh, 80,000. Earlier it is how much, sir? Earlier 3 lakh, right? This is how we computed illustration number 8. Going to the illustration number 9. See here, sales is 2 lakh, profit is 20,000, variable cost is 60%, which means PV ratio is 40%. Okay. Calculate the PV ratio, 40%. Straight away we computed. They are asking fixed cost. So it is pretty simple. Try to understand. Sales minus variable cost will give you contribution, minus fixed cost will give you profit. Okay, sir. Sales is how much, sir? 2 lakh. Variable cost is 60%, which is 120,000. 60% of sales is variable cost, 120,000. So 80,000 is contribution. So minus fixed cost, we know, we don't know that, let it be F. You will get a profit of how much? 20,000. They have given now how much is profit? 20,000. So can I tell 80,000 minus F is equal to 20,000. So F is equal to rupees 60,000. Therefore, fixed cost is how much, sir? Fixed cost is rupees 60,000. They are asking how much sales to be made to earn a profit of 50,000. Pretty simple. Sales to be made to earn the profit of 50,000. Let it be X minus variable cost. Variable cost is 60%. So 0.6 X and contribution is 0.4 X. Fixed cost is how much, sir? Fixed cost is 60,000. So you will get a profit of 50,000. So 0.4x minus 60,000 is equal to 50,000. So 0.4x is equal to 1,10,000. X is equal to how much, sir? X is equal to 110,000 divided by 0.4, which is around rupees 275,000. That is, you have to make the sale of 275,000 to earn the profit of 50,000. This is how we have computed illustration number 9. Going to illustration number 10. Listen here. From the following particular, calculate PV ratio. Profit when sales are rupees 40,000. New break even if the selling price is reduced by 10%, which means break even will change. Yes, sir. Because break even sales varies with price, because contribution changes. No. Yes. Fixed cost is 8,000. They are telling. Right now break even point is 20,000. Variable cost is rupees 60 per unit. Variable cost is rupees 60 per unit. In this scenario, what to do, sir? Make the maximum use of given data. Try to understand. Break even sales, they are telling rupees 20,000. Now, can I tell sales is 20,000? Okay, sir. Minus variable cost. Let it be. Will give you contribution. Yes. Minus fixed cost will give you profit as 0. Fixed cost, which is 8,000, will give you profit as 0. No. Break even we consider. No. Yes, sir. Therefore, can I tell contribution is also 8,000? Yes, sir. Contribution is 8,000. So can I tell my variable cost is 12,000? Yes, sir. Variable cost is 12,000. So can I tell PV ratio is nothing but contribution by sales. Contribution is 8,000. Sales is 20,000, which is nothing but 8 by 20, which is 40%. PV ratio is 40%. They are asking how much would be profit when the sale is 40,000. How much will be the contribution when the sale is 40,000? 40,000 into 40%, which is 16,000, minus fixed cost is 8,000. So new profit will also be 8,000. So profit when the sale will be 40,000 is rupees 8,000. They're asking what would be your new break-even point if the selling price is reduced by 10%. Now try to understand. Now try to understand very carefully. How many units have you sold, sir? How to compute that? Try to understand. In the previous calculation, we got to know how much is our total variable cost. It was 12,000. And also in the question they have given how much is variable cost per unit. That has rupees 60. So try to understand number of units sold if you take it as X. Number of units sold if you take it as X. X into rupees 60 will give you 12,000. Yes, sir. X is equal to 12,000 divided by 60, which is 200 units. So earlier you told you sold how many units, sir? Earlier you sold 200 units. So sales is 20,000 for 200 units. Per unit how much? Sales is 20,000 for 200 units. Per unit how much, sir? 20,000 divided by 200. Sales units is or selling price is rupees 100. Selling price is 200 units now. So selling price is how much, sir? Rupees 100. Now what they are telling? New break even if the selling price is reduced by 10%. Earlier it was 100 rupees. Now new selling price will be rupees 90. So let the break even be B. So 100 into B. Number of units to be sold is B. Minus variable cost. Will variable cost varies along with the sales price? The answer is no. So variable cost remains at 60 only. 60B. So sorry, this is not 100B, this is 90B. Okay, this is 90B. So your contribution is how much, sir? Contribution will be 30B. And fixed cost is how much, sir? 8,000. So profit will be how much, sir? 0. Because break even we are considering. So 30B is equal to 8,000. B is equal to 8,000 divided by 30, which is 266.67 units. You have to sell 266.67 units in terms of units. In terms of sales, it will be 266.67 into 90 rupees per unit, which is rupees 24,000. That is, to earn the break even or break even sales will be 24,000. New break even sales 24,000 here. This is how we have done our calculations. Okay, that's all about illustration number 10. Look at the illustration number 11. They're asking you to calculate the margin of safety. What and all data they have given, sir? The data given by them is fixed cost they have given, variable cost they have given, total sales they have given. Okay, so try to understand. Sales is 3 lakhs, sir. Okay, variable cost is 150,000, sir. Fine. Contribution how much, sir? Contribution also 150,000. Yes. Minus fixed cost of 1 lakh gave us a profit of 50,000. Yes, sir. Now can I tell my PV ratio is 150,000, that is contribution, divided by sales, which is 3 lakh, 50%. Yes, sir. Now I have a profit. I have a PV ratio. Don't you think I can find a MOS? Easily I can find a MOS as rupees 1 lakh. MOS is 1 lakh. Is there any other method, sir? Yes, there is a method. What is it? Break-even sales method. What is it, sir? Let the break-even sales be X. Okay. Variable cost is what, sir? Half. No. Variable cost. PV ratio is 50%. Variable cost percentage is also 50%. So let the variable cost be 0.5x. Yes. We will get a contribution of 0.5x. Yes. Fixed cost is how much? Fixed cost is 1 lakh. Will give a profit of 0. So 0.5x is equal to 1 lakh. X is equal to 1 lakh divided by 0.5. So your break-even sales will be 2 lakh. Your break-even sales is how much, sir? 2 lakh. Your actual sales is how much, sir? 3 lakh. So actual sales minus break-even sales will be margin of safety, which is 1 lakh. Which is 1 lakh. Hope it is clear. Going to the next illustration. See here. From the following information, calculate the cash break-even point. Sir, what do you mean by cash break-even point? Try to understand. Here we are trying to find out how much sales we need to recover only cash expenses other than non-cash expenses. What are non-cash expenses? Like depreciation, amortization, where cash flow is not there but treated as expense. Those are non-cash expenses. Now we want to find out how much sales we need to make sure we are able to pay our fixed cost, which are cash based. I mean, to recover the fixed cost other than non-cash expense, how much break even we should make? Very simple, people. You should consider only cash fixed cost for this purpose. Then you will arrive at a cash break even sales. What is this, sir? Try to understand what they have given. Selling price they have given 60, variable cost they have given 40, which means 20 rupees is what, sir? 20 rupees is contribution. So how much is the PV ratio? 20 by 60 into 100, which is 1 by 3. 1 by 3 means it should be 33.33%. PV ratio is 33.33%. Okay. Fixed cost is how much, sir? 2 lakh. Depreciation included in fixed cost is 50,000. So moral of the story, cash fixed cost is 150,000. Cash fixed cost is 150,000. So let the cash break even point be C. Okay. So how much is variable cost percentage? PV ratio is 33.33. Then variable cost percentage should be 66.67. So it is 0.6667 C divided by or minus, you will get 0.3333 C minus fixed cost, only cash fixed cost, which is 150,000, you will get 0. So 0.3333 C is equal to 150,000. So C is equal to 150,000 divided by 0.3333, which is rupees 4,50,000. Which is rupees 4,50,000. In units, how much, sir? How much is the selling price? 60, no? So rupees 4,50,000 divided by rupees 60. 4,50,000 divided by rupees 60. That is 45,000 divided by 6 comes to 7,500 units. Or you can do our normal table method also. Anything is fine. This is your question number 12. Okay. Look at question number 13. For the coming year, a manufacturing company has budgeted as under. What is it, sir? Contribution per sale. Basically, PV ratio is 45%. So variable cost is how much, sir? 55%. Margin of safety is 33.33%. Sorry, 33 actually it should be 33.33 because they have done a calculation based on 33.33. So please make it as 33 1 by 3. Okay. So margin of safety is 33.33. Then break even sales should be 66.67% of total sales. Fixed cost is 585,000. Okay. What you are supposed to determine? Determine the total sales volume for the coming year and profit thereunder. Determine the total sales volume for the coming year and profit thereunder. How to determine this, sir? Pretty simple. Try to understand. We know the break-even sales percentage or margin of safety percentage. Correct? Also, we know the PV ratio. If we know the PV ratio, then very simple. Try to understand. Let break-even sales be X. Let break-even sales be X. So contribution will be at break-even point. How much it will be? 45%, no? So 0.45X. Correct? And we know that in a break-even point, contribution 0.45X minus fixed cost 585,000 will give you profit, which is 0. So X is equal to 585,000. X is equal to 585,000 divided by 0.45, which is rupees 13 lakhs. Which is rupees 13 lakhs. So one thing is clear now. Our break-even sales is how much? 13 lakh. And we also know that break-even sales is 16.67% of total sales. 16.67% of total sales. So 13 lakh is 66.67 percentage. 100 percentage is question mark. You have to calculate how much is 100 percentage. So all you have to do is 13 lakh divided by 0.666666666 you should do. You will get around rupees 19 lakh 50,000. 19 lakh 50,000. This is your total sales. This is your total sales. How much? 19 lakh 50. Also they are asking you to calculate how much is the profit. Pretty simple. 19 lakh 50 is the sales. Contribution will be how much, sir? 19 lakh 50,000 into 45 percentage. So 19 lakh 50,000 into 45 percentage, you will get around 8 lakh 77,500 minus fixed cost, which is 585,000. You will get around 2,92,500. 2,92,500. This will be your profit. Okay. Going to illustration number 14. When the sales of the company decline from 9 lakh to 7 lakh, sales is falling, that is 9 lakh, one more sale is 7 lakh. Profit of 50,000, when the 9 lakh profit was 50,000, converted into loss of 50,000. When it went to 7 lakh, it became loss of 50,000. Determine the contribution margin. Try to understand one thing. You can use equation method, or you can use other method. I will tell what it is. The change in profit is nothing but change in contribution. Why sir? Because fixed cost remains same. Whether it's 9 lakh or 7 lakh, fixed cost remains same. So can I tell change in sales of 2 lakh led to the change in profit of how much? 1 lakh. Because positive 50,000 to negative 50,000, difference is not 50,000, difference is 1 lakh. So can I tell this is not only change in profit, this is also a change in contribution? Because the change in profit, the reason is change in contribution. Yes sir. So can I tell change in contribution divided by change in sales will also give you PV ratio? Yes. So change in contribution is how much, sir? 1 lakh divided by change in profit is how much, sir? 2 lakh. Change in contribution is 1 lakh, change in sales is 2 lakh. So moral of the story, PV ratio is 50%. PV ratio is 50%. So one more formula you can remember, that is PV ratio is equal to change in profit divided by change in sales. No sir, we don't want to remember. Do you have any other idea? Yes, of course. What is it, sir? Try to understand. Let's take contribution percentage as X. Contribution not amount, contribution percentage as X. Can I take two different sales, 9 lakh and 7 lakh? Yes, sir. In these two, how much will be the contribution? Contribution for the first one will be 9 lakh X. Correct? 9 lakh into contribution percentage. 9 lakh X. Second one is how much, sir? 7 lakh X. Contribution percentage will remain same. Amount will change, but percentage will remain same. Yes, sir. Minus fixed cost. We don't know how much is fixed cost. Let me take it as F in both the scenarios. Yes, sir. Do we know the profits in both the scenarios? Yes, sir. In the first scenario, profit is positive 50,000. In the second scenario, it is negative 50,000. So can we write it in the equation form? Yes, sir. That is 9 lakh x minus f is equal to 50,000. Equation number 1. 7 lakh x minus f is equal to minus 50,000. Okay, sir. This second equation. So I will solve this. 9 lakh x minus f is equal to 50,000. 7 lakh x minus f is equal to negative 50,000. Minus plus. So FF will get cancelled. So what is here, sir? 2 lakh x is equal to 50,000 plus 50,000, 1 lakh. So x is equal to 1 lakh divided by 2 lakh. 1 lakh divided by 2 lakh, which is 0.5. So what was x? X was nothing but PV ratio percentage. So how much it is? 50%. This way also you can do if you don't want to do under that equation, I mean that method, change in contribution, change in profit divided by change in sales. You can do this way also. No worries. Going to 15th one. See here. An exporter of garments is earning a profit of 1 lakh on a sale of 12 lakh. So when he is making profit, when he is selling 12 lakh, he is making a profit of 1 lakh, where the selling price was rupees 40. So how many units he sold? 12 lakh divided by 40. How many units is sold? 12 lakh divided by 40, which will come to 30,000 units. Which will come to 30,000 units. Okay. And variable cost is rupees 30 per unit. Variable cost is rupees 30 per unit. So try to understand. Selling price is rupees 40. Variable cost is rupees 30. Contribution is rupees 10. So contribution by selling price, PV ratio is 25%. PV ratio is how much, sir? PV ratio is 25%. PV ratio is 25%. Okay, sir. Done. Anything else? Let's see. Exporter incurs an additional fixed cost of 3 lakh on product improvement, which enables him to economize rupees 5 per garment variable cost. What do you mean by this, sir? Try to understand. If at all he incur, right now he is incurring fixed cost. Right now he is already incurring a fixed cost, some fixed cost. We don't know how much it is for the time being. Okay. If at all he incur extra 3 lakh on that fixed cost, if he incur extra 3 lakh on that fixed cost, he will be able to reduce the variable cost from 30 to rupees 25. So if he incur extra 3 lakh, he will make the variable cost as rupees 5. Okay. As per the trade agreements, the sale of his garment is restricted to the old value of 12 lakh, which means as per the agreement, he can't sell more than 12 lakh. Maximum he can sell is rupees 12 lakh in sales value. What should be the selling price per garment so that exporter earns the same profit at the same sales value? So you want to earn the same profit. You want to earn the same profit by selling 12 lakh rupees. How much earlier you used to sell? 12 lakh only. But now what happens? Variable cost will decrease, fixed cost will increase. No. Now they are asking how much will be the new selling price. So for this, what we should do, sir? Last year's all the informations are available. Sales is available. Okay. Variable cost is available. Okay. Profit is available. Yes, but fixed cost is not available. So we want fixed cost. We want fixed cost because we want to know how much will be our total fixed cost for the next year. Yes, sir. Correct. So now listen here. Your fixed cost, how to compute, sir? Last year sales was how much? Sales was 12 lakh. That is, you used to sell 30,000 units. Okay. Variable cost was how much, sir? 30,000 into rupees 40. 30,000 into rupees, rupees 30. 30,000 into rupees 30, which is 9 lakh. Okay. You used to get a contribution of how much, sir? Contribution of 3 lakh. And fixed cost we don't know, but we used to make a profit of 1 lakh. So from contribution of 3 lakh, what if you reduce? You will get 1 lakh. From contribution, you should reduce 2 lakh to get 1 lakh. From contribution, you should reduce 2 lakh to get 1 lakh. So fixed cost is what, sir? Balancing figure. So last year fixed cost is how much? 2 lakhs. Last year fixed cost was how much? 2 lakhs. Hope it is clear. Yes, sir. It is clear. Now, yes, sir. Now what? Now try to understand. Now they are telling new sales will be 12 lakh only. But how many units and what is the selling price? We don't know. Total sales will be 12 lakh only. Okay. Variable cost can we compute? The answer is no. Per unit 25 I know. Per unit 25 we know. But how many units sold do you know? You don't know. You don't know. So let it be. You will get a contribution. That also you don't know. Let it be. And they are telling fixed cost will be, last year it was 2 lakh. This year you are going to incur extra 3 lakh, which means fixed cost is 5 lakh. So that you will earn the same profit. So profit is how much? 1 lakh. So to earn the same profit, after reducing the fixed cost of 5 lakh, contribution should be how much, sir? Contribution should be 6 lakhs. Contribution should be 6 lakh. Can I tell my PV ratio as 6 lakh divided by 12 lakh, which is 50%? Yes, sir. PV ratio is 50%. PV ratio is 50%. So try to understand. PV ratio is 50%, which means variable cost percentage should be how much? 50%. Variable cost percentage is 50% of sales price. Now try to understand. Do you know variable cost is how much? Yes, sir. Last time it was 30. Now you are going to get a benefit of 5 rupees, which will become 25. Yes, sir. It will become 25. Now try to understand. 25 means 50%. 100% is question mark, which will be rupees 50. Therefore, new selling price will be how much, sir? Rupees 50. New selling price will be rupees 50. Hope it is clear. Now, look at the 16th one. On investigation, it was found that variable cost in XYZ Limited is 80% of the selling price. So, whatever the selling price, 80% is variable cost. So, PV ratio is 20%. If the fixed expense are 10,000, how much is fixed expense? 10,000. Calculate the break-even sales of the company. So let the break-even sales be X. So, contribution will be how much, sir? 0.2x. Correct? 0.2x minus 10,000 fixed cost will give you 0. So, 0.2x is equal to 10,000. X is equal to 50,000. So people, therefore, new break-even point is rupees 50,000. New break-even point is rupees 50,000. Done. Another firm, MN Company Limited. Another firm, MN Company Limited, having the same amount of fixed expense. They also have the 10,000 as a break-even point at a lower figure than that of XYZ. So they are telling one firm is their MN company. They also have same fixed cost. But for the break even, they don't even have to sell 50,000. They can sell less and make a break even. They can sell less and make a break even. Comment on this. Pretty simple people. That is possible when the contribution is more, no? When the contribution is more. Contribution when it will be more? Two reasons. One, either selling price will be more or variable cost is less. See, the lower break-even point is due to its lower variable expense to volume ratio, which it in turn may be either due to its lower variable cost per unit or higher selling price. Eventually, more contribution means early recovery of fixed cost. Simple. Yes, this is your illustration number 16. So, actually 17th one, before explaining 17th one, I have to explain you one small concept left, that is multiple break-even point. Give me a minute, I will explain it. Yes, sir, what do you mean by break-even when multiple products are there? Try to understand, people. So far, whatever we have done, in that one product used to be there, correct? We used to take the contribution of that and we used to find out break-even point, etc. Now my question is, in our factory, let's say there are 2 products are getting produced, 3 products are getting produced. Either is multiple product, not one product, more than one, correct? But fixed cost will be changed for everything? The answer is no, sir. Because in one factory only, one factory means one fixed cost. So try to understand, fixed cost will be one only. But products are 3, A, B and C. Now the question is, sir, how many units of A should be sold? How many units of B should be sold? How many units of C should be sold? So that contribution of all the 3 will be equal to fixed cost of the factory or a company. How to do this, sir? Very simple, people. Very simple. Listen here. What we did earlier, break-even point, how we used to ascertain? 2 formulas we used. One is fixed cost divided by contribution per unit. We used to get it in units. Or we used break-even point is fixed cost divided by PV ratio. Fixed cost divided by PV ratio. When multiple units are there, all you have to do is just in the denominator add C. Sir, what do you mean by this, sir? That is, you are not going to take contribution per unit, you are going to take combined contribution per unit. That is, all the units contribution together. Or you are not only going to take the PV ratio of one product, you are going to take combined PV ratio. Now the question comes, sir. How to ascertain the combined contribution? How to ascertain the combined PV ratio? How to ascertain combined contribution? How to ascertain combined PV ratio? Try to understand. Let's say there are 3 products, A, B, C. Sales ratio is, let's say, A 3, B 2, C 1. What do you mean by this, sir? We can sell 1 unit of C, 2 unit of B and 3 unit of A at the time. I mean, one time if you consider, for example, one day you consider, in a day, out of total sales of, let's say, 6 product, 1 product will be C, 2 product will be B, 3 product will be A. And contribution per unit is A will be, let's say, rupees 10 per unit, B is rupees 12 per unit, C is rupees 5 per unit. Now, how to ascertain the combined contribution, sir? Combined contribution is nothing but weighted average. The sales units are there, no? This you take it as a weight. And contribution, you take it as the value. What do you mean by this, sir? That is 3 into 10 plus 2 into 12 plus 5 into 1 or 1 into 5 divided by, I will write it as 1 into 5. Okay, summation wx we did. Okay, divided by summation w, that is 3 plus 2 plus 1. 3 plus 2 plus 1. Now what we will do, sir? 30 plus 24 plus 5 divided by 6 will give you how much, sir? 54, 59 divided by 6. You will get combined contribution in rupees. You will get combined contribution in rupees, that is I think around 9.166 something. That is 59 divided by 6. 9.833. 9.833 will get. It is combined contribution. Now what you will do, sir? Fixed cost divided by 9.833 if you do, you will get break-even points in units. Let's say you got around, let's say your fixed cost is 98,333. Okay, so you got 9.833, correct? So how much it will be? 10,000 units. Sir, 10,000 units of A, B, C, which one? Just divide it, no? Just divide it. In which ratio, sir? 3:2:1. That is 10,000 I am going to divide. That is 10,000 divided by 3. Sorry, divided by 6. 10,000 divided by 6 into 3. 5,000 units of A should be sold. 10,000 divided by 6 into 2. 3,333 unit of B, 1,667 unit of C should be sold. This is combined contribution. Sir, what if it's in percentage, sir? PV ratio how to find, sir? Then you calculate the sales also in percentages. You consider sales mix. So to the sales mix, you have to multiply the PV ratio. Okay. Sales mix will be how much, sir, in this case? 3 by 6, 50%, 0.5. 2 by 6, that is 1 by 3, 0.33, 0.167. Correct? These are the sales percentage. PV ratio also you take. Let's say PV ratio, here it is 50%, here it is 30%, here it is 20%. If you multiply sales percentage with the PV ratio, you will get a combined PV ratio. That if you divide by, fixed cost if you divide by combined PV ratio, you will get a break-even sales, because you are considering a PV ratio, not contribution per unit. That you have to divide later in the sales mix. That's it. Look at this question. Look at this question. Question number 17. ABC Limited manufactures and sells 4 type of product under the brand name A, B, C, D. Okay. Sales mix only they have given. Sales mix only they have given in percentages. So A, B, C, D. A, B, C, D. Sales mix in percentage. How much it is, sir? 33.33, 41.67, 16.67, 8.33. Okay. Sales mix in percentage they have given, sir. The total budgeted sales are rupees 60,000. Total expected is 60,000. That you leave. No worries. Now, variable cost as a percentage of selling price is, so variable cost percentage they have given. Using that we can compute PV ratio, no? Using that we can compute PV ratio. So now try to understand. PV ratio is how much, sir? For product A, variable cost percentage is 60%, which means PV ratio is 40%. Product B, 68% is PV variable, which means 32%. Product C, 16.67, where the sales mix is there, 80% is variable, so 20% is PV ratio. Product D, 40% it is, so 60% is PV ratio. Now just multiply sales mix with PV ratio, that is 33.33 into 0.4, that is 13.33. Okay. 41.67 into 32 percentage. So 41.67 into 0.32. Again 13.33. 16.67 into 0.2. 3.33. 8.33 into 0.6. 4.99, 5 I can consider. So total is how much? Total is 13.33 plus 13.33 plus 3.33 plus 5, which is 34.99. I can tell it as 35%. Combined PV ratio is how much? 35%. Fixed cost is how much? 14,700. So 14,700 divided by 0.35 will give you how much, sir? 14,700 divided by 0.35 is rupees 42,000. Now 42,000 is your break-even sales. Now you can divide it in the ratio of 33.33, 41.67, 16.67, 8.33. You will get a break-even sales for each and every product. That's it. Simple one. Correct? Now, last illustration of the unit also, of the chapter also altogether. Okay. From the cost records of the company for a specific period for product X, the information given in the first column can be ignored since it is one of its several projection of the assistant is useful. Listen. Sales units 10,000 and future projection is 20,000. Right now 10,000 loss is there. In future we are going to make a profit of 10,000. Fixed cost is 30,000, 30,000. Variable cost per unit rupees 8, rupees 8. On the basis of the first column, determine what increased sales volume is required to cover an additional attractive package cost of 0.5 per unit to increase the sales at an existing sales price to yield zero profit. So they are asking how many units of sales you have to sell extra. I mean, how many units of sales you have to make sure additional variable cost of rupees 0.5 is covered, to make sure you are going to make zero profit, which means break-even point. Break-even point. Basically, they are asking, take a variable cost as 8.5 and compute a break-even point. That's what they are asking. That's it. Getting it? They are asking you, take a variable cost as 8.5 and find out how much is the sales units. For that selling price, we want no, sir. Selling price could be computed using this, no? Selling price could be computed using that. Is it, sir? Yes. How? I will explain. What increased sales volume is required at the present sales price to cover an additional publicity expense of rupees 5,000 for a period while yielding a profit of 5,000. So, right now whatever is there, present sale price is there, no? For that, how much extra units we should sell at the present selling price to make sure that extra publicity is covered of 5,000, which means one extra fixed cost. That's it. Okay. Next, what increased sales volume is required to reach the profit of 4,000 while reducing the selling price by 3% per unit? Okay. Simple question. Listen here, everyone. First, all we want is selling price per unit. All we want is, thank you, selling price per unit. So, selling price per unit is how much, sir? Selling price per unit, let's take it as X. Selling price per unit, let's take it as X. Okay. Now, can I tell actual sales is 10,000 X? Yes, sir. Minus variable cost is 8 rupees. That is 10,000 into 8. Units sold is 10,000. Variable cost is 8, which is 80,000. Okay. Contribution is 10,000 X minus 80,000. Fixed cost is how much, sir? Fixed cost is 30,000. That is negative 30,000. gave us a profit of negative 10,000. Gave us a profit of negative 10,000. So try to understand. If we solve the equation, 10,000x minus 80,000 minus 30,000 is equal to minus 10,000. That minus is very important. Minus is very important. Now 10,000x is equal to minus 1,10,000 will go that side. It will become plus 1,10,000. So it will be 1 lakh. 1 lakh. Therefore, x will be rupees 10. Current selling price is how much, sir? Current selling price is rupees 10. Current selling price is rupees 10. So all the questions we can answer now. What is it, sir? What increased sales volume is required to cover an additional attractive package cost of rupees 0.5 per unit to increase the sales at the existing sales price to yield zero profit? Basically, they are asking, with the new variable cost, how much is the BEP, break even point? Let's say new break even point be X. Okay. So sales will be how much, sir, at break even point? Sales will be 10x. Is it, sir? Yes. Why? Because selling price remains same. Minus variable cost. They are telling variable cost of 0.5 is increasing. So it will become 8.5. So number of units we don't know. So 8.5x you can tell. Yes, sir. So contribution will be how much, sir? Contribution will be 1.5x minus fixed cost. How much is the fixed cost, sir, right now? Fixed cost is 30,000. Great. So what is profit? Profit, they are telling 0. 1.5x is equal to 30,000. So x is equal to 20,000 units. X is equal to 20,000 units. Right now, how many units we are selling? 10,000 units. In future, how many units we should sell to make sure we make sure break-even point we ascertain? I mean, break-even point we attain by incurring additional variable cost of 0.5. We have to make the sale of 20,000 units, which means extra how much you should sell? 10,000 units extra you should sell, because right now you are selling 10,000 units. Existing sales volume 10,000, extra is 10,000 units. First one is next. What increased sales volume is required at the present sales price? Present sales price to cover an additional publicity expense of 5,000 for that period, yielding a profit of 5,000. That is, present sales price is how much, sir? Rupees 10. So I will take sales as 10x. Variable cost will be 8x, because they didn't tell. You should consider that also. No, they didn't tell. Take the variable cost as a new one. So I am taking it as old one only. Okay. So it is 8x. Independent questions, no? So it will be 2x. It will be 2x contribution. Fixed cost is how much, sir? Fixed cost will be, right now it is 30,000. We are going to incur extra 5,000. So it will become 35,000. Yes, sir. Profit, are they expecting anything? Yes, they are expecting 5,000 profit. So 2x is equal to 40,000. X is equal to 20,000. So moral of the story is, again you have to sell 10,000 extra units. You have to sell 10,000 extra units. Going to the third one. What increased sales volume is required to reach the profit of 4,000 while reducing the selling price by 3% per unit? So they are telling new selling price is how much? 3% reduced. Right now 10 minus 3% will be rupees 9.97 or 9.7 it is. I think it's 9.7, no? Yeah. It should be 10 minus 3%. It is 9.7. Sorry, not 9.97. It is 9.7. Okay. Minus what, sir? Minus variable cost. Variable cost is rupees 8 per unit. Correct? Okay. you will get a contribution as 1.7x. Yes. Variable fixed cost is how much, sir? Fixed cost is how much they have given? 30,000. Fixed cost is 30,000. Profit they are telling how much you are planning to earn a profit. You are planning to make a profit of 4,000. Correct. So 1.7x minus 30,000 is equal to 4,000. So 1.7x is equal to 34,000. X is equal to again 20,000, which means you have to sell again 10,000 extra unit to make this happen. Yeah, that's it. With that, we have completed this particular marginal costing chapter, where students will tell that it's difficult. Nothing is there if you know the concept. So make sure all these things you go through once. With that, we have completed chapter number 3, revision. Hope it is clear. Next chapter will be relating to how we are going to apply our marginal costing concepts into different things like pricing decision. That is, pricing decision is all about how much you should charge it to your customer. How much you should charge to your customer. That is, what would be the selling price you will be charging to your customer. Make or buy decision. That is, certain things you can buy from outsider, certain things you can produce in your own. Now, whether buying from the outsider is better or making on our own is better. Buying from the outsider is better or making on our own is better. Try to understand. I will just give the glance of all this concept. Okay. Later we'll look at the questions of this instead of again going to the concept, because along with question, if extra concept comes, I will explain. Try to understand. Pricing decision is all about whether you are going to, at what price you should sell. Very simple. Price at which I can maximize my profit. Price at which I can maximize my profit. I am going to sell it at that price to my customer. I am going to sell it at that price to my customer. That is pricing decision. Make or buy decision is what, sir? Whether I should make in my factory or should I outsource it. Whether I should make it in my factory or should I outsource it. What you will do, sir? Let's say if I make cost is 10 rupees. If I outsource cost is 9 rupees. Now I am able to reduce the cost now by 1 rupee. Now what I will do? I will outsource it. Or if I make cost is 8 rupees. If I buy it from outside, then it will be 10 rupees. Then what is better to do? I will make. Basically, make or buy decision is all about, or on what basis you are going to take a decision in this case, sir. Very simple. Where my cost will be less. To make the cost will be less or to buy the cost will be less. Whichever is less, I will choose that. Accept an order or reject. Accept an order or reject. Here what decision you have to make, sir? Normal orders will be getting. Sometimes you might get a special order. Sometimes you might get a special order. Of course, not at the normal price. They might be giving it a less price. Now the question is whether you should accept that order and satisfy that or no. Whether you should accept that order and satisfy that or no. Pretty simple. If that new order adds to your profit, if that new order gives you additional profit, accept it. If it don't give you additional profit, don't accept it. Try to understand. If that additional sales, additional order gives you extra profit, accept it. If it don't give extra profit, don't accept it. Optimum utilization of factors of production. Try to understand. The resources are not abundant, right? Certain resource will be bottleneck, which means that will be restricted. Although you have a capacity, you won't be having a resource. That time, which resource you will, which you will produce. Very simple, people. For example, there is machine hour. Okay, machine hour is restricted now. Machine hour is restricted to 10,000. 10,000 hours of machine hour is available. Now, there are 3 products. Product A, product B, product C. Product A, product B, product C. Now, which you should produce more? Very simple. You should calculate which gives more contribution per unit of limiting factor. which gives more contribution for per unit of limiting factor. For example, product A gives you 10 rupees contribution, product B gives you 6 rupees, product C gives you 8 rupees contribution. This is contribution. Product A requires, machinery is a bottleneck I told. So, I mean, A, B, C, everything full you can't produce. To produce A, B, C full, whatever requirement is there, for that, machine hours are not enough. These are restricted. For example, to produce A, B and C, together you need, let's say, 15,000 hours. But hours available is just 10,000. Now the question is, whether A to produce, B to produce, C to produce. How much units of what to produce? Very simple. That time what you should do is, you should calculate the contribution per unit of bottleneck resource or limiting factor. Machine hour, A requires 2 hours of machine, B requires 1 hour of machine, C requires 3 hours or 4 hours of machine. Now what we will do, sir? Now we will calculate per machine hour how much contribution which is giving. A is giving 5 rupees per hour, B is getting us 6 rupees per hour, C is getting us rupees 2 per hour. So what we will do, sir, now? First we will produce how much ever required. Which one? B. B will produce. After that, if at all machine hour is remaining, then you produce A. Because you rank, no? Which gives you more contribution. B gives you highest contribution for the limiting factor. A gives you next highest. C gives you least. So later you produce A. After producing B, after producing required product of A, if still machine hour remaining, in that machine hour you produce C. Of course you can't produce full. If at all you can produce full, then this question only won't arise, no? Because there is no limiting factor only. Limiting factor is you need lot of resource, but so much resource is not there. In that situation, how much to produce what product, right? That is optimum utilization of factors. Okay, that we are going to see. Replacement decision. Right now we will be having some machinery which will be giving you some cost. Now you have a new option of going for different machinery. Now the question is whether to go for that new machinery or no. Pretty simple. If the new machinery cost, after installing new machinery, the benefit derived from new machinery is more than old machinery, go for it. If not, don't go for it. For example, in new old machinery, we are making a cost of 10 rupees per unit. If the new machinery makes it rupees 7, after considering its cost, additional cost also, then go for new machinery. Otherwise, don't go for new machinery. Evaluation of alternative choices. That is, you will be having different choices in that which to choose. That is based on the benefit derived. Whichever gives you a more benefit, you go for that. Subcontracting, again, just like a make or buy only. Expansion of business. That is whether you should expand a business or no. Pretty simple. To expand business, you need additional cost. So you should check whether it gives you additional benefit or no, additional profit or no. If you are able to make additional profit, go for the expansion. If you are unable to make the additional profit, don't go for expansion. Just be in the business where you are. Shut down or continue. Try to understand. Sometimes what happens, you will be making loss. But people, sometimes there will be something called as shutdown cost. That is, although you close your business, you have to incur such expenses. For example, lease agreement is for 10 years. That is, whether you run the business, don't run the business. For 10 years, you have to give a rent. Now, you close, you don't close. Now, the question is whether to close the business or not to close the business, because you are making a loss. Because if you are making a profit, then the shutdown concept itself won't come. You are making loss. So whether it is shut down or continue. Sir, you are making loss, no, so shut down, no. Try to understand. What we are going to check is, if we continue, how much will be our loss? If we shut down, how much will be our loss? If we continue, how much will be our loss? If we shut down, how much will be our loss? Whichever gives us less loss, that we are going to do. How is it, sir? Along with illustration, we will Get to know. This is what we are going to look in this particular chapter. Okay. Okay. Now look at the one illustration of pricing decision. Okay. A company is manufacturing a product, marks an average net profit of 2.5 per piece when the selling price is 14.3. So when the selling price is 14.3, we are able to make the profit of 2.5 by producing and selling 6,000 pieces or 60% of the capacity. So right now we are operating at what capacity? 6,000 pieces, which is 60%, which means 100% is how much, people? 100% is 10,000. So we have a capacity of producing and selling 10,000, but right now we are operating at what capacity, sir? 6,000, which is 60%. Okay. So cost is as under. So try to understand one thing. Selling price is 14.3. They are telling net profit is 2.5. Correct? So 14.3 minus 2.5. 14.3 minus 2.5 is 11.8. Correct? 11.8. Cost of sales is 11.8 right now at the capacity of 6,000 units. Okay. Direct material is how much, sir? 3.5. Direct wages is how much, sir? 1.25. Works overhead 6.25. 50% is fixed, 50% is variable. As well as sales overhead 25% is variable. What to do, sir? All we have to do is first we have to split the works overhead into variable and fixed. Try to understand. We are going to split it into variable and fixed. What they are telling? 6.25 per unit. Yes, sir. 6.25 per unit. So try to understand. 6.25. Give me a second. 6.25 into 50%, which is 3.125. 3.125 is variable, 3.125 is fixed. 3.125 is variable, 3.125 is fixed. Okay. Sales overhead is 0.8. In that variable and fixed, what they are telling? 25% is variable, which means 75% is fixed. So 0.8 into 25% is how much, sir? 0.2 and 0.6. Correct? 0.2 and 0.6. Using this, try to understand, using this we can find out a total fixed cost. How, sir? 3.125, how we got? By dividing total fixed cost by 6,000. Fixed cost per unit, how we ascertain? Total fixed cost divided by units. You will get, now you got per unit, which means you divided it by units. Which units? Actual units, which is 6,000. So now if you multiply 3.125 into 6,000, you will get a fixed cost as 18,750. In this scenario, how much, sir? 0.6 into 6,000, which will give you 3,600. So fixed selling overhead is 3,600. Fixed works overhead is 18,750. Okay, sir. Done. Now what, sir? During the current year, company, they given it as he, but make it as company intends to produce the same number. That is, they are planning to produce 6,000 units only, but anticipates that fixed charges will go up by 10%. So fixed charges are there, no? They will go up by 10%, and direct labor rate and material rate will increase by 8% and 6% respectively. Try to understand here there is a mistake, possibility of mistake. That is, what you will do is, material you will add 8%, wages you will add 6%. Don't do that, because labor and material respectively, not material and labor respectively. So labor is 8%, material is 6%. Keep that thing in mind. But company has no option of increasing the selling price. So company has no option of increasing the selling price. Under this situation, company obtains an offer for a further 20% of capacity. So company gets an offer for further 20% of a capacity, which means 2000 units. So they got 2000 units as a offer. What minimum price, that is you should quote minimum price, what minimum price you will be okay to ensure manufacturer's overall profit will be 16,730. So what they are asking, to earn the profit of 16,730, what minimum price you should charge, what minimum price you should charge. Pretty simple, people, try to understand right now we are selling how many units? 6,000 units, correct? 6,000 units. Okay. Direct material, right now how much you are paying direct material? Right now you are incurring 3.5 per unit, correct? They are telling direct material cost will increase by 6%. So what will be the new direct material cost? New direct material cost will be 3.5 plus 6%. 3.71. Okay. Direct labor will be how much, sir? Direct labor will be 1.25. Right now we have rupees 1.25 and there will be an increase of 8%. So 1.25 plus 8%, which is rupees 1.35. Okay. Direct labor will be so much, sir. Okay, fine. Next, variable factory overhead, no change will be there. That is, it will be 3.125 only. Rupees 3.125 only. And variable selling overhead also, there won't be any change, which will be 0.2 only. Total variable cost will be how much, sir? Total new variable cost 3.71 plus 1.35 plus 3.125 plus 0.2. Rupees 8.385. One thing to always remember, if you produce one extra unit also, you have to make sure rupees 8.385 you are going to incur, which means you are not going to agree something less than variable cost for sure. You are not going to agree something less than variable cost for sure. Because if at all you agree for less than variable cost, loss is guaranteed. Minimum you are going to charge variable cost. So much you know. But here in this case, we are expecting some profit also. Correct? So listen here. Fixed costs will go. Fixed factory overhead is how much, sir? Fixed factory overhead, last time it was 18,750. This year we are expecting fixed overhead to increase by 10%. 10%, which will come to 18,750. Give me a second. Which will come to 18,750 plus 10%. Rupees 20,625. There is fixed selling overhead. Last time how much, sir, it was? Last time it was 3,600. Last time it was 3,600. This time, last time it was 3,600. Yeah, last time it was 3,600. This time will be how much, sir? This time it will be 3,600 plus 10%. Rupees 3,960. 3,960. Total fixed overhead will be how much, sir? 20,625 plus 3960. Rupees 24,585. Rupees 24,585. Now listen. If we operate at the same level like last year we operated, we are going to sell 6,000 units. Yes. At what price, sir? They have clearly mentioned that you can't increase the selling price. It should be 14.3 only. Okay. 6,000 into 14.3. 6,000 into 14.3, which is rupees 85,800. Okay. Minus variable cost. Variable cost is how much, sir? New variable cost. New variable cost is 6,000 into rupees 8.385. 8.385. 6,000 into 8.385, which will come to 50,310. Correct? So 85,800 minus 50,310 will come to 35,490. Minus fixed cost. Minus fixed cost, which is 24,585. How much will be profit, sir? If at all you operate at the same level, minus 24,585. You are going to make a profit of 10,905. You are going to make a profit of 10,905. Now in question what they are asked, what will be your selling price? What will be your selling price for the new units? For the new units, if you want to make the profit of how much? 16,730, which means from the old units, you can make 10,905. Now extra if you want, you can make it through new units only. How much, sir? How much is the extra we are expecting? 16,730 minus 10,905. Rupees 5,825. We are expecting to make profit of 5,825. So how much profit per unit we should make? 5,825 divided by 2,000 units, which will come to 2.9125. So try to understand, people. Try to understand. This fixed cost is there, no? This fixed cost is there, no? That is recovered already. That is recovered already by selling 6,000 units. Now try to understand. You don't have to recover the fixed cost from the additional cost or additional production, because fixed cost is already recovered from the existing 6,000. So no fixed cost portion to be recovered. All you have to recover is variable cost, yes sir, plus expected profit from those units. You have to recover variable cost plus expected profit. So how much variable cost you have to recover? 8.385. Correct? Also profit of 2.9125. So total minimum you are going to charge 8.385 plus 2.9125. 11.2975, you can tell it as 11.28 like that, or 11.3. You are going to charge nothing less than 11.3 if you want to make a profit of 5,825. If you want to make a profit of 5,825. Okay. Or sir, is there any other method you can solve it? Yes. How is it, sir? Sales. Listen here. Sales, I am going to divide it into two parts. I am going to divide it into two parts. What is it, sir? Try to understand. Right now we are selling how many units? 6,000 units. At what rate? At the rate of 14.3. No doubt in that. Correct. Also, we are going to sell 2,000 more units. At what rate, sir? Let's take it as X. So total sales will be how much, sir? Total sales will be how much, sir? 6,000 into 14.3, 85,800, 85,800 plus 2,000x. Sales will be 85,800 plus 2,000x. minus variable cost. Variable cost is how much, sir? We computed now 8.385. So 8,000 units into 8.385. So 8,000 into 8.385, which will come to 67,080, which will come to 67,080. So new contribution will be how much, sir? 85,800 minus 67,080, that is 18,720 plus 2,000x. 18,720 plus 2,000x minus fixed cost. How much is the new fixed cost, sir? 24,585. 24,585. How much profit we are expecting, sir? We are expecting a profit of together 16,730. 16,730. Now if you solve, we will get X value. That is nothing but minimum selling price we expect. That is 18,720 plus 2000x minus 24,585 is equal to 16,730. So you can consider it as 18,720 minus 24,585. You will get minus 5,865. If you take that side, it will become plus. So 5,865, 16,730 plus 5,865, you will get 22,595. That is 2000x is equal to 22,595. X is equal to divided by 2000. 22,595 divided by 2000, you will get around 11.2975. That is 11.29, 11.3. So new price will be 11.3. You can solve it this way also. Basically, remember one thing: any of fixed cost is recovered, that's sorted out. At least variable cost you are going to recover. Always remember, to your customer, you will never charge something less than variable cost, because it will lead you to loss. It will take you towards loss. That's for sure. Because only if contribution is there, then the profit will come. Here contribution only you want to make negative, then what profit you can expect? You will accept a new order, or you are going to charge the price which is going to make you profit, not loss. So always remember, your price should not be less than variable cost if you want to make a profit. Fixed cost, if any additional fixed cost is there, then you consider that. If there is no additional fixed cost, ignore it, because that is already incurred, sunk cost, not required for decision making. Because anyhow you have incurred it. You sell 6,000, you sell 7,000, you sell 8,000, you don't sell. That is already incurred. You can't do anything. So you ignore that. So variable cost you take, profit expected you take. If profit expected is not there, at least variable cost you have to recover. You don't have option. That is all about your pricing decision. It was all about your pricing decision. Okay. Now listen here. Buy or make. That is whether you should buy or make it on your own. You might be, for example, you are a car dealer, car manufacturer. Now steering wheels. Steering wheels you can do it on your own, or you can buy it from outside. Whichever gives you less cost, you are going to go for that. Simple. Correct? So listen here. You are the management accountant of XYZ company. The MD of the company seeks your advice. Okay. On what, sir? Advice on what? Listen. On the following problem. Company produces a variety of product, each having a number of computer parts. Product B takes 5 hours to produce on machine number 99, working at a full capacity. B has a selling price of rupees 50 and a marginal cost of rupees 30. So you have one product called B. Okay. To produce B, it takes 5 hours of machine. 5 hours of machine, where selling price is 50, variable cost is 30. Contribution is how much, sir? Contribution is rupees 20. Okay, done. Next, A. There is one more component, A10. Okay, which can be made with the same machine, which takes 2 hours. Which takes 2 hours, and cost for the same is rupees 5. Variable cost is how much? Rupees 5. See, this is component used. B is what you are selling. Okay. Now, the supplier's price is 12.5. So, this component A10 is there, no? Supplier is charging you how much? 12.5. Supplier is charging you 12.5. Now, the question they are asking is, should the company make product A10 or buy it? Whether they should buy it from the outsider only or should they make the product. Assume machinery is a limiting factor. Assume machinery as a limiting factor. Very simple. Try to understand. Which means limiting factor means you can't do both B and A10 completely. If you want to produce A10, then you have to sacrifice certain portion of B. You have to sacrifice certain portion of B. Or if you want to make complete B, then you can't produce A10. So, how is it, sir, or what to do, sir? Very simple, people. Try to understand. How much contribution your B is giving? Your B is giving rupees 20 as a contribution. Correct? Your B is giving rupees 20 as a contribution. Yes, sir. Now, how much is a contribution per hour B is giving? It takes 5 hours of machine. So, per hour of machine, contribution is rupees 10. Per hour of machine, contribution is rupees 10. Okay. Now, if at all you produce CA on your own, the cost will be just 5 rupees. If you buy it, cost will be 7.5, which means you can save 7.5. You can save 7.5. Savings also as good as contribution only. Yes, sir. Now, how much is the benefit per hour we will receive then? We will receive, here not 10, okay. 20 rupees for using the machine for how many hours? 5 hours. Rupees 4. 4 per hour. Contribution per limiting factor is 4 per hour. Now, 7.5 you can save by using your machine for 2 hours. Which means per hour of usage, how much benefit you can get, sir? Per hour of usage, you can get a benefit of 3.75. You can get a benefit of 3.75. Correct? Now, should you produce A or should you buy it from the outsider? Try to understand. Now, better to buy it from the outsider. Why, sir? If at all you produce A, try to understand what is happening. If at all you produce A10, let's say you have to produce 5 A10. You have to produce 5 A10, which means how many hours is required? 10 hours. 10 hours is required. Correct? By using the machine for 10 hours, how much you can save? Per hour 3.75. So you can save around 37.5. You can save around 37.5. Correct? Now, you are using machine for 10 hours, which means in that 10 hours, you would have produced 2B. Correct? You would have produced product B, 2 products. Correct? Yes, sir. Now try to understand. What will happen if at all you produce 2B, how much you are going to make profit? You are going to make contribution of 20 from that. Correct? 20 rupees per product, 2 products, which will be rupees 40, which means you can save 37.5. I agree. But in the process of saving 37.5, you are going to lose 40 rupees. Because variable cost, if you produce, you have to incur. At the same time, anything you produce A, you have to incur A's variable cost. You produce B, you have to incur B's variable cost. However, if at all you produce A, then 10 hours is lost. In 10 hours, you can produce 2B. If you produce 2B, you would have made a contribution of 40 rupees income. But because of producing 5 C's, you are making a saving of 37.5. Income 40 rupees. By not earning that income, you are able to save 37.5. Better to make income. So, it is advised for the company to buy it from the outside. So, it is advised to buy it from the outside. This is how you are going to do. Because fixed cost has no importance. Fixed cost has no importance over here unless and until it is relevant. Relevant means what, sir? If you do that, you are going to incur that. If you don't do that, you are not going to incur that. For example, if you produce A10, extra fixed cost of 10,000 to be incurred, then the 10,000 also plays a major role in decision making. Otherwise, no. Okay. See here. A TV manufacturing company finds that while it costs 6.25 to make each component of X, the same is available in the market for 4.85. So try to understand TV manufacturing, what they are telling. Now they are making one component X that cost them total 6.25. While if they buy it from the outside, they can get it for 4.85. Sir, then buy it from the outside. No, why you want to incur? Wait. The breakdown of cost is as follows. Material 2.75, labor 1.75, other variable 0.5, depreciation and fixed 1.25, total is 6.25. Try to understand. In the 6.25, I am going to divide between variable cost and fixed cost. Fixed cost is 1.25, which means variable cost is rupees 5. Variable cost is rupees 5. Try to understand this thing. What is it, sir? Whether you buy the component, or whether you produce the component. What is it, sir? Whether you buy the component or whether you produce the component, this you are going to incur. Because that is fixed. Whether you produce 0 component, whether you produce 100 component, that is there now. Yes, sir. So try to understand. If at all you buy from the outsider, to outsider you are going to pay 4.85. Yes, sir. Also you are going to incur the fixed cost of 1.25. So per component, how much is the total cost to you? 4.85 plus 1.25. Rupees 6.1. Rupees 6.1. If at all you produce, you are going to incur 6.25. So better buy it from the outsider because total cost anyhow it is less. If at all your seller was selling at 5.3, then you would have taken it as 5.3 plus 1.25, which is 6.55. So producing is better because if you produce, you will incur 6.25. If at all you buy, you are going to incur 6.55 because fixed cost you can't avoid. So it is better to buy it from the outside. So look at the one more illustration here. Yeah. Carbon Limited manufactures 50,000 units of product with the following cost breakup. These are variables. This is fixed. So to produce this, 4 is fixed. Variable is how much, sir? 5 plus 8. 5 plus 3, 8. 8 plus 1.5, 9.5, 10, 12. Rupees 12 is variable cost. 4 is fixed cost. The product with the same specification is available in the market for 14 rupees. 14 rupees. What they are telling, would you make or buy it? Would you make it or buy it? Try to understand. If we make it, we are going to make a cost of 16 rupees. I mean, we are going to incur a cost of 16 rupees. If we buy it to our supplier, we are going to pay 14 rupees. Correct? Plus, this you have to incur. You don't have option. Whether you produce, you don't produce. Fixed cost you have to incur. No? So, you are going to incur this 4 also. Then that component cost to you becomes 18, not 14. If at all you produce, it will be 16. If at all you buy it from outside, component cost will become 18. So better produce it so that your cost will be 16. So in the first situation, we are going to make it. What would be your decision if the supplier offers to sell the product at 11? If he offers to sell the product at 11, we are going to pay him 11 and incur fixed cost of 4. Total rupees 15. But if you produce, it will cost you 16. In this scenario, what you will do? You are going to buy it. You are going to buy it because if you are not buy it. If at all you are going to produce, you will incur 16 rupees. If at all you buy, you are going to incur 15 rupees, which is better. 15 rupees is better. You are going to buy it. If it's at 12 rupees, to supplier you will pay 12 rupees. Fixed cost of 4 you will incur, which will come 16 rupees. If you produce on your own, then also 16 rupees. Then what you will do, sir? Left to you. Either if you want to buy, you can buy. If you want to purchase, you can purchase. I mean, if you want to produce, you can produce. If you want to buy from outside, you can buy from outside. Both will give you same. But this is quantitative wise. Qualitative wise, you should think whether supplier in future is going to increase price, then better to produce it. In supplier in future going to reduce price, then start buying it, so that in future you will get a discount. Or if you produce in future, you have a ability of reducing the price, reducing the purchase like production cost, then produce it. Like that, qualitative wise you can take different decision, but quantitative wise the decision won't make any difference. If you buy it also same, if you produce it also same. Now, frame industry is considering to making its own motor casting, which is currently purchased for rupees 20.5 per unit. Okay. The purchase price does not include the ordering, receiving, inspection cost, which frame expect to be rupees 2. So try to understand, it won't be just 20.55. Now it will be 22.5 for sure. Outsider cost only 22.5. Done, sir. It can manufacture the 6,500 required units at a lower cost than it's paying purchasing externally. So it can produce internally at less than that. Okay. The relevant cost for both the producing and buying is as follows. Try to understand. Per unit 6.25, direct labor 10, variable overhead is 5. Okay. If at all you make it on your own, it will be how much, sir? It will be 15 and 21.25. 21.25. If you make it on your own, you are going to incur 21.25 as a variable cost. If at all you purchase it, you are going to incur not 20.5, you are going to incur 22.5. So they are asking whether to produce or whether to buy it. Of course, if you produce total, you are going to incur 21.25. If you buy it, you are going to incur 22.5. Better to produce, no, because you are able to produce, you are able to save 1.25 per unit. So for 5,500 unit, you are able to save 1.25. So it's better produce on your yeah. See, assume that frame facilities will remain idle if they do not manufacture the casting. Frame industry would increase income by 8125. That is how, sir? 5,500 into 1.25. 5,500 into 1.25. 1.25 only they can save, no? Give me a second. 22.5 minus 21.25. 1.25. So they can save around this by making the component instead of purchasing it. Correct? If, however, sorry, 6,500, not 5,500. 6,500 into 1.25. 8,125. They can save 8,125 if they make it and not buy it. If, however, frame could use the idle capacity to manufacture a new product line, then you have to consider opportunity cost, etc. Like whatever we did in illustration 2. That way. Okay. That was all about make or buy. Yes. Now we are discussing about accept an order or reject it. One more decision making based unit, that is whether you accept the order what you get or you should not accept the order. Sir, how to decide, sir? Very simple. If it is giving you benefit, extra benefit, accept it. It's not giving you, reject it. Okay. Sir, extra benefit means how, sir? If it recovers your fixed variable cost, if it recovers your variable cost, it gives you a contribution and there is no additional fixed cost, then accept it, sir, because whatever contribution is additional profit. Okay. What else, sir? If there is a contribution, good contribution, at the same time additional fixed cost is there. Now, if you accept that, you will incur that cost. If you don't accept that, you will not incur. Then that fixed cost will become relevant. Yes. Now, if at all your contribution is able to recover that fixed cost and give you extra benefit, accept it, or else don't accept it. That is the thing. So you should check whether additional fixed cost is there, additional fixed cost is not there. Let's say additional fixed cost is not there. Now, all you have to do is get a positive contribution, because whatever contribution you get, everything will go towards a profit. Second, no sir, extra fixed cost is there. Now you should check the extra contribution what you will get by accepting, whether that will recover your additional fixed cost and gives you a benefit. If the answer is yes, accept it. No sir, contribution I am getting is 1 lakh. Extra fixed cost I am incurring is 150,000. Now don't accept it. This is what you are going to do in accept an order or reject it. Okay, we'll see a few questions based on this. Look at this question now. A company currently operating at a 80% capacity, which means company is operating at 80% capacity, which means there is a space of other 20% capacity. Correct? Profitability particulars is as follows. Sale is so much, 12,80,000. That is, when you are operating at 80%, your sale is 12,80,000. Cost is, these are the variable cost, that is direct material, direct labor, variable overhead, which is almost 560, 6,40,000. Correct? Which is 50% of your sales. Which is 50% of your sales. Done. Fixed overhead is 520,000 and you are making a profit of 120,000 right now. Okay. Now, an export order has been received that would utilize half of the capacity of the factory, which means now we are getting new order. To satisfy, you need to use 50% of the factory. Sir, how is that possible, sir? The only way available is 20%, anyhow it is available, but the remaining 30%, now you should leave your current customer and you should satisfy that 30%. Correct? The order has either to be taken in full and executed at 10% below the normal domestic prices or rejected totally. You can't tell 50% and all I can't give, but 20% I can. You can't do that. Either you have to take full 50% or it is 0%. The alternative available to the management is given below. What are the different alternatives available? 1. Reject order and continue with the domestic sales. Right now, whatever is happening, 80%. Or accept it. Accept order. Split capacity equal between overseas and domestic sales and turn away excessive domestic sales. Third one, increase the capacity so as to accept the export order and maintain the domestic sales. That is, you have to increase your capacity by 30% more. So, how much will it cost, sir? To increase capacity extra you have to incur? Yes. How much will it, sir? Buying an equipment that will increase capacity by 10% and fixed cost by rupees 40,000. So what you are going to do? 1, you are going to buy a equipment which will increase your capacity by 10%. Because of this, your fixed cost also will be increased by how much? 40,000. Because of which your fixed cost also will be increased by how much? 40,000. Work overtime at 1.5 the normal rate to meet the required capacity. So what you are going to do? Because see, 100% was there. In that 80% you are utilizing. Other 50% if you want means you need 130% capacity. To go to here, 10% could be sorted out by bringing a new machine. Other 20% what you can do, sir? To achieve this, you are making your employees work overtime. But when they work overtime, you are going to make them payment of 1.5 the normal rate to meet the required balance capacity. To meet this 20% capacity, when they work overtime, you are paying them extra 1.5 times. That is, right now, normally you are paying 100 rupees. For this extra 20% work, you are going to pay them 150 rupees. Like that it is. Prepare a comparative statement and profitability. Suggest the best. Very simple. Three options are there. What is that, sir? Option number 1. Whatever you are working, continue it. Option number 2. Domestic sales 50%, export 50%. Okay. Option number 3. Domestic sale 80%, export sale 50%. To increase that 30%, incur extra fixed cost, incur extra labor cost. So, listen here. Now, when you are operating at 80% of capacity, you are making a sale of 1280. You are making a variable cost of around 640,000, because of which your contribution is 640. Correct? Contribution is 640. From that fixed cost, right now you have 520. So profit you are making is 120. This is given in the question. Now, let's say you are going to decrease your domestic sales, and instead of domestic sale, you are going to make export sale. Okay, sir. How to do it, sir? Pretty simple, people. Now you are operating at 80%. Yes, sir. And you are able to make 12,80,000. Agreed. Now you are decreasing it to 50%. So how much it will be? 12,80,000 divided by 80 into 50, which will come to 8 lakhs. So your domestic sales will be restricted to 8 lakhs. 50%, 8 lakhs. Okay. So, sir, export is also 50% only, no, sir? Export is also 50% only, no? So, that also should be 8 lakh. The answer is no. Why? Because export sale you can make by giving the prices at below 10% below the domestic, which means it won't be 8 lakh, it will be 8 lakh minus 10%, which is 7,20,000. So in second scenario, your sales will be 8 lakh plus 7,20,000, that is 13 lakh 20. 8 lakh plus 7,20,000, 15 lakh 20. Now, third scenario is what, sir? You are going to maintain the domestic sale of 12,80,000 as it is. You are going to maintain domestic sale of 12,80,000 as it is. Also, you are going to sell to the export. How much, sir? 50%. 50% is how much we computed earlier? 8 lakh. But we are going to make it at 10% less value, which is 7,20,000. So, in the third scenario, total sales will be 20 lakhs. In third scenario, total sales will be 20 lakhs. That is 12,80,000 plus 7,20,000. Coming to the material, sir. I told you one thing yesterday, if you remember. Variable cost won't change along with the change of selling price. In this question, whether the selling price is changing, sir, or whether the quantity is changing, selling price is changing. Domestic to export, selling price is changing, which means variable cost remains same. So try to understand how to compute in this scenario, sir. Right now, for 80% of capacity, we are incurring 4 lakh as a material cost. In the case number 2, we are utilizing 100%. For that, how much? Cross multiplication, which will come to 5 lakh. Okay, sir. Now, for the 80% of the capacity, we are incurring 4 lakh as a material cost. In future, we are going to make 130%. For that, how much? I am telling you again, you can't apply the variable cost as 50% directly. The reason is in the export sale, selling price is falling, but variable cost per unit remains same, because variable cost won't change along with the selling price. So for 130%, how much, sir? For 130%, how much it will be? All you have to do is 4 lakh divided by 80 into 130. 6,50,000. 6,50,000. These are the direct material for these three situations. Okay, sir. Done. Next is what? Next is direct labor. Next is direct labor. In the situation 1, what they are telling? In the situation 1, what they are telling? 160,000. That is, when you are operating at 80%, your direct labor is 160,000. When you operate at 100%, how much it will be? Very simple, sir, 2 lakh. So for the case number 2, it is 2 lakh. For the case number 2, it is 2 lakh. What about case number 3, sir? Here there is a small thing you have to remember. That is for 80%, for 80%, you are paying 160,000. Yes, sir. For 100%, how much you pay, sir? For 100%, you pay rupees 3,20,000. Agreed. Agreed. Now, for 80%, you pay 160,000, sir. Yes. For 30%, how much you pay, sir? Why is it? I will tell. Why is it? I will tell. Now, for the extra 30%, if this is the rate, how much you should spend? Around 60,000 you have to spend. Around 60,000 you have to spend, provided it is at normal rate. But for this 30%, you are not paying at the old rate, you are paying at 1.5 times of the old rate, which will come to rupees 90,000. So to produce 100%, you will be spending 320,000 as a labor cost, and also you are spending 90,000 for producing other 30%, which will come to 4,10,000. Your labor cost is 4,10,000 for this. 4,10,000 for this. Give me a second. Not 4,10,000. Give me a second. Where is the calculation? Sorry, here it is not 360. No, sorry. It is not 360. Here it is how much, sir? Here it is 2 lakhs. Here it is 2 lakhs. So 2 lakh normal to produce 100%. 100%. For extra 30%, you will be paying 90,000, because 1.5 times you pay, no? So which will come to 2,90,000. 2,90,000. You can check it here. 260,000 and overtime is 20,000. Overtime is 20,000. Total is 280,000. Sir, but there in the study mat, it is 280,000. Why we are getting 290,000? Pretty simple. Try to understand here. Here what we did? One thing, remember. They are telling in question, the capacity is increased this way. 100% is there. First it will be increased to 110% by using the machinery. From here it will be increased to 130% by extra work. So extra work is happening here only. Extra work is happening only to the extent of 20%. So listen here. For 80% we are paying 160. Up to 110% we are going to pay normal rate only, because they are not working extra. For 110% we did the machinery changes and all. So they are working normally only. So for them we'll pay normally 220,000. Okay. 220,000. Now For the remaining 20%, that is for 80% 160,000, for 20% question mark, which will come to rupees 40,000. For this, we are going to pay 1.5 times, which will come to rupees 60,000. Overall, we are paying to the laborers around 280,000. Overall, we are paying to laborers how much, sir? 280,000. 260,000 plus 20,000, 280,000. Now, going to the variable overhead, 80,000 for 80%, which means 1 lakh for 100%, 130 for 130%. Done. So, using that, we get a contribution here. Done, sir. From that, we'll reduce the fixed cost. For the first two scenarios where we are using the existing capacity, no changes in the fixed cost, 520, 520. But for the third scenario, we are incurring extra fixed cost of how much, sir? Extra fixed cost of 40,000. So our fixed cost will become 560,000. Yes. So we'll find out the profit. First scenario profit is 120, second scenario 2 lakh, third scenario 380. So which is better, sir? Option number 3 is better. Option number 3 is better because it's going to give us a profit of 380,000. This is how we have to do this particular things, decision making. Basically, if the profit is increasing, go for it. If the profit is not increasing, don't go for it. As simple as that. Look at one more illustration over here. Yeah. A factory is running at a 50% capacity, which means other 50% is idle. It's not used due to the trade recession. The following details are available. Cost per unit will be calculated this way. 1032 is the variable cost, which will come to rupees 15, whereas fixed cost is rupees 5 per unit at current level. Because if the sales becomes more, total fixed cost remains same, cost per unit becomes less. If the sales become less, total fixed cost remains same, but the cost per unit becomes more. Current level fixed cost per unit is rupees 5. Current production per unit per year is 12,000. So how much is the total fixed cost, sir? 12,000 into rupees 5, which will come to rupees 60,000. Rupees 60,000. Okay. Total cost is 15. So sales is 180. Currently, we are making a loss of 60,000. Okay. A customer offers to buy 10,000 units at the rate of 17 per unit, and managing director hesitates to accept the offer. Because, try to understand, now you are selling 12,000 units and making sales as 180,000, correct? So, per unit, how much your per unit is sent at how much, sir? Per unit it sold as 15. But now customer is offering to buy it at what? At the rate of 17 per unit. Okay. Advise whether the company should accept or decline the offer, clearly showing the reason in support your answer. So now you should tell whether company should accept it or no, showing the reason for your answer. Current annual production capacity is 50%, which is 12,000 units. So try to understand. So at using a 50% capacity, we are able to make 12,000 units. So if you want to make 100%, it will be 24,000, which means right now we are selling 12,000 and our customer is offering 10,000, which means 22,000, which is well within the limit of which is well within the capacity of the organization, people. So keep one thing in mind. There is no expansion. There is no expansion in capacity. Moral of the story, fixed cost remains same, which means for the further decision making, fixed cost has zero impact. For the decision making, fixed cost has zero impact. Then what will have impact, sir? Only variable cost will have impact. How much is the variable cost? Variable cost is rupees 15. Variable cost is rupees 15. Your customer is ready to purchase it at 17. To produce this, you are going to incur 15, which means net you are going to get a contribution of 2 rupees. As the fixed cost is already covered in the earlier one, we are not going to think twice. We are going to accept the order because it is giving us a positive contribution where there will be no extra fixed cost to be recovered. Correct? So you are going to accept it. As no further fixed cost is to be incurred, entire contribution is towards a profit only. So automatically it contributes toward 20,000 of your profit. Right now you are making a loss of how much? 60,000. In future, loss will be reduced to 40,000. In future, loss will be reduced to 40,000. So it is better to go for it or no, sir? Absolutely go for that one. Okay. So that is about accept or reject. Now we are going to discuss about optimum utilization of factors of production, which are all limiting factors. So these factors are limited in nature, which means they are not scarce. Yesterday I gave you a glance how to do it. Today we are going to see few questions in this. Okay. Look at this question now. A company is producing two products. Okay. A and B. The particulars of the companies are as follows. Product A, product B. How much per unit? So they have given per unit cost. Okay. Sales is 75 and 80. That is selling price of A is 75 rupees. Selling price of B is 80 rupees. Material cost is 15 and 20. Labor cost is 20 and 15. Direct expenses 10 and 12. Variable overhead 10 and 15. Machine hours used. For product A, we are using 3 hours of machine. For product B, you are using 2 hours of machine. Consumption of material, both are using 2 kg, 2 kg. Okay. Comment on the profitability of each product if both use the same raw material when total sales potential in units is a key factor. That is, the total sales will be there, no? That is key factor. Whatever you are making sale right now, that is the max you can make. Now, which to sell better? I mean, which to sell more? Very simple. Which gives a more profit, that you have to sell more. Okay, which gives more profit, sir? Fixed cost is same for both. So which gives more contribution, that gives more profit. Total sales potential in values is a key factor. So whatever you are selling in value, that is a key factor. Raw material is in short supply, that is raw material is a key factor. Production capacity, that is in terms of machine hours, is a key factor. Okay, listen here. What you should do, sir? First you have to find out the contribution of both. Find out the contribution of both. That is, first one, these four are the variables. No, these four are the variables. 15, 20, 35, 45, 55. And in second scenario, it is 35, 50, 62. So, first one is giving you a contribution of 20 rupees. Second one is giving contribution of how much? 18 rupees. So, per unit, when the unit is a key factor, which means right now, for example, if 10,000 units you are selling in total, now 10,000 is the max you can sell. You can sell 9,000 of A, 1,000 of B, 5,000 of A, 5,000 of B, you do whatever you want, but more than 10,000 units you can't sell. If that is a case scenario, people, per unit, which is giving you more profit? A is giving you more profit because it's giving you a contribution of 20 compared to B, which is giving you a contribution of just 18. So, which is better, sir? A is better. So, see here, contribution per sale unit, it is giving more. So, better we will go for A. Next one. They are asking in terms of value. Then selling price, basically percentage of PV ratio or contribution percentage. Which is giving you more contribution, sir? This is giving 20 rupees for every 75 rupees sales you made. This is giving 18 rupees for every 80 rupees you made. So 20 divided by 75, which is around 26.67%. So if you sell A If you sell A, for example, 1 lakhs is a sale. If you sell 1 lakh rupees of A, then you are able to get 26,667 rupees as a profit. However, B 18 divided by 80, which is 22.5%, which means if your sales is restricted to 1 lakh, if you sell B as a sales, then you are able to make profit of just 22,500. So which is better, sir? Selling A is better. So in terms of value, which is better? A is better. Done. Raw material is a short supply, sir. Raw material is a short supply. In that scenario, per kg of raw material, whichever gives me more contribution, I am going to produce that and I am going to sell that. Simple. Basically, for the money you are investing in terms of raw material, how much you will get back, which gives you more return. That, for example, here A is giving you a contribution of 20 by using 2 kg of raw material. Per kg of raw material, it is contributing you how much? 10 rupees. What about B, sir? It is giving you 18 rupees is contribution for 2 kg of raw material. So per kg of raw material, how much it is giving? 9 rupees. So which is giving more contribution per kg of raw material? A is giving you more contribution. Again, select A. Done. Next, they are telling machine hour is a constraint or a key factor in that scenario. Try to understand. 20 rupees you are able to make by spending 3 hours of machine. So per hour of machine, how much it is contributing? It is contributing rupees 6.67. Correct? What about B, sir? It is giving you 18 rupees by using machine for just 2 hours, which means per hour it is contributing 9 rupees. Now, which is to produce more? It is better to produce B more. So see here. Product B is more profitable to product A when the capacity is a constraint. Hope you guys understood this constraint factor things. Right? So, we'll see one more question. Wait. See here. Your company produces 2 products, P and Q. Your company is producing how many products, sir? 2 products. Which are those? P and Q. The relevant data per unit of output is given below. Cost of direct material per unit they are telling 28 rupees, 13 rupees, labor 15, 25, variable overhead is 25, 12.5, fixed factory overhead is 10 rupees, 5 rupees, variable, this is selling expense, okay. This is fixed factory overhead, this is selling expense, it is 14 and 10, total cost is 92 and 62.5, that is total adding this. Selling price is 170. Profit you are making is 8 and 4.5. Profit has nothing to do here. Listen here very carefully. Factory overheads are applied on the basis of machine hours. So factory overhead on what basis you are applying, sir? On the basis of machine hour. Basically, apportion rate is machine hour. The existing plant and infrastructure will allow production and sale of either P or Q. Both the products are processed through the same production center. Try to understand. You can't produce both. You can't produce both. Either you have to produce P or you have to produce C. Either you have to produce P or you have to produce C. You are required to suggest which product should be processed and sold. Factory overhead are applied on the basis of machine hours. The existing plan and infrastructure, they repeated this point, okay. You are required to suggest which product should be processed and sold, which will give you more profit that you process and sell, which will give you more contribution that you process and sell. See, in this question, we only have to assume machine hour as a limiting factor and all. So it is like this. But in examination, they will give which is limiting factor. Give me a second. There is one nice question in your study mat for this limiting factor that we will do and we'll go to the next units. Okay, we'll do that question and we'll go to the next unit. Give me a second. Yes, look at this question. The availability of material A is limited to 8,000 kgs. That is, raw material is a key success factor here or key factor here. Okay, or a constraint. try to understand. We have three products, P, Q and R. Okay, sir. Demand for P is 2000, demand for Q is 2500, demand for R is 4000, which means basically max to max you are going to produce so much. Max to max you can produce, I mean you are going to produce P 2000, Q 2500, R 4000. Why, sir? Because if you have a capacity to produce also you won't produce, because after producing what you will do? Getting it? If you have a capacity also you won't produce, because after producing you can't do anything, because you can't sell it. You can't sell it because the demand is restricted. Now, variable cost is 10 rupees, 12 rupees, 14 rupees. Purchase price per unit is 13, 17, 16. Okay. Kgs per unit of material A, 3 kg, 2 kg, 1 kg, which means to produce 1 unit of P, you need 3 kg of A. To produce 1 unit of Q, you need 2 kg of A. To produce 1 unit of R, you need 1 kg of A. So try to understand now, if you want to produce as per the market demand, P how much you will produce, sir? 2000 you will produce. How many units are required per kg? 3, I mean per unit 3 kgs. So total how much you need? You need 6000 kgs. You need 6000 kgs. Okay. Then, sir, Q, you are going to produce 2500 kgs. What rate, sir? I mean 2 kg per unit. So you need around 5000 kgs. Okay. R, sir, 4000 at the how much, sir? 1 kg. You need 4000 kgs. Total you need how much, sir? Total you need 15,000 kgs. Total you need 15,000 kgs. Now the question is, sir, is 15,000 kg of raw material available? The answer is no. If at all it was available, we would have produced P also, Q also, R also according to the market demand. But here raw material is restricted, boss. So whether you are going to produce P, if yes, how many units of P? Are you going to produce Q? If yes, how many units of Q? Are you going to produce R? If yes, how many units of R? That we have to decide or take a call. For that, very simple. Now we have to find out per kg of raw material which is giving me more contribution, that will be produced first. After that, if any raw material is remaining, then we are going to produce the next ranked one. If still the raw material is remaining, then we are going to produce the third alternative. So let's see which is giving you more contribution, sir. Which is giving you more contribution. Try to understand. P, if you make, you are able to make it at 10 rupees. Okay. If you purchase, then it will be at 13 rupees. Moral of the story, by making you can save 3 rupees. By making you can save 3 rupees. When it comes to Q, 12 rupees if you do it on your own. If you buy it 17 rupees, so if at all you do it on your own, you can be able to save 15 rupees. This could be, end of the day, it's a contribution. Correct? The amount towards profit. Now, it could be sales and variable cost also. Anything. Benefit. Now, or if you produce, you can produce at 14. Whereas if you buy it, you have to buy at 16. Which means 2 rupees is what you are going to. Sorry, here not 15, it's 5. 2 rupees is what you are going to save. Okay. But here, raw material is a restriction. So try to understand. 1 kg of raw material, how much P will contribute? 3 rupees will be contributed when you are going to use 3 kg. So per kg how much, sir? 1 rupee. Done. Second one, sir, 5 rupees you are going to make by use of 2 kg of raw material. Per raw material how much rupees, sir? 2.5. Okay. Or 2 rupees you will save by selling or by using 1 kg of raw material. So you are able to save 2 rupees per kg use of raw material. So which is giving you more benefit? Q is giving me more benefit. Next, sir. R is giving. Next, sir. P is giving. Now, which will you make? Which will you buy? Try to understand. Now, let's say you make first Q. How many units you are going to make, sir? 2500 units. Okay. And what is the unit required per unit? What is the kg required? 2 kgs. So you are going to use 5000 kgs in producing Q. In producing Q, you are going to use how much? 5000 kgs. Great, sir. Next, 3000 kg is remaining. Correct? How many units of R is there demand? 4000 kg. Can you produce 4000 kg using 3000 kgs? The answer is a big no. A big no. So what you are going to do, sir? Max to max, how much you can produce, sir? 3000 kg is remaining. Per unit, you need 1 kg, which means you are going to produce 3000 kg. So, next, 3000 kg of R you are going to produce. So that 3000 kgs, total is how much? 8000 kgs. So, moral of the story is 5000 kg of Q, 3000 kg of R will be produced or made, and 1000 kg of R, that is remaining requirement, and 2000 kg of P will be bought from the outside. This is what your theory of constraints is. You have to work more question based on this, because this is one of the examiner's favorite area of asking questions in the examination. Hope it is clear. Now we'll go to the next kind of decision making. Okay, we'll go to the next kind of decision making. That is replacement decision. What do you mean by replacement decision, sir? Whether you have to replace the machinery or no. Whether you have to replace your capital asset or no. When will you replace, sir? When your benefit exceeds your cost, you are going to replace. Otherwise, you are not going to replace. Look at a question, then you will understand. Listen here. Basically, they didn't give a question on replacement, but they have given a question on something called as indifference point. Okay, IDP, indifference point. That replacement thing you are going to learn in your FM. Okay, in FM you have investment decision. In investment decision, the question will come whether new machinery should be bought or what, whether old machinery should be continue or no, like that. Okay, because if you get a new machinery, the regular setup cost, service cost and all will be less. But once you are going to incur a huge expenditure, correct? So that's the thing. Leave that. Listen here. What is IDP, sir? Indifference point. See, indifference point from question to question it changes. But in marginal costing or any costing, you remember, indifference point is, for example, let's say there are two products. Here in the given example, X1 and X2. Okay. Indifference point is the point or the sales. Point or the sales. Okay. At which, for example, 1000 is a indifference point. Means if you sell 1000 units of X1, if you sell 1000 units of X2, the cost will be same or the profit will be same. Try to understand? Try to understand? If you sell one, for example, in the example 1000 units, which means X1 also if you have to sell 1000, X2 also you have to sell 1000. In that scenario, benefit from the both or cost of the both will be same. That is your indifference point, which means those are not, they are not at all different. They are same. They are same. That is your indifference point. Okay. You can go through that illustration. In all other remaining decision making things, nothing much special is there. There is one thing called as shutdown or continue. Shutdown or continue. I told you yesterday, or I told you in the previous, while beginning of this chapter, that is, boss, if at all you are making a loss, you can't straight away tell that, boss, I am going to close my business because there will be some cost called as shutdown cost. There will be some cost called as shutdown cost. What is it, sir? That is, even if shutdown also you have to incur that. If you shut down also you have to incur that. Those costs are shutdown cost. Now, when the shutdown cost is there, you should take a very careful decision. That is, you should check whether producing gives you more loss or shutting down gives you more loss. Which gives you more loss, that you reject. The other one which is giving less loss, that you select. Okay. I will show a example. Listen here. The Hope company has 3 divisions. So they have 3 divisions, each of which makes a different product. The budgeted data for the coming year is as follows. A, B, C. Sale is so much. Direct material, direct labor, direct expense is so much. The management is considering the closing down of division C. The management is considering to close down the division C. There is no possibility of reducing the fixed cost. So they are telling you can't reduce your fixed cost, that will be remaining same. They are asking whether or not division C should be closed down. So they are asking whether division C should be closed down or. Try to understand. Now, how much is the profit as a company you are making? How much is the profit you are making as a company? How much, sir? 112,000. First, let's look at the sales. 112,000 plus 56,000 plus 84,000. Correct? Sales you are making is 252,000. Sales you are making is 252,000. Direct material, how much you are incurring, sir? Direct material you are incurring 28,000 plus 7,000, 35,000. Direct labor you are incurring is 5,600 plus 22,400, 23, 28, 35,000. Direct labor is 35,000. Direct expense is 14, 42, 49,000. Okay. So contribution is how much, sir? Contribution is 252,000 minus 119,000. Contribution you are making is 133,000. Contribution you are getting is how much? 133,000. And how much is the fixed cost, sir? Total fixed cost of the company, 28 plus 28, 56. 56 plus 14 comes to 70. 56 plus 14 comes to 70. 70,000. So right now you are making a profit of how much, sir? 63,000. Right now you are making a profit of 63,000. Okay. Done, sir. Now check what if C is closed down. Check what if C is closed down. Sales will be restricted to 112,000 plus 56,000, which will come to 168,000. Yes, sales will be 168,000 minus direct material. It will be 14,000 plus 7,000, because if C is closed down, no need to produce. If no need to produce, no direct material. So only direct material of A and B will be considered. Minus direct labor 12,600. Yes. Minus direct expense 21,000. It is 168,000 minus 21,000 minus 12,600 minus 21,000, which will come to 113,400 minus fixed cost. Now try to understand, although you close down C, these three you can avoid, but not this 28,000. That's what they are telling in the question. So your fixed cost will remain at 70,000 only. So it is 113,400 minus 70,000 which will give you a profit of 43,400. So by closing down the C division, your profit will be reduced to 43,400. Instead of doing this, do one thing, don't close down your business, or don't close down C. But if you see the C individually, how it looks, sir? Sir, our direct material is 14,000, sir. Direct labor is 22,400, sir. Direct expense is 28,000, sir. And fixed cost is 28,000. So how much it is, sir? 14,000 plus 56,000, that is 28 plus 28, plus 22,400, 92,400, 92,400. But sales is 84,000, which means you are making a loss of 8,000. Making a loss of 8,400. Making a loss of 8,400. Sir, better to close, no? But individually, if you see like that. But until your contribution is contributing towards fixed cost, until your contribution is contributing towards shutdown cost, at least, don't close your division. The result is in front of you. Okay. So there are other few decisions. Just go through all those things. Okay. And shutdown cost, if there is any other question, I will show you. Give me a second. Look at this question. Okay. T Limited manufactures 20,000 unit of X in a year at its normal production capacity. So what is it doing, sir? It is manufacturing how many units? 20,000 units at its normal capacity. The unit cost as to variable cost and fixed cost at this level is 13 rupees and 4 rupees. So variable cost is how much? 13 rupees. Fixed cost is 4 rupees per unit. So total fixed cost is 20,000 into rupees 4. Total fixed cost is rupees 80,000. Total fixed cost is rupees 18,000. Done. The selling price per unit is rupees 20. Selling price is 20. Variable cost is 13. So contribution is positive, which is rupees 7. Contribution is positive, which is rupees 7. Okay. Due to the trade depression, it is expected that only 2,000 units of X can be sold during the next year. Next year you can sell how much, sir? Only 2,000. From the 20,000 you are falling to 2,000. The management of T Limited is considering to shut down the plant. Because of this, of course, your 90% sale is going to decrease. So management is planning what? Let's close the business, boss. Let's chill. So the fixed cost for the next year are expected to be reduced to 33,000. So if at all, right now how much? 80,000. If at all you close down, then it will be 33,000, not 0. Try to understand. If you close your business also, you have to incur 33,000. The fixed cost for the next year is 33,000. Additional cost of plant shutdown are expected to be 12,000, which means additional cost of again 12,000 is expected if you shut down. If you shut down, you have been recently appointed as a management accountant of the company. Advise whether the plant should be shut down or no. Whether the plant should be shut down or no. So what you should do, sir? If you shut down, how much will be your loss? If you don't shut down, how much will be your loss? So which gives you less loss? Select that. Okay. Here, if the plant is operated, then what you are going to do, sir? You are going to sell 2,000 units, okay, at the rate of rupees 420 per unit. So which will come to 40,000. If the plant is shut down, you didn't produce only, what you will sell? Nothing, 0. Minus variable cost. If you produce only, you are going to incur this. How much? 13 rupees per unit. For 2,000 unit, it is 26,000. Done. Now, contribution is how much, sir? Contribution in first scenario is 14,000. Next scenario, it is 0. Okay. Minus fixed cost, sir. In first scenario, how much is the fixed cost? You are going to incur 80,000 as a fixed cost if you produce. If you shut down, your fixed cost will be restricted to 33,000 plus 12,000, which will come to 45,000. 45,000. Now, if at all you produce, your loss is 66,000. If at all you shut down, your loss is 45,000. Moral of the story, when it is shut down, the loss is less. Select that one. Select that one. Hope it is clear. Sometimes they will ask when the company should be shut down. That is, up to which sales it is better to operate. That time what you should do, sir? You should check. Try to understand. Shutdown cost will be there. Let's say 30,000. Now, if at all your contribution is more than 30,000, better to operate, because you are able to recover this 30,000 somehow. You are not going to incur this. If your shutdown is more, it is more, better. If at all it goes below this 30,000, if at all contribution goes below this 30,000, for example, by not shutting down, you are able to make 20,000. By shutting down, or by not shutting down, for example, I will take like this. Listen here. Let's say sales 1 lakh. Okay. Variable cost 60,000. Fixed cost. If you run the organization, it is 70,000. If you shut down, it will be 40,000. If you shut down, it will be 40,000. Now the question is whether to run the organization or no. Now, how to check that, sir? Contribution is how much? Contribution is 40,000. Done. Fixed cost is how much, sir? 70,000, because you are running. Loss will be 30,000. If at all you shut down, contribution is 0. Fixed cost will be 40,000. Your loss will be 40,000. So it is better to run or shut down, sir? Better to run, because loss is less. But to what extent you should run, sir? That is, to what extent of sale you can run. Try to understand until you are able to recover the shutdown cost. Run. For example, now if your contribution is more than 40,000, run the organization. Let's say your contribution is 30,000. Then you are making 70,000. As a fixed cost. How much will be your loss? Loss will be 40,000. If your contribution is 20,000 and your fixed cost is 70,000, loss will be 50,000. Try to understand. In this scenario, don't do it only. Shut down. If you shut down, your loss will be 40,000. So what you are going to do is, you will fix your loss as 40,000. Your shutdown cost will be your loss. Sales, you take it as X. Variable cost is 60% of X. 0.6X. You will get 0.4X as a contribution. Fixed cost is 70,000. It will give you negative 40,000. Now, 0.4X minus 70,000 is equal to minus 40,000. Now, 0.4X is equal to positive 30,000. Correct? Now, X is how much, sir? X will be 30,000 divided by 0.4. 75,000. That is, if at all your sales is more than 75,000, produce it. If it's less than 75,000, don't. Sir, proof, sir. Let's take two examples. One is 70,000 sale, one is 80,000 sale. One is 70,000 sale, one is 80,000 sale. Now let's take sales as 70,000. Shutdown sales will be 0 minus variable cost, correct? Which is around 60% of that. So 70,000 into 60%, 42,000. Shutdown, it is 0. Contribution 28,000. Shutdown, it is 0. Minus fixed cost. In this scenario, fixed cost is how much, sir? Fixed cost is 70,000. Fixed cost is 70,000. In this scenario, fixed cost is 40,000. In this scenario, fixed cost is 40,000. Here the loss will be how much, sir? Here the loss will be 70,000 minus 28,000, which is 42,000. Here the loss will be 40,000. That is, when the sale is 70,000, it is better to shut down or continue. Better to shut down because loss is less. One more sale I took it as 80,000. That is over and above this sale what I got. In that scenario, what it will be, sir? Sale will be 80,000. Shutdown sale will be 0. Variable cost will be 60% of this, which is 48,000. Here it will be 0. Contribution will be 32,000. Here it will be 0. Fixed cost 70,000. Correct? Here it will be 40,000. Which is giving you more loss? First one is giving you 70,000 minus 32,000. 38,000 loss. Second one is giving you 40,000 loss. In that scenario, better to shut down or no, sir? Not to shut down, continue because your loss is less. So they will ask up to what sales it is better to run your business. Always remember, up to you making a loss of shutdown, it is better to run. If at all your loss is exceeding your shutdown cost, close it. Because if you close it, your loss will be restricted only to shutdown cost. If you close it, your loss will be restricted to shutdown cost. If at all you produce more and more, then your loss will be exceeding your shutdown cost. Instead, restrict your loss to shutdown cost. So what we will compute? We'll compute a sales by considering loss of production as a shutdown cost. Then we'll get one sale. So over and above that sale you make, better to do it. If at all your sales is less than that point, then shutdown is better, because in that shutdown your loss will not exceed shutdown cost. It will be restricted to shutdown cost. These are all about this particular chapter, people. So next we are going for the next chapter. Okay. Now we'll be revising next chapter, that is transfer pricing. Sir, what do you mean by transfer pricing? Sir, pricing for transfers. What is this, sir? That is, when you transfer a goods, you are going to fix a price, no? That is called as transfer pricing. Sir, but while doing pricing decision also you told that the price at which you are going to transfer, that will be pricing decision. Yes. Transfer pricing also you are telling the same thing. Yes. But try to understand. Pricing decision is company fixing the price to sell to customers. Company fixing the price to sell to customers, outsider. Whereas transfer pricing is one department of the company or one wing of the company or one company of the group companies sending to the other division of the same company. Which means same company, in that from one place to other place, one division to other division, group companies, one company to other company of the same group company, the price at which it will transfer, that is known as transfer pricing. Basically it is internal pricing. Okay, this is nothing but internal pricing. That is, for example, a company is there called A. It has two divisions, X and Y. Now X division selling its products to Y division at what price, sir? That is your transfer pricing. For example, let's say this is a pixel. Correct? This is a pixel. Now it is of Google. Yes, sir. Which is operating system, sir? OS. Again, Android. Android is of whom? Google. Now let's say Google mobile is one division, Google Android is other division. Now for mobile they should give Android, no? Now this Android division, how much it will charge for a mobile division for each and every Android supplied? That is nothing but transfer pricing. That is nothing but transfer pricing. Now Google finding out how much they should charge for a mobile to a customer, that is your pricing decision that we have discussed already. Now we are going to discuss transfer pricing. Okay, hope you understood that basics. Yes sir. What are the different methods of transfer pricing, sir? What are the different methods of transfer pricing? Try to understand. Transfer pricing could be on the basis of cost based transfer pricing, market based transfer pricing, negotiated transfer pricing. What is negotiated transfer pricing, sir? Try to understand. Your division manager's performance will be decided on their division profit. So each and every manager try to make sure that their division profit is maximum, correct? To make sure that division is maximum, they expect their revenue to be more, cost to be less. Revenue to be more, cost to be less. So negotiated transfer price, what happens? Division X, division Y, both managers will come and decide one price. That is, division X should sell or should give or should transfer the product to division Y at what rate? To division Y at what rate? That is your negotiated transfer pricing. Market based transfer pricing is what, sir? Market based transfer pricing is, right now in market, how much X division is selling their product to outside customer, same rate will be charged to Y division. That is market based transfer. Cost based transfer, for the cost will be the base. In marginal cost, what we will do? They are going to recover variable cost in this. In the marginal based costing, they are going to recover a variable cost. In absorption costing, they are going to recover bit of overhead. Standard costing, they will fix one rate. How much is actual, etc. doesn't matter. They are going to charge at that. Two-part tariff, what happens is, people try to understand. Let's say division X is there, division Y is there. Okay. Division Y has two options. One, they can buy it from the X, or they can buy it from the outsider. Okay. If they buy it from the outsider, they have to pay 15 rupees. If they buy it from the outsider, they have to pay 15 rupees. For the product X, they are making the product at 14 rupees. The cost of making is 14 rupees. They can sell it to the outsider at 16 rupees. They can sell it to the outsider at 16 rupees. In that scenario, what they are going to do, sir? When Y manager comes and asks the X manager, boss, give us the product, how much they will quote the price as? How much they will quote the price as? They are going to quote the price as rupees 16. They are going to quote the price at rupees 16. Why? Because they can sell it to the outsider. They can sell it to the outsider. Yes, sir. They can sell it to the outsider at 16 rupees. So they can make the profit of 2 rupees. Yes. Now, will the Y manager will be ready to pay for it, sir? The answer is of course no. He won't be ready. Because in outside market, he is getting for 15 rupees. In outside market, he is getting for how much rupees? 15 rupees. Now, as a company, you think, for outsider, you have to pay 15 rupees. Okay. But if at all you buy it from the company itself, for X, if you pay 16 rupees, X is going to make a profit. So, as a company, which is better, sir? Whether to buy it from the outside or whether to buy it from the organization? Pretty simple. If you buy it from the outside, you have to pay extra, which will go to outsider. If at all you buy it from the same division or the same company's division, it is better, no? The revenue will be inside the company only. Always remember, this transfer price has nothing to do with the company's profit. Directly. Transfer price has nothing to do with the company profit. Company profit solely and solely depending upon outside at what rate they are going to send. But cost has impact. So try to understand. Now, X manager will not be ready to give it. Y manager will be buying from the outside. End of the day, who is going to lose? Company as a whole is going to lose. because both are concerned about their performances. Both are concerned about their performances. So this reason, what company will do is, company will bring something called as goal congruence. Company will bring something called as goal congruence. In goal congruence, what happens, sir? They will tell X division, okay boss, you want to send it at 16, fine, you send it at 16, no worries. Y, you want to buy it at 15, okay, you buy it at 15. End of the day, according to X, sale is how much? 16. Transfer price is 16. But according to Y, transfer price is how much? 15. For these people also win-win situation. As a company also, it is win-win situation. So now they are going to do two prices for this. This method of doing is goal congruence, because goals will be different. As a managers, you are concerned about your performances. You are least bothered about company's profit. Correct? As a managers, you are concerned about what, sir? You are concerned about your own performances. So which is better to you, that you will think, not from the company's point of view. But as a company, you should make a profit, no? So that is called goal congruence, working at the same goals. But here there will be a lack of goal congruence. To avoid that, what they are going to do is, they are going to charge two prices. For one department one price, the other department one price, because that has nothing to do with the actual sales and profit, because that is happening internally, right? That is goal congruence. And two tariff means, people, two tariff means what they will do is variable cost plus certain portion of fixed cost they will add, and they will charge it to other department. Variable cost of department X along with certain portion of fixed cost of department X, they are going to charge it to department Y. That is two-part tariff. All these things you will understand by looking at the example or illustrations that I will take you guys through it. Okay, I mean, which is better, that you will understand there only. Determining at what rate you should send. Next is your international transfer pricing. Try to understand. Let's say one company, Maruti Suzuki and Suzuki, both are Japanese company, but one is in India, one is in Japan. Now whether how much these people should charge, that is Japanese people, how much they should charge to the Indian company, or Indian company, whether it's better to buy it from the local source or from the Suzuki. To decide this, not only normal factors will be there, also tax factors also you should consider. Okay, how is that done, sir? I will explain you along with the question. Now let's straight away jump into the questions. Okay, these are theory questions. I'm going to skip it. See here, look at the illustration number 3. BC company fixes the inter-divisional transfer price for its product on the basis of cost plus return on investment. How they are doing a transfer pricing, sir? Transfer pricing is based on cost plus return on investment. The budget for the division for alpha is as follows. Fixed asset is 5 lakh, current asset is 3 lakh, debtor is 2 lakh. Total asset is how much, sir? Total asset is 10 lakh. Total asset is 10 lakh. Annual fixed cost of the division is how much, sir? Annual fixed cost of the division is 8 lakhs. Annual fixed cost of division is 8 lakhs. Variable cost is rupees 10. Variable cost is rupees 10. Budgeted volume is 4 lakh per unit. Desired return on investment is 28%. Determine the transfer price. Try to understand. On what basis we are going to do? On the basis of cost plus return on investment. Cost plus return on investment. What are the costs, sir? We have a variable cost per unit, how much? 10. Fixed cost how much, sir? 8 lakh. That is for overall. Per unit how much? 8 lakh divided by 4 lakh units. That is rupees 2. Rupees 2. Total cost is 12. Are we transferring at cost? The answer is no. They are transferring at cost plus return on investment. How much is the return on investment they are expecting? Their asset is 10 lakh, so their investment is 10 lakh. Yes, sir. How much return they are expecting? 28%. Overall, they are expecting around 2,80,000 as a return. From how many products? 4 lakh units. So per unit how much, sir? Per unit it will be, people, 40 divided by 280, which is 7. 7 rupees you are going to recover over here. Sorry, 0.7. 0.7 you are going to recover over here. So total you are going to send it at a transfer price of 12.7. This simple. Yes, sir. Done. Shall we look at the other illustrations? Yes. Listen here. Going to illustration number 4. Yes. Look at the illustration number 4. Author company is a multi-divisional company. So they have multi-divisions. And its managers have been delegated full profit responsibility and autonomy to accept or reject the transfer from other divisions. So they are responsible for profit directly. So they have a choice, or they have authority to either accept or reject the offer from the other division. Great, sir. Division X produces a sub-assembly with a ready competitive market. So Division X is there, no? They produce something called sub-assembly, and this has a market. That is, they have a outside market. It's not something like whatever you produce, the other division should use it. You don't have open market. Nothing like that. You have a market for it. Okay. This sub-assembly is currently used by Division Y for a final product that is sold outside at rupees 1200. So it is getting sold at outside how much, sir? 1200. This is market price. Okay. Division X charges Division Y market price for sub-assembly, which is rupees 700 per unit. So Division X is charging to Division Y how much? Just 700. Variable cost is 520 and rupees 600 for Division A and Division B. For Division A, how much is variable cost, sir? 520. For Division B, how much is the variable cost, sir? 600. So listen here. How much is the contribution of Division A? How much is the, Division X? Basically, it should be X and Y. Okay. Not A, B, it should be Division X and Y. So how much is the contribution of Division X, sir? Division X contribution is 700 minus 520, rupees 180. Rupees 180. Okay. The manager of Division Y feels that Division X should transfer the sub-assembly at a lower price than the market price, because at this price Division Y is unable to make a profit. So Division Y manager is telling, brother, listen, I am unable to make a profit. Please give me at a price less than what you are giving. Okay. Because now try to understand what Y is doing. Y, they are able to sell it at what price, sir? They are able to sell it at 1200. Market price for Y product is 1200. And they are incurring a variable cost as how much, sir? They are incurring a variable cost of 600. If you think that, the answer is no. Why, sir? This is other variable cost of Division Y. Also, you have to pay for sub-assembly, no? That is also variable cost. So, total variable cost, this 700 also will get added. So, 1300 is variable cost. So, they are making a loss of 100 rupees. They are making a loss of 100 rupees. So, what Y is telling is, Division Y is telling is, boss, we are making a loss of 100. Please give it at less price. Let's see what happens. Compute Division Y's profit contribution if the transfer are made at the market price, and also the total contribution profit of the company. So they are asking how much will be the contribution for the Division Y. I already computed and told it is negative 100. Total contribution to the company is how much, sir? See, outsider you are selling at 1200. Remember this. Outsider you are selling at how much, sir? 1200. For this, how much variable cost you are incurring? Division X is incurring a variable cost of 520. Division Y is incurring a variable cost of 600. So you are incurring a variable cost of 1120. So as a company you are making a contribution of 80. As a company you are making how much contribution, sir? 80. $80 or 180, sir? Give me a second. So as a company, you are making contribution of 80 only. Okay. As a company, you are making contribution of 80 only. See here. 80 and 100. Done, sir. Next one is what? Assume that division A can sell all its production in the open market. So they have the possibility of selling it at 700. Okay. If they sell it at open market, should division X transfer goods to division Y? If so, at what price? Try to understand. Try to understand. If at all they are able to sell it at outside, at what rate, sir? 700. Should X transfer it at what price to Y? Very simple. Listen here. 180 is the contribution what we are doing, or 180 is the contribution what we are getting. So it is better to sell to outsider. If at all, for example, division Y ask it for 650 rupees, then your contribution will fall to how much, sir? 130. So automatically we'll lose 50 rupees. Correct? So it's okay to sell it to outsider, plus if at all you sell it to outsider, you are going to get 700 rupees. So now if you want to sell it to Y, sell it not less than 700 rupees. I mean, if you want to sell it to division Y, then don't sell it less than 700. See here. The company's contribution is 100, greater if the subassembly is sold to on the intermediate market rather than to division Y. Thus, it should be sold to the intermediate market. The market price would be appropriate transfer price. That is alternative. Okay, done. Listen here. Next one. Assume that division X can sell its open market only at rupees 500 units at rupees 700 out of 1000 units that it can produce every month, and a 20% reduction in the price is necessary to sell at its full capacity. Should the transfer to be made? Try to understand. Now, and also listen here. If so, how many units should it transfer and at what price? Submit a schedule showing comparison of contribution margin under 3 different alternatives. See, 3 different alternatives. What, sir? 1. Transfer complete 1000 to division Y. Okay. 2. Sell 500 units in the intermediary market at 700 and transfer 500 units to division Y. Third one. Sell 1000 units on the intermediary market at 20% reduced price. Whichever gives a more profit to division X, that you are going to accept. First alternative is what? Transfer 1000 units also to division Y. So try to understand. Company sales as a whole is 1000 unit at 1200 rupees, which is 12 lakh. Correct. Variable cost is how much, sir? Variable cost is 520 of division A and 600 of division 520 of division X, 600 of division Y. Total it is 1120, which is 11 lakh 20,000. As a whole company, you are making 80,000 rupees profit. 80,000 rupees profit. One thing you have to remember. What will happen? Or how much your division manager Y is ready to pay you? Try to understand. Is the sales price is 1200? Is the sales price is 1200? To sell this, anyhow you have to incur 600 rupees. To sell this, anyhow you have to incur 600 rupees. Now he left out with 600 rupees. Now max to max, he will be ready to pay you 600. Max to max, he will be ready to pay you 600. Why, sir? Let's say if you quote at 650, he will tell, no boss, I am not going to buy you from you also, I am not going to buy from market also, I am not going to produce only. Instead of making loss, I will sit quiet. Because if you quote 700, he is making 100 rupees loss. If you quote 650, he is making 50 rupees loss. If you quote 600, he won't be making any loss. So he will either tell, boss, max to max I'm going to give is 600. So always remember, now if you want to sell it to Y, you can't sell it for more than 600 rupees. Okay. So first alternative is what, sir? Sell 1000 units to Y, then you can make it, sell it at 600 rupees. Okay. Variable cost is 520, which means you are going to make a profit of 80. First one, you are going to make a contribution of 80 rupees. So 80 into 1000, which will come to 80,000. Which will come to 80,000. Correct? Understood? Yes, sir. Next, second alternative. Sell 500 units in the intermediary market at rupees 700. So 180 rupees you are going to sell 500 units, and remaining 500 units you are going to sell it at 600 to division Y, which means contribution is how much, sir? Contribution is just 80 rupees. So 80 into 500. So how much it will be? How much it will be, sir? 180 into 500. 180 into 500. Give me a second. 180 into 500, which is 90,000. Okay. Plus 80 into 500, which is 40,000, which means you are going to make a profit of here 1,30,000 in total. Division X. Okay, sir. Done. Alternative 3 is what, sir? Sell whole 1000 units at an intermediary market at a price reduced by 20%. Right now, what is the price, sir? 700. If it's reduced by 20%, how much it will be, sir? It will be 560. It will be 560. Correct? 700 minus 20%. 560. So, if you sell at 560, variable cost is 520. Your contribution is just 40 rupees for 1000 units, which means you are going to make a profit of 40,000. So out of all the alternatives, which is better, sir? It is better to go for alternative 2. That is, sell it to outsider 500, remaining sell it to department Y at what rate? 600 rupees. Because that's what max to max they are going to give you. That's what max to max they are going to give you, because they are not going to give. I told no. If at all you quote more than 600, what he will tell? Boss, I don't produce only. Simple. Why I should produce? I am making loss. If I produce, I am making loss. Why I will produce? I will sit quiet. So you are going to charge 600. So which is better? Alternative 2 is better. Hope you understood this. Right? Let's go to the next illustration. Listen here. Look at this illustration now. The Webel Limited manufactures and sells television sets, TV sets. The assembly division assembles the TV. It buys the picture tube for the television from the picture tube division. So they have assembly division, they have picture tube division. So picture tube, assembly tube division takes the picture tubes from whom, sir? Picture tubes division. So who is transferor? Transferor is the division which is transferring. So this is transferor. Then the division which is receiving, that is called as what, sir? Transferee. Transferee division. Okay. The picture tubes division is operating at a capacity, which means they are operating at a normal capacity, 100%. The incremental cost of manufacturing the picture tube is 700 per unit. So variable cost is how much, sir? Rupees 700. Great. The picture tube division can sell as many as picture tube as it wants in the outside market at a price of 1,100. So price for the unit is how much, sir? 1,100. They can sell it outside at what price? 1,100. If it sells picture tube in the outside market, it will incur a variable marketing and distribution of rupees 40. This is very important. For marketing and distribution, you have to incur 40 rupees. Sir, that is not included in 700, sir. The answer is no. It is not included in 700. Okay. Okay. So what does that mean, sir? Try to understand, people. To sell it in your own company, that is to other division, is marketing necessary? Marketing necessary to sell it to outsider. Why to your own company? So remember one thing, if at all you are going to sell it to your own company's division, no need to incur this 40 rupees. No need to incur this 40 rupees. Remember that point in mind. Okay, sir. Similarly, if the assembly division purchases a picture tube from outside supplier, it will incur a variable purchase cost of rupees 20. So purchase department, if they buy it from outsider, they have to spend 20 rupees extra, which means market price is 1100. So they have to spend 1120 actually to buy it from outsider. Okay. Using the general guideline on transfer pricing policy, what is the minimum transfer price at which the picture tubes division will sell product picture tube to division, assembly division? Pretty simple. Try to understand. Try to understand. As a picture tube division, yourself as a picture tube division, because if I sell it to outsider, you are able to make 400 rupees after or before deducting market expense of 40. From outsider, you are expecting 360 rupees. Correct? Contribution, which means variable cost of 700 will be recovered. Along with that, extra 360 will be recovered. You understood why 360? Because 40 rupees extra you have to spend for marketing. So as you can sell outside for 1100 rupees and make a contribution of 360. Now, if your one more division tells, give it to me at less than that, will you agree? The answer is of course no. The answer is of course no. Because you expect at least 360 rupees contribution. If it is not giving you 360 rupees contribution, sell it to outsider. It is giving you 360. So, what will be the minimum price you expect? You tell, listen boss, 700 rupees I am incurring. Correct? Variable cost. That anyhow I have to recover. If you don't give me at least 700, so why I will produce? I don't produce only. Same logic. If I produce, I will incur expense of 700. If I don't produce, 0. Why to incur loss? So 700 I am going to recover. Along with that, if I sell it to outsider, net I am able to make the contribution of 360. So I am going to sell you for nothing less than 1060. If it's over and above 1060, come to talk. Otherwise, don't. So minimum selling price we are expecting is 1060. Second is what, sir? Suppose divisional managers act autonomously to maximize their own division's operating profit, either by transacting internally or buying and selling in the market. If two division managers were to negotiate a transfer price, what is the range acceptable? What is the range acceptable? Try to understand. Now, division X is not going to sell something less than 700. In fact, they are not going to sell for something less than 1060. That's for sure. Because by selling at 1060 only, they can make the minimum profit what they are expecting from the outside market. If the market is not there, then fine. I might give you at 700 because I am losing nothing. Here I am losing no if I give it for less than 1060. Correct? So assembly department is picture tube department is pretty simple, not less than 1060. Now assembly department, listen here. They can get it from the outside at 1120. Correct? 1000 rupees for purchasing and 1100 for purchasing, and 20 rupees is for extra purchasing cost. 1120. Now, if at all division tells give me transfer price as 1150, of course they don't accept, because from outside they are getting for 1120, which means they are not going to pay something more than what they are getting it at outside. So somewhere the negotiation price will be not less than 1060, because the tube department won't agree or picture department won't agree. and it won't go beyond 1120 because assembly department won't agree because they are getting it at 1120 from outside. So the range will be 1060 to 1120. Answer. Going to the sixth one. Division A is a profit center, which means they are responsible for both profit and cost, which produces 4 products P, Q, R and S. Each product is sold in the external market also. Market price 350, 345, 280, 230. Variable cost is 330, 310, 180, 185. So what is the contribution in the outside market? What is the contribution in the outside market? 20 rupees, 35 rupees, 100 rupees, and here 45 rupees. Done, sir. Labor are required per unit is 3423. 3423. Product S can be transferred to division B, but the maximum quantity that might be required for transfer is 2000 unit of S. So S can be transferred to division B, but max to max how much you can transfer? Only 2000 units. Okay, sir. Outside how much you can sell, sir? P you can sell 3000, Q you can sell 3500, R you can sell 2800, S you can 1800. S you can sell 1800. Division B can purchase the same product at slightly cheaper price of rupees 225. So you are going to sell it at 230, no? They can buy it from the outside market at 225 instead of receiving the transfer from S from division A. What should be the transfer price for each unit for 2000 unit of S if the total labor available in division A is 24,000 and 32,000? So here it is the question of transfer price as well as time constraint. It is the question of transfer price as well as time constraint. See how it's going to work. Let's quickly compute how much is the contribution. How much is the contribution per laborer? How much is the contribution per laborer? Listen here. P for 3 hours you are making 20 rupees. So you can tell per hour how much you are making, sir. Per hour you are making 20 divided by 3, which is rupees 6.67. Okay. Q 35 rupees for 4 hours. 35 divided by 4, 8.75. Okay. R you are making 100 rupees for 2 hours. 50 rupees. 50 rupees per unit per hour. Okay. Yes, 15 rupees per hour. Okay. Now if you rank, R you will produce more, S you will produce second, Q you will produce third, P you will produce fourth. Correct, sir? Now try to understand. Maximum sale of R you can make is 2800. So if you make 2800 units as a sales, 2800 into how many hours is required? 2 hours is required, no? 2. Which means you need 5600 hours. 5600 hours. Correct? Yes, sir. Now, yes. Externally you can sell 1800. Internally you can sell 2000. Total 3800 you can sell. 3800 units. 3800 units. How many hours is required per unit, sir? 3 hours is required. 11,400 hours. 11,400 hours. Total is how much, sir? 11,400 plus 5,600, which is 17,000. Still, how much is available? Still 7,000 hours is available. Still 7,000 hours are available. Yes, sir. Correct. Now, next ranking is Q. So, how much Q you can sell? 3,500 you can sell. At what rate, sir? Or 3,500, how much hours is required? 4 hours. which is 14,000. Of course, we don't have so many hours. Of course, we don't have so many hours. Okay. Okay. Now listen. Now listen. So how many units of Q could be produced, sir? How many units of Q could be produced, sir? 7,000 hours, which is remaining, divided by 4 hours is required per unit. 1750 we can produce. So 1750 into 4, which will come to 7,000 hours, which will come to 7,000 hours. Total is 24,000 hours. Now listen here. Give me a second. 24. P, you are not giving any hours. Okay, okay. This is with the transferring to other division. Now, without transferring, how much you can do, sir? Without transferring, of course, P you need 5,600 hours only. But for Q, you have to, or for this is for R, this for S, this for Q. No. So yes, you can sell only 1,800 units. 1,800 units. So how many hours it will take, sir? Yes, 3 hours it will take, which is 5,400. Which is 5,400. Total is how much, sir? 11,000. 11,000. Which means how many hours is still available? 24,000 minus 11,000, which is 13,000 hours is still available. Now in 13,000 hours, how many Q can be produced, sir? In 13,000 hours, you can produce 13,000 divided by 4. 3,250 Q, which is less than your market demand, which means still 250 demand will be there. Still 250 demand will be there. So try to understand this. If at all you accept the transferring to the other department, then you can produce Q how much, sir? 1,750. If at all you don't transfer, you sell only to the outside market, then you can sell, produce how many units of Q, sir? 3,250, which means how much it will be? 3,250 minus 1,750 is 1,500. That is what you can sell extra. So if you are able to sell extra 1,500 rupees, how much you are able to make, sir? You are able to make 35 rupees per unit. So 1,500 into 35. 52,500. Try to understand one thing. If at all you transfer it to the other department, by not producing a Q, you are losing 52,500. If at all you don't transfer to other department, then you can make 52,500 extra contribution from product Q. So understand one thing, you are not only going to charge variable cost, you are also going to charge how much is the contribution you are losing from the next best alternative. You are losing 52,500. So you are going to charge 52,500 for your 2,000 units divided by 2,000, 26.25 extra. Not only variable cost, you are going to charge 26.25. So minimum you are going to charge is variable cost of 185. Yes, sir. Plus 26.25 in this scenario. Plus 26.25. 211.25. So your transfer price will be 211.25. Hope it is clear. Yes, sir. Now What if the hours availability is 32,000? What if hours availability is 32,000? Again, if at all you didn't understand the 24,000, now listen and concentrate carefully. P is the first what we are going to produce, correct? Ranking wise, sorry, R, S, Q, P, correct? R, S, Q, P. R is the maximum we are going to produce first. How many units are there, sir? 3,000. First, let's assume transfer is there, no transfer. When transfer is there, how much will be your units will be produced? When no transfer is there, how much units will produce? So when transfer is there, you are going to produce how many units of P, sir? 3,000 units, correct? 3,000 into how many hours per unit? 3 hours. Sorry, give me a second. How many units of R is required? 2 hours, no? 2 hours, which is 6,000. Sorry, here only, which is 6,000. Okay. When no transfer is made, also you are going to 6,000 only, because first you are giving priority to R. Now, yes, sir. When the transfer is there, you are making how much sales or how much production? 1,800 to sell it outsider and 2,000 to transfer, which is 3,800. 3,800 into per hour, how much you are taking, sir? Per hour, how much you are taking? I mean, how many hours you are taking? 3 hours, which will come to 3,800 into 3, which is 11,400. 11,400. If at all you don't have, or if at all you don't sell it to your own division, then you will produce just 1,800. So for that, how much you will take? 5,400. Okay. Now, how many hours are utilized, sir? 6,000 plus 11,400, which will come to 17,400. How many hours were available, sir? Available hours were 32,000. Available hours were 32,000, which is 14,600. So 14,600 is excess in scenario 1. How much is excess in scenario 2? Excess in scenario 2 is 6,000 plus 5,400. 11,400. Excess in 11,400 minus 32,000 minus 32,000, which is 20,600. In scenario 2, excess hours available is 20,600. Now listen very carefully. Q, how much demand is there? Q demand is for 3,500, correct? 3,500, sir. Okay. How many hours required per unit? 4 hours. So 14,000 is the requirement of Q. Is there available in first situation? Yes, sir. So 3,500 into 4, which will come to 14,000. In scenario 2, so it is available only because we have 20,600. Correct. Now, in scenario 1, how much is available? 600 hours are available. In scenario 2, how many hours are available? 6,600 is available. In scenario 1, 600 hours are available. In scenario 2, 6,600 are available. So in scenario 1, how many units requirement is there? P, 3,000. How many hours it will take? 3 hours, which means 9,000 hours is required to produce P. Do you have enough time? No, sir. So how many units you can produce max to max? 600 divided by 3 or 4, it is 3. 600 divided by 3, which is you can produce 200 units. Max to max you can produce 200 units. 200 into 3, which will come to 600, which will be total hours will be equal to hours availability 32,000. Just check once, cross check. That is 6,000 hours required for R, 11,400 required for S, 14,000 required for your Q, and 600 required for your 32,000 is there. Okay, sir, done. What if you don't produce? Then hours available was 6,600. So in 6,600, how many units of P could be produced? 2,200. Demand is there for how much? Demand is there for how much? Demand is there for 3,000, which means demand is exceeding. So we are going to produce 2,200 of P for 3 hours, which will come to 6,600. So try to understand. Try to understand. If at all you transfer, you are producing only 200 units of P. If at all you don't transfer, you are producing around 2,200, which means by transferring it to the other division, you are going to lose 2,000 units of P, which will contribute you per unit. What is the contribution? 20 rupees. 20 rupees, which is 40,000. So you are not only recovering a variable cost from the other department, you are also going to recover this 40,000. So 40,000 will be recovered from the 2,000 units, which is rupees 20 per unit. Correct? 20 per unit will be recovered. Variable cost is how much, sir? Variable cost we discussed, no? Variable cost of S, sir. It is 185. So 185 plus 20, which is 205. You are not going to charge something less than 205 for sure. So your transfer price will be 205. Hope you understood this question. Treat it as a LMR, last minute revision. Before going to examination, you should study this and go. Okay. Okay. Now let's discuss one of the very important aspect, that is international transfer pricing, how it works, sir. Always remember, whenever international transfer pricing, it is how one country's company giving the goods to the other company. Basically here the tax factor will come, that you should keep in mind. Along with question, I will keep explaining the things. So one thing you remember, as a company, by transferring goods from one country to the other country, if it gives a benefit, as a company as a whole, you will accept it or else reject it. Okay. See, assume that division X, which is part of XYZ group, manufactures a single product A. So division X is into manufacturing of product A. Division X maximum capacity is 450,000 units a year. So what is the capacity? 450,000 is maximum capacity. Yes, sir. I will just try to write. Give me a second. Listen here. What is happening here? What is happening here? Listen. Division X, correct? Division X, they are doing what? Product A. They are doing product A. Yes, sir. So maximum capacity is how much, sir? Division X, maximum capacity is 450,000 units. Division X, maximum capacity is 450,000 units. Yes, sir. Now, it sells 420,000 units to external customers at a price of 75.95. So, give me a second. So, they are selling how much to the external customers? 420,000. External 420,000 units, which means, try to understand, there is a capacity of 30,000 which is idle, which means not used. Okay. At a price of 75.95 rupees, 75.95 is the price to the external customers. Done. Now, a contribution of 30.50. So how much contribution they are getting, sir? 30.5. They are getting a contribution of 30.5. Okay. 30.5 is the contribution. Done. Next, what they have given, sir? Division Y is also part of XYZ group, which means whatever happens between division X and Y will be considered as transfer pricing. So division Y is also part of XYZ group, but it is situated in a different place to division X. Okay. Division Y purchases 120,000. So division Y is there, no? They purchase how much? They purchase 120,000 units. 120,000 units of product A each year from a local company Z, which is not a part of group, which means some external supplier at a local currency which is equivalent to 65.33. They are purchasing at what rate, sir? 65.33. They are purchasing at 65.33. So 65.33. Done. Now, it has been suggested that in the interest of maximizing the group's profit, not the division profit, group's profit, division Y should purchase product A from division X. As there is no marketing cost is involved, when transferring goods to Y, division X would be set the transfer price of A at 69.6. So they are ready to send it at a transfer price of rupees 69.6 because they don't have marketing cost, it seems. So how much was the marketing cost, people? Marketing cost was earlier to outsider they are selling at 75. They are selling at 75.95. Now to the division Y they are ready to sell it at 69.6. which is rupees 6.35, which is rupees 6.35. So division Y it is sold at how much, sir? 6.35. Now, I mean 6.35 is the market cost which can be saved. Done. Now, this would be give division X the same contribution as external sale, that is 30.50. Okay. Division X would give division Y order priority and some external customer could be no longer be met, which means because your capacity retained is how much? I mean extra capacity is available is how much? Extra capacity available is people 30,000 units. But how much actual units will be required to be sent to division Y? 120,000, which means 90,000 units you should stop sending it to external customers and send it to this division. Now, sir, A, Y will do, sir. I mean, division X, Y will do that, sir. Because they are getting same contribution. You send it to the division Y or send it to the external customer, you are getting the same contribution. What you are going to lose? Nothing. So, that thing. Now, what else information they have given, sir? Should division Y continue to purchase from company Z, that is external customer, or switch to X in order to maximize the group profit? If A, the tax rate in the country of division X is 25%, tax rate of company of Y is 30%. So this is operating at 25%, this is operating at 30%. Now, B, the tax rate of division is 40%, this is 20%. One more situation is 40%, 20%. So in these two scenarios, whether it is better to buy from the outside or whether to buy it here to maximize the group's profit. So concentrate here very, 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 very carefully. Okay. What is it, sir? What is it? Try to understand. Now, division X point of view we'll see first. Division X point of view, we'll see first. Let's say division first is a Indian company. Division Y is a Japan company. Division X is Indian company. Division Y is Japan company. Now, Division X is selling for 20,000 units, which means extra 30,000 units is space is available. Now try to understand one thing. This 450,000, I am going to divide it into 3 parts or 2 parts. Okay, I am going to divide it into 2 parts. 420,000, 30,000. 420,000 and 30,000. Now try to understand. 420,000 is already we are selling. 30,000 is extra what we are going to sell if at all we accept a transfer pricing. Now try to understand how many units is required, sir? 120,000. In that 120,000, 30,000 will be satisfied in this one. Remaining 90,000, what you should do, sir, stop sending it to external customers and send it over here, which means earlier you used to send 420,000 to external customer. Now start sending only 330,000. Remaining 90,000 send it to division. So total you would be able to send 120,000 units to division Y. But one thing understand over here. One thing you understand. Whether that 90,000 what you are cancelling from external customer and giving it to division Y. Whether that 90,000 what you are cancelling from external customer sales and giving it to division Y, if you sell to your external customer also, you are going to make the contribution of 30.5. If you sell it to your division also, you are going to make 30.5. So moral of the story, whether you sell that 90,000 to external customer, you sell that to the division, it is not going to add any value or decrease any value. Because if you sell to external customer also, per unit 30.5 will earn. If you sell to your own division also, 30.5 will earn. So no benefit from that. So, but 30,000 is left idle, right? Now, anyhow from 420 you are making same profit, but 30,000 extra you are making sales. Earlier that sales was not there. Now it is there. So 30,000 incremental contribution will be how much, sir? Incremental contribution will be how much, sir? Incremental contribution, that is basically profit only, because fixed cost is ignored, because anyhow it is recovered. So incremental profit won't be on the 90,000 or 120,000 people, just 30,000, because out of 120,000, 90,000 we are not making anything extra, or we are not losing anything, right? So 30,000 into per unit we are able to make how much contribution? 30.5. Correct? Rupees 30.5. So extra contribution how much you are making, sir? 30,000 into 30.5, which will come to rupees 9,15,000. 9,15,000. Correct? Now 9,15,000 extra contribution you made. Let's say earlier you are making 1 crore rupees profit. Now, because of this extra sales, your profit will become 1 crore 9,15,000. Yes, sir. 9,15,000 extra profit you made. Yes, sir. Now try to understand. When you made 9,15,000 extra profit, auntie will sit quiet. Which auntie, sir? Nirmala auntie. Correct? Nirmala auntie will ask what? Listen, boss, you made a profit of 9,15,000. Yes, madam. We have made a profit of 9,15,000. Now, who will pay tax on it? Oh my God. Extra profit, extra tax. Now try to understand. She will ask you to pay the tax of 25% of your profit. Which means your net benefit is not 9,15,000. To division X, your net benefit is not 9,15,000. Instead, it will be just 75% of it, because 25% is going as a profit. Your net benefit is 9,15,000 into 75%. Rupees 6,86,250. 6,86,250. This will be added to the group's profit. Group's profit, this will be added. Also. Sir, but there it is cost now, sir. That also will do. Wait. Now this is from the point of view of X. Company X. Now, let's go to Y. Try to understand. Now, earlier, you were buying 120,000 units, no doubt. But at what rate you used to buy? In Japan, you used to buy it at 65.33. 65.33. So how much you used to spend? 1,20,000 into 65.33, which is rupees 78,39,600 you used to spend. Correct? 78,39,600 you used to spend. Now, if you buy it from the Indian company, then how much you will be spending on it? 69.6. Which means you will be spending 120,000 into 69.6, which is rupees 83,52,000. So extra how much you are spending, sir? 83,52,000 minus 78,39,600. Rupees 5,12,400 extra cost you are incurring as a division Y. 5,12,400 extra cost you are incurring as division Y. Yes, sir. But try to understand, more the expense, less the tax. Because more the expense, less the profit. Now try to understand, division wise profit will be reduced by 5,12,400. Division wise profit will be reduced by 5,12,400. At the same time, tax also will reduce, no? At the same time, tax also will reduce, which means you will get a tax benefit. Which means your profit will be reduced by 5,12,400. At the same time, you will get a tax benefit. So try to understand, your additional expenditure is not 5,12,400. No. What your Japanese finance minister will tell? No, don't pay us extra, because you are incurring a loss, extra loss. Earlier you were making profit of 1 crore. Now your profit is reduced from 1 crore to 94,87,600, something like that. So on that 5 lakh, you are saving a tax. So your net expense is not so much. So your Japanese, you are paying 30% tax now. That could be saved on this extra expenditure. So of this, 70% will be your net expense into 70%. That is 5,12,400 into 70%. Rupees 3,58,680. Now, as a group, try to understand. Your company X is getting your net benefit of 686,250. Company Y is losing around 3,58,680. Net. You are making profit or loss as a company. Your income will be increased by 686,250. Your expense will be increased by 358,680. As a company, you are able to make profit of 327,570 from this transaction. So it is better to go for transfer pricing. Done, sir. Now Second scenario with the different tax rates. Second scenario with the different tax rate. Try to understand. Again, division X, division Y. I'm not going to tell again how much extra they are making, how much extra these people are losing, because we calculated already. How much extra actually X is making? X is making extra 5,12,400. Sorry, 9,15,000. X is making extra 9,15,000. However, when you make extra, you have to pay anti-extra. How much you have to pay anti-extra, sir? In the second scenario, 40%, sir. Whatever we have made profit, in that 40% will go to anti, which means 60% will be left with the group. So how much it is? How much is the net amount left with you from company X point of view? It is 9,15,000 into 60%, which is rupees 5,49,000. 5,49,000. Division Y, sir. Division Y. You are spending extra 5,12,400. 5,12,400. Now you will ask Japan finance minister, tax rate is how much? How much? He will tell 20%. So you are going to incur not 100% expense, just 80%, because you are saving 20% in terms of tax. So 5,12,400 into 80%. So your expense is 4,09,920. So as a group, try to understand. Your income came to 549,000 after tax. Your expense after reducing the tax benefit, it is 409,920, which is rupees 139,080. Again the benefit. Again go for a transfer pricing. This is how the international transfer pricing works. So how sir? How to do it in simple way? Find out transferor department's additional contribution. From that you reduce tax on that additional. You will get income. To the group. Transferee department's additional expense you take. From that you reduce the tax benefit. Sir, both you are telling reduce. One is expense, one is income. So from one income will get reduced, from the other one expense will get reduced. Sir, but expense, how it will get reduced, sir? Because you are getting a tax benefit, which means earlier if you are paying, for example, earlier you had a 1 crore rupees profit. Okay, that time you are paying 30%, which is around 30 lakhs. Now because of the transfer pricing, extra you are losing 10 lakh, which means now you will be making just 90 lakhs on this 30%, which is 27 lakhs. Try to understand. Earlier you used to pay 30 lakh as a tax, now 27 lakh as a tax, which means tax you saved is 3 lakh. For the sake of you spending extra 10 lakh, you saved a tax of 3 lakh. So net can I tell you spent only 7 lakh? Yes, that's what we are doing. So we'll get a expense. Now we will compare income with expense. If the income is more than expense, net income is more than net expense, go for a transfer pricing. If the net income is less than net expense, don't go for a transfer pricing. Buy it from the local companies itself. This is all about the transfer pricing. Please go through all other questions. Okay. Now, what and all we have completed, sir, already? Chapter number 1 completed, 2 completed, 3 completed, 4 completed, 9 completed. Correct? And 5 is also completed, transfer pricing. Now, we completed 6 chapters, which means 4 more is remaining. In the 4 more, decision making chapter, only if time permits we are taking. Otherwise, you have to do it on your own, because nothing is there in that. That is nothing but mixture of all these chapters, right? So you're going to do it on your own. If at all time permits, I'm going to take. Otherwise, no. So now we left with 6th, 7th, 8th. 3 chapter. Very, very, very important chapters. Okay. Yes. We'll continue. next chapter. Yes. Now we will be starting with next chapter revision, that is standard costing and variance analysis. This is one of the favorite chapter of any CS, CMA student. Yes. So we are going to start with that. Many people will skip it. I don't know why. One of the easiest chapter actually. You should never skip this because it carries good weightage also. No? So, okay sir, is it easy? Yes, it is easy. Then people tell it's difficult. Yeah, exactly. They tell it, not you. So you can do, yes sir. So, is it important also sir? Yes, it's going to carry 10 to 15 marks. So it's going to be an important one. Okay. And one of the easiest one also, don't worry, don't skip. Okay. Because it's going to play a major role in your paper. So always remember. Okay sir. No worries. Let's see. What is standard costing then? Standard costing. See, before understanding what is standard costing, first we have to understand what is standard cost. Standard cost is nothing but people, predetermined cost. Predetermined cost. That is, before incurring only we assumed some cost. No, that cost itself is nothing but a standard cost. Okay sir. So what is standard costing sir? Is it a method of costing? The answer is no. It is a technique of costing. It is technique of costing. Technique for what sir? Technique for cost control. Technique for cost control. How it is going to work sir? Very simple. We'll compare our standards, that is predetermined things, with the actuals. Okay. So we'll try to find out whether any variation is there or variance is there. If it is there, why it is happening? Whether it is a good variance or bad variance. Right? Whether it's a good variance or bad variance, and why it is happening, how to rectify it. Finish. That's all about the technique of standard costing. Okay. So how it is going to work sir? Try to understand. Now let's say we estimated our profit to be 20 lakhs. We estimated our profit to be 20 lakhs, but our actual profit is just 18 lakhs. Our actual profit is 18 lakh, which means 2 lakh rupees is a decrease in the profit. 2 lakh is the decrease in the profit. Sir, decrease in the profit, is it positive or negative to the organization, or in simple, is it favorable to the organization or is it adverse to the organization? It is unfavorable. It is adverse because your expected profit is more than what is actual. So it has given you adverse effect. So now we will find out what is the reason for this. What is the reason for this? There could be two reasons. One, variation in the revenue, or you can tell it as sales. The other one is variation in the cost. The other one is variation in the cost. So one, there could be a variation in the sales, or there could be a variation in the cost. So now again the cost we are going to split into three parts. Cost variation also, there could be different variations. What are those sir? One is material cost, labor cost, other expense, which is basically we will call it as overheads. Okay, overheads further we are going to divide between variable overhead, fixed overhead. That is, let's say we expected our sales to be 50 lakhs. We expected our sales to be 50 lakh. Now the sale is 50 lakh only. So whatever the variation for the profit, sales wise we are expecting, or we are getting whatever we expected, but cost wise we might have incurred more. Okay sir, which cost you incurred more? You might have incurred material cost more, or you might have incurred a labor cost more, or you have incurred a overhead more than estimated. Estimation is nothing but standards. Correct? Overhead sir, whether variable overhead or fixed overhead, both or any one of that possible. Yes. So these analysis we will do. These variations we will find out. Due to sales, how much is the variation? Due to cost, how much is the variation? In the cost, due to material, how much is the variation? Due to labor, how much is the variation? Due to variable overhead, how much is the variation? Due to fixed overhead, how much is the variation? That's all we are going to do in this particular chapter. Okay. Now first we'll take costs. In the cost, first we will take material cost. Material cost variation or material cost variance, MCV. Material cost variance. Okay, sir. What is material cost variance, sir? Try to understand, people. Try to understand what is material cost variance, sir. Cost of material, what we expected. Cost of material, what we expected, that is more or less than actual. Expected is more or less than actual. This expected, people, this expected, when we compare it with the actual output, see, expected, we expected it for the budgeted output. We expected it for the budgeted output, but when you convert this expected into the actual output, because when you are comparing, you can't compare. For example, there is 100 marks paper, there is 50 marks paper. There is 100 marks paper, there is 50 marks paper. Your friend got, let's say, 44 marks in 100 marks paper. Or let's say your friend got 44 marks in 50 marks paper. Your friend got 44 marks in 50 marks paper. You got 46 marks in 100 marks paper. You got how much? 46 marks in 100 marks paper. Now you can't go and tell your parents that you scored 2 marks more than your friend. Your friend is scoring 44 in 50 marks paper. You are scoring 46 in 100 marks paper. Now, can you just compare these two? Does that make any sense? You can't tell your friend, Macha, I got more marks than you. Then he will tell or she will tell. Of course, if you are thinking you got more marks than me, you are thinking correct. Your mark shows about your thinking capacity. Correct? So try to understand. You can't just compare some random figures here. So try to understand your actual expense. You are incurring for actual output. Your actual expenses you are incurring for actual output. Then you can't compare that actual expenses with the budgeted expense. You are going to convert your predetermined rates or predetermined cost, which is predetermined for budgeted output, to the actual output. So when you convert budgeted cost as it was estimated for the budgeted output to the actual output, then that cost we call it as a standard cost. So always remember, people, standard cost is not about dealing budgeted data with actual data. Instead, first step involved is converting a budgeted into a standards. How to convert it, sir? Budgeted will be for budgeted output. For the actual outputs, how much? That will be your standard. Comparing that with the actuals will give you variance analysis. So always remember one thing. You are not going to compare budgets with the actuals. You are going to compare standards with the actuals. So what is the difference between standards and budgeted, sir? Budgeted data will be in relation to budgeted output, whereas standard data is budgeted figures converted into standards using the actual output instead of budgeted output. So that point you have to keep in mind always. Okay. Yes. Now we'll start with material cost variance. Listen. Material cost variance. Sir, what is it, sir? Basically, how much material cost we expected and how much is actually incurred. Difference between that is a cost variance. Okay. Now, cost, no, it is. Yes, sir. So, cost, what you estimated is more than what actually is. I mean, you incurred less than what you estimated. Favorable or adverse? Of course, favorable. Because you thought your cost will be 10 crore, but you incurred only 9 crore. So, of course, it is favorable. We thought 10 crore, sir, we incurred 12 crore. Not good, because more the cost, less the profit. So, it is adverse. So now what is it, sir? Before exactly like telling you all the formula and all, let me take you through an example. Okay. Let's say we are in a restaurant business. We are in a restaurant business. During the period, we thought that we are going to sell 10,000 plates of biryani. Let's say our biryani is the best one. Okay. Our biryani is the best one. During the period, we thought we are going to sell 10,000 plates of biryani. Okay, sir. Done. Now, what you did, sir? Before selling 10,000 plates, we should know exactly what and all the materials are there. Let's say only two major materials will take. We'll take a rice, we'll take chicken. Let's say to prepare 10,000 plates of biryani, we need 5,000 kgs of rice. We need 5,000 kgs of rice and 4,000 kgs of chicken. We need 5,000 kgs of rice and 4,000 kgs of chicken. Okay, sir. In actual, we were able to produce and sell 8,000 plates. In actual, we were able to produce and sell or prepare and sell 8,000 plates, where rice used by us is 4,200 kgs, and the chicken used by us is let's say 3,000 kgs. Done, sir. Okay. Now try to understand, people. This 8,000 plates, whatever the information is there, everything is actual. 10,000 is there, no, sir? Wait, sir, we will only tell. 10,000 is there, no? That is standard. The answer is no. 10,000 is budgeted. Because actually we were able to sell only 8,000 plates of biryani. Now try to understand whatever the material cost we are comparing. We should compare the cost, budgeted cost of 8,000 plates of biryani with the actual cost of 8,000 plates of biryani. Correct? Yes, sir. And we estimated rice to be around 50 rupees per kg, chicken to be around 200 per kg. Rice to be 50 rupees per kg, chicken to be 200 per kg. Actually, we spent 55 rupees per kg of rice, 55 rupees per kg of rice, and rupees 190 per kg of chicken. Rupees 190 per kg of chicken. Now try to understand how it's going to work. Yes. So, sir, you told that we have to compare standards and actuals. So, shall we write few datas in a table format? Yes, sir. First, we'll write about standards. Let's write about standard quantity. Try to understand. Standard quantity is what, sir? Rice and chicken, 5 and 4. thousands? The answer is no. Why? Because 5 and 4,000 are when the output expected was 10,000. Now output is just 8,000. So we are going to convert the 10,000 data into 8,000 data. That is when 10,000 it was 5,000, when 8,000 it is question mark, that is 5,000 divided by 10,000, 0.5 into 8,000, which is 4,000. So standard quantity of rice is 4,000 for actual output. Okay, done. Chicken, sir. Chicken, it was 4,000 for 10,000, for 8,000 question mark. That is 0.4 into 8,000, which will come to 3,200. 3,200 kgs. Okay, sir. Standard price is what, sir? Standard price is 50 and 200. Standard price is rupees 50, rupees 200. Actual quantity for actual output is 4,200 kgs and 3,000 kgs. Okay. Actual price is how much, sir? Actual price is 55 and 190. Correct? Rupees 55 and rupees 190. Done. Now, sir. Now, first ascertain the variance, cost variance. What is the cost variance? Try to understand. We were expecting our rice cost to be, in total, we are expecting our rice cost to be 4,000 into 50. But actually, we incurred 4,200 into rupees 55. Yes, sir. We are expecting chicken cost to be 3,200 into 20. But actually, we incurred, 3,200 into 200. But actually, we incurred 3,000 into rupees 190. Now, what is it, sir? That is nothing but 4,000 into 50. Give me a second. Yes. 4,000 into 50, which will come to 2 lakh, minus 4,200 into 55. 2,31,000, which means 31,000 extra we are incurring compared to standards. Favorable or adverse, sir? Adverse. Favorable or adverse, sir? Adverse. Done. Chicken, sir. We thought we are going to use 3,200 kgs at the rate of 200, which is 640,000. But actually we have used only 3,000 kgs for 190, which is 5,70,000. 5,70,000. So difference is, people, around 70,000. Try to understand, in this scenario, what we assumed is more than what we incurred, or in simple you can tell what we incurred is less than what we kept as a standard, which means favorable situation. Net you can tell from two materials around 39,000 rupees favorable situation. That is, whatever you expected your cost to be, actually we incurred less than that. So how did you arrive at a material cost variance, sir? How did you arrive at a material cost variance? 4,000, 3,200. What was that? Nothing but a standard quantity. Okay. What was 50 and 200, sir? Standard rate or standard price minus. What was 4,200 and 3,000, sir? Actual quantity. And what is 55 and 190? Actual price. This is the formula for your material cost variance. No need to by heart formula. All you have to understand is what the formula is all about. Very simple. Cost variance is overall comparison. So we did it. Okay. Now 39,000 we are incurring less than what we expected. Net 39,000 we are incurring less than what we expected. Okay, sir. Now what is the reason? Sir, we used less than what we expected. Production manager will tell, sir, we used less than what we expected. That is the reason. So give promotion to me. Purchase manager will tell, Sir, we bought at a rate less than what we expected. You asked me to get it at 200 rupees, sir. I got it at just 190. Give me the promotion. Now the question comes, for this variance, how much the production manager is responsible, how much purchase manager is responsible, correct? So what we are going to do, sir, this cost variance, we are going to divide it into two parts. One is price variance, one is usage variance. One is price variance, one is usage variance. Is it, sir? Try to understand. First one is material price variance. What is material price variance, sir? How much is the variance due to change in price? That is, change in what we estimated and what we actually paid. What is the difference, or how much is the difference? How to ascertain that, sir? Very simple. We'll call purchase manager and we'll tell. Boss, listen. Your work is one simple task. Remember carefully and listen here very carefully. Remember this. Purchase manager task is very simple thing. Go bring us the material how much ever we ask. Don't tell standard is so much, etc., etc. Your thing is very simple. Go and bring a material of the quantity how much ever we tell at the rate which we kept as a standard. So try to understand. Purchase manager work is buying the material how much ever is required. He is least bothered about using extra, using less. His work is pretty simple. We call him and we tell him, so much quantity of this one, you get it, boss. Our chef call and tell the purchase manager, boss, go buy this kg of rice, this kg of chicken. You can't ask the chef, you are using more than standard. No, that is left to chef. Your work is getting it at a price what we told. So try to understand. First, in first scenario, what we told him, boss, go and get a 4200 kg of chicken. Why 4200, sir? That is what we are using now. So we asked him to buy 4200 kg of chicken. At what rate, sir? We asked him to buy at 50 rupees. But he is buying at what rate, sir? He is buying at 55, which means he is paying extra. If he is paying extra, then favorable or adverse, sir? Adverse. Favorable or adverse? Adverse. How much, sir? 21,000 if I am not wrong. 4,200 into 5. 21,000. Rupees 21,000, but it is adverse because for the rice he is paying extra. Chicken, sir, our chef called and asked him to get 3,000 kgs of chicken. At what rate, sir? At the rate of 200, because 200 is the set standard. But he is getting chicken at just 190, which means he is saving us 10 rupees per kg. So 30,000 into 3,000 into 10 is nothing but rupees 30,000. Favorable or adverse, sir? We are saving our cost than expected. So it is favorable. Yes, sir. Done. Now 9,000 is a favorable. We tell our purchase manager, boss, good job, well done. Out of 39,000 favorable thing, yours contribution is 9,000 favorable. So how we arrived at this, sir? Actual quantity, that is 4,200 and 3,000, because he has to buy us whatever we ask him to buy. 50 and 200 is what, sir? 50 and 200 is standard price, and 55 and 190 is actual price. Will give you material price variance. Okay, sir. Done. Next. Okay, sir. So remaining thing is production managers now. we'll check. That is remaining thing is because you are using more or less. You are using, that is material usage variance. Okay. Rice, sir, and chicken. Rice, you are supposed to use how much, sir? 4000 kgs. You are supposed to use 4000 kgs, but you are using how much, sir? 4200 kgs. You are supposed to use 4000 kgs, but you are using 4200 kgs. Okay. Chicken, you are supposed to use 3200 kg. You are supposed to use 3200 kg, but you are using just 3000 kgs. Now, with what price we should multiply this, sir? Try to understand. Now, if you tell our production manager, boss, multiply it with the actual price, what he will tell? Sir, listen. You told me you are going to get me a materials at the standard price. Correct? Yes. Now, if you are paying more, who is responsible, sir? Am I anyhow related to that? No. Because paying more is not my problem, sir. Your purchase manager's problem. I am least bothered about it. My duty was what? You told that you are going to send rice of value rupees 50 and chicken of value rupees 200. I am least bothered actually how much you spent, because that is your purchase manager's responsibility. So try to understand the price which we are going to take is not the actual one, because it is the responsibility of the purchase manager. For the production manager would have told in the beginning, boss, we are going to send you a rice at 50 rupees, chicken at 200. Your work is to make sure you are going to use just 4000 unit, but you are using 4200 unit, correct? So 200 units into 50, around 10,000 rupees is adverse. 10,000 rupees is your adverse, because you are using more. When compared to next one, 200 kg you are using less, per kg it is 200, which will come to rupees 40,000, which will come to your rupees 40,000, but favorable because you are using less. Net I can tell 30,000 is favorable. Net I can tell 30,000 is favorable. So try to understand, people. Cost variance is nothing but total of price variance and usage variance. Total of price variance and usage variance. So can we write the formula, sir? Yes. 4000 kgs and 3200 kgs was what, sir? Standard quantity. 4200 and 3000 is what, sir? Actual quantity. Okay. So 50 and 200 is what, sir? Standard price. Will give you material usage variance. Material usage variance. Hope it is clear. Yes, sir, clear. Now, sir, now try to understand. Now we are going to give an award to our usage manager, because he is making sure that 30,000 rupees is saving than what we thought. Correct? Whereas purchase manager also saved only 9,000. So promotion will be for production manager. But purchase manager will run coming. What he tells? Sir, listen. Yes, sir, tell. He is using 3000 kg of chicken, no? Yes. Where you asked him to use 3200 kg, no? Yes. 200 kg is saving, correct? Yes. You know why, sir? Don't know why? Because the quality of chicken what I bought is awesome. The quality of chicken what I bought was awesome. Because of that, instead of using 3200 kg, if we just used 3000 kg also, you would have got the same taste. That's the reason he is using 3000 kg. Not that because of his capacity or his ability or his skills. We are like, is it? Yes, sir, it is. Okay. Sir, what about rice, sir? What about rice? You will tell, I don't know about rice. He is using extra. Whatever rice I bought now, that is of good quality. Now, don't you think this could be one reason? This also could be one reason for using more or less. For using more or less, this could be also one reason. That is the quality of the product what we bought. Yes, sir. So what we are going to do, sir, we are going to further divide this material usage variance. We are going to further divide this material usage variance into material yield variance, material mix variance. We are going to divide it into material yield variance, material mix variance. Whereas material yield variance means due to the quality of the product, whether you are using extra or you are using less, that will be due to quality of the product. That portion will be treated as a material yield variance. It is giving more yield than expected or less yield than expected. Okay. Remaining is, instead of using rice, you might have used more chicken. Instead of using more chicken, you might have used more rice. Because of that also variance could be there. We asked you to use how much, sir? In a standard, we asked you to use 5000 kg and 4000 kg, which is in the ratio of 5:4. So, actually you are using how much, sir? 4200 and 3000. You are not using it in a ratio. So, this could also be reason. So, what we should do, sir? Very simple, people. Our manager, purchase manager will tell, no, because of the quality it is. So, we'll call him. Okay, sir. According to you, your product quality is good. Correct? Yes, sir. So, we'll do one thing. We are going to revise our standard. According to you, just because you got good products, we are using less, no? Fine. We will change our standards only. How we are going to change, sir? Actual terms, how much we have utilized, sir? 7200 kgs. Okay. Let's say our new standard will be 7200 kgs only. Whereas standard earlier, how much we thought we are going to use? 7200 kgs. Again, total we are using same only. So what we will do, sir? Now this actual quantity we are going to split in the standard quantity ratio, which will be known as revised standard quantity. Our actual quantity we are going to split into standard in the standard ratio, which is known as revised standard quantity. So what we will do, sir? 7200, that is total of average, into ratio of rice and chicken, that is into 4000 divided by 3200, that is 7200, sorry, divided by 7200. Okay, 7200 into 4000 divided by 7200, which will come to 4000. So rice new standard is 4000 kgs. Okay. Chicken, sir. Chicken will be 7200 total into earlier standard ratio was 3200 to 7200, which is 3200. Here total of actual quantity, total of standard quantity is matching in this example. Just a coincidence. In all the question, there is no necessity the total actual quantity and total standard quantity should match. Clear? Done. Now what we will do, sir? This we are going to divide it into, as I already told, material yield variance and material mix variance. Material yield variance is due to what, sir? Quality of the product. Either the good quality or bad quality. If the bad quality, you will consume products more than expected. If it's a good quality, you are going to consume more than. If it's a good quality, you are going to consume less than estimated. So what we will do, sir? We tell him we tell him, listen boss, rice and chicken, correct? Yes sir, rice and chicken. Rice according to us, if it's due to quality, if it's due to only quality, you must have used 4000. Earlier how much you plan to use? Earlier you plan to use 4000 kgs. Yes sir. Now how much you are changing it into 4000? So earlier you plan to use 4000 kgs. Now also your new standard is also 4000 kgs only. Done. Chicken sir, earlier you plan to use 3200, now also 3200. Planning, only planning I am talking, not actual. 3200 kgs. Done. Rate will be, of course, for the material usage we took standard price. Here also we are going to take the standard price itself, which is 0, 0, 0. So try to understand. Due to the quality of the product, nothing has changed. Which means due to the quality of product, no benefit at all. Because as per your theory of good product, we changed actual in the standard ratio. No? Then we thought our standard should be 4000. Actually, it is 4000 only. We thought new standard to be 3200. Standard also 3200 only. So whatever is happening, it is happening only relating to mix variance. That is, instead of using chicken, you are using rice. Instead of using rice more, you are using chicken more. Either you are using one more, one less. That is the while mixing you are just messing up with the quantity of mix. So we tell our production manager, boss, listen, first we'll take rice, then we'll take chicken. Rice, as per our new standard was supposed to be 4000 kgs, no? Yes sir. But actually how much we have used, sir? 4200 kgs. Rate will be, of course, standard rupees 50. Chicken sir, actually as per our new standard you must have used 3200, no sir? Yes sir, 3200. But actually how much you have used, sir? We have used 3000 kgs, which means rupees 200. Now try to understand. Instead of using 200 kgs rice less, you use 200 kg rice more. Instead of using 200 kg chicken more, you are using 200 kg rice more. Which means instead of chicken, you took out bit of chicken, you added more rice. Sir, wrong, no sir. Adverse, no. The answer is no. Try to understand. Rice price is 50 rupees. Chicken price is 200 rupees. So you are using high quality, high priced product less, high priced material less, low price material more, which means it is favorable. So always remember, your new standards are more than the actual quantity, then adverse. If your new standards are less than actual quantity, it is favorable. Sir, what about yield, sir? Yield formula you didn't write. Material yield variance is 4000 and 2000, that is nothing but revised standard quantity. 4000 and 3200 is nothing but standard quantity. This is what, sir? This is your standard price. Now if at all your new standard is more than the old standard, adverse. If the new standard is less than the old standard, favorable. Going here, what was this, sir? This was 3,200 and 4,000, which is nothing but revised standard quantity again. 4,200 and 3,000 actual quantity, correct? 50 and 200 is standard price. Standard price. This is material mix variance. That is, if at all we used actual more than our new standard, adverse. If at all we used actual less than our new standard, favorable. This is all about the material variance. So quickly I will write down all the formulas together. Try to understand. Material cost variance is the major one, correct? Material cost variance. Material cost variance. How you are going to derive, sir? You are going to multiply standard quantity with the standard price and actual quantity with the actual price. Difference will be material cost variance. Okay. It could be due to two reasons. One, you are buying the product at less price or more price, or you might be using product at a product more or less. Anything it could be, depends on that. Favorable, adverse is going to change, and also both at the same time is possible, sir. Yes, it could be possible. It could be possible. So I am going to divide it into material price variance, material usage variance. Price variance is what, sir? Here purchase manager is responsible to buy whatever we tell at a standard price, but he might buy it at a actual price, and whatever we ask, whatever we actually consume, that one. But in usage, what it is, sir? In usage it is, we asked him to use some quantity, but they might have used a different quantity, but we promised them we are going to get it at a estimated price itself. So it will be SQ minus AQ into SP. Now usage variance further could be divided into two parts: material yield variance, material mix variance. Material yield is also known as sub-usage. Okay, material yield is also known as sub-usage. So yield variance could be our new standard compared with the old standard. Okay, whereas mix variance is new standard compared with the actual one, correct? So this is your yield variance and mix variance. Always remember, yield variance and mix variance is possible only and only when there are more than one raw material. When there are more than one raw material, then only you will be having the material mix and material yield variance, otherwise no. With that, we have completed the material cost variance. Then we have three more cost variances left: labor cost variance, variable overhead, fixed overhead, and sales variance, correct? Four variances are left. We'll see that later. We'll go to questions. We'll try to solve all the ICMA questions. Okay, at least look after all the ICMA questions. Before that, we'll go through all the standards first. I mean all the different cost and sales first. Then we'll try to solve the questions together. Yeah. Now we'll start our discussion in one more important element of cost, that is labor cost. Because after material, this will be the one more major expense to any industry, correct? That is labor cost. So here we are going to find what variance it is. That is, what are the different variances under labor cost. Here also simple people, same logic like a material only. We can't take the budgeted figures. Budgeted will be bought into standards of actual. Then actual will be compared with the standard. Then we are going to find a variance. Correct? So try to understand. But in labor, there is one more thing called as idle time. If you know idle time, what is idle time? Idle time is nothing but, sir, you paid for that hour, but your employees are not working. They are doing jolly, ella jolly. Okay, they are having fun now. or due to some abnormal reasons, whatever it is, basically some abnormal idle time will be there, correct? So in that they won't be working. That thing is there. Okay, let me take quick example. Okay, that is, let's say there are two kind of labor A, labor B. Labor A, labor B. Standard hours per unit. Let's say labor A need for 1 hour, labor B need 2 hours. That is, to produce 1 unit of product, we need 1 hour of labor A, 2 hour of labor B. Coming to the standard rate, we are planning to pay rupees 20 per hour for a labor A, rupees 15 per hour for a labor B. Yes, sir. Actual hours paid. Actual hours paid is how much, sir? Actual hours paid is labor A, we are paying 10,000 hours. Labor B, we are paying around 21,000 hours. Labor A, we are paying 10,000 hours. Labor B, we are paying 21,000 hours. Idle time, that is paid for it, but they are not working. Paid for it, that they are not working. Idle time is 200 hours and 500 hours. 200 hours and 500 hours. Actual hours worked is how much then, sir? Actual hours worked would be 9,800. 20,500 hours. Actual rate would be rupees 21 per hour and rupees 16 per hour. Rupees 21 per hour and rupees 16 per hour. Okay, sir. Done. Now, how to compute a labor cost variance? First, we are going to find out labor cost variance. Labor cost variance, people, we estimated two things are there, two labors are there. Labor A is there, labor B is there. Correct? Correct? Let's say units produced is 9,000. Units produced is 9,000. So for 1 unit standard labor hour is 1 hour. For 9,000 actual output, how much is the standard labor hour of A, sir? 9,000 hours. Okay. And we plan to pay them at the rate of rupees 20. Great. Labor B, sir. For 1 unit you need 2 hours of labor B. So for 9,000 units, how much you need, sir? 18,000 hours you need. And we are planning to pay them at the rate of rupees 15. Okay. This will be compared with actually how much we are paying in reality. Actually we are paying 10,000 hours of A at the rate of rupees 21. Okay. 21,000 hours of B at the rate of rupees 16. Okay. So first scenario, sir. First scenario, you are paying rupees 30,000 extra. First scenario, you are paying rupees 30,000 extra, which is adverse, because your standard was supposed to be 1,80,000. Your actual is 2,10,000. Difference is 30,000 adverse. You are paying extra. Coming to B, rupees 66,000 adverse. Okay. Together you can tell your whole cost is adverse by 96,000. That is, boss, whatever you have planned, no, total cost of labor is more by 96,000 compared to standard. So what formula you applied, sir? 9,000 and 18,000 is nothing but a standard hours. 20 and 15 was a standard rate. Okay. 10,000 and 21,000 was actual hours paid, not worked. Okay. Actual hours paid. And 21 and 16 is what, sir? 21 and 16 is actual rate. You will get labor cost variance. Okay. Now, for this variance, there are three reasons. One, You are paying extra. You thought you are going to pay 20 rupees, but you paid 21 rupees. You plan to pay 15 rupees, you are paying 16 rupees. One is that reason. Two, you planned to use just 9,000 hours, but you are paying them 10,000 hours. You planned that you are going to pay for 18,000 hours, you are paying them 21,000 hours. Two. And also in the 10,000, 21,000 directly we can't write, because in the 10,000, 200 hours is towards idle time. In the 21,000, 500 hours is towards idle time. So that we are going to split. One is due to rate, one is due to efficiency, one is due to idle time. First we'll go for a rate. Just like material cost variance only, labor rate variance. Boss, what we told you? We asked you to get how much ever the labor we want. That is actual hours paid at the rate of standard rate, but you are getting it at a actual rate. This is your labor rate variance. That is actual hours paid into standard rate minus actual rate. Okay. This is your rate variance. Two more variance in that. One is idle time variance. That is what, sir? Idle time. Yes. Idle time, how to compute? Actual hours paid minus actual hours worked into standard rate. Always remember, this is always and always adverse. This is always and always adverse. Always remember this point. Idle time means wastage only, no? Wastage, how can it be favorable? So best from waste we will do. You do, but still it's wastage only. Correct? So idle time variance is wastage only. Done. Next is labor efficiency variance. That is, you are using more labor. So just like material usage variance, that is standard rate. Okay, sir. You are comparing standard hours with the actual hours worked, because the 200 and extra whatever idle time was there, that we have already addressed. Whatever extra idle time was there, that we have already addressed. We don't have to address it again. We have to address remaining portion. That is how many hours is actually worked. With that, efficiency will come. Now this also could be further divided into mix and yield. Because labor A, you are paying 20 rupees. Labor B, you are paying 15 rupees. Now, if at all you are changing your mixer, labor A you are using more than labor B than the standard, then automatically people, your cost will be adverse, because you are paying the costliest labor more than expected. If at all you are using labor B more than expected, then labor A you are using less, labor B you are using more, which means you are using less costliest labor more, less costliest labor. You are using costliest labor less than less costliest labor, which means it is favorable. So what we are going to do, this efficiency could be further divided into two: mix variance and yield variance. Yield variance is what, sir? We asked you to get the labor who produces 10 product per hour. Either you will get a labor who produces just 9 product or 11 product, which means yield itself is not good, or yield is very good. If it's very good, favorable. If it's not good, adverse. So formula is standard rate into standard hour minus revised standard hour. Standard hour minus revised standard hour. When it comes to labor mix variance, people, standard rate is, you are going to compare revised standard hours with the actual hours paid or worked, sir. It is worked, because paid is sorted out already in the idle time. This is all about your labor variance. When we see our few questions, you will get an idea about it. Now, if you want me to write quickly the formulas, labor cost variance is nothing but standard rate into standard hours minus actual rate into actual hours paid. Correct? This could be further divided into 3. If the idle time information is there, 3, otherwise only 2. Okay. So 3, which and all, sir? One is labor rate variance, labor efficiency variance, labor idle time variance. Labor rate variance, sir, standard rate minus actual rate into actual hours paid. How much ever we ask, you have to give it. Going to idle time variance, idle time is nothing but actual hours paid, yes sir, minus actual hours worked, yes sir, into standard rate, that is labor idle time variance. Labor efficiency variance is people, labor efficiency variance is your standard hours allowed and how much hours you actually worked, right, into standard rate. If you work more than required, then of course we are paying more, which means adverse. Okay, done. This could be further divided into 2. There is labor yield variance, labor mix variance. Yield variance is what, sir? Yield variance is standard hours you are comparing with the revised standard hours. If the revised standard hours is more than standard hours, adverse. If the revised standard hour is less than standard hours, favorable. So it is standard rate. Here it is revised standard hour minus actual hours worked, okay, into standard rate. With that, labor is done, not done. Hope it is clear. I mean, once we do a sum, you will get an idea of that in a much more better way. This is your labor variance and material variance. This many of you guys won't be having any doubt, etc., etc. Next comes the best one, that is overhead variance. Okay, that we'll discuss now. Overhead variance is very nice and usually question you can expect from overhead variance, and one of the easiest one if you understand a concept. On that we'll spend a much more time. Okay, yes. Now we'll start with overhead variance, right? Overhead variance or overhead cost variance. Sir, what do you mean by overhead cost variance? People try to understand. Overhead cost variance is nothing but how much we estimated, based on that we will absorb. So basically overhead cost variance was actually how much we incurred, how much we absorbed. Try to understand. Overhead cost variance is nothing but how much actually we are incurring, how much actually we are paying, minus how much is what we recovered, what we absorbed. Recovered means how much we charge to our product so that we can recover from our customers. So how much we actually incurred, how much we recovered, difference is nothing but overhead cost variance. Sir, what we incurred, what we absorbed, difference is under recovery or over recovery? No sir, the answer is yes. So overhead cost variance is nothing but under recovery or over recovery, or under absorption or over absorption. So always remember, overhead cost variance is nothing but under recovery or over recovery, or under absorption or over absorption. Okay, if it's under absorption means what, sir? You incurred more, but you recovered from the final product less, which means adverse. Over absorption means what, sir? You incurred less, but you recovered from the product more, which means it is good to you, know, that is favorable. So always remember, under recovery is adverse, over recovery is favorable. Okay, now how does this what is it, sir? It is nothing but recovered amount, recovered or absorbed overhead minus actual overhead. Actual overhead is what we incurred, that they will give in the question, but how to compute this recovered or absorbed overhead, sir? How to compute this recovered or absorbed overhead? Remember people, it could be done on the unit basis or it could be done on a hourly basis. Okay, it could be done on a unit basis, it could be done on a hourly basis. One thing is very simple. Always remember, we are going to recover our overhead on the recovery rate. We are going to recover our overhead on the recovery rate basis. So recovery rate per unit, or if it's a hourly basis, recovery rate per hour. Okay, unit basis people, we are going to recover it from the actual production. So I can tell it as recovery rate per unit into actual output. Actual output will give you recovered overhead. That is recovery rate or absorption rate into actual output will give you recovery. Sir, what do you mean by recovery rate, sir? Recovery rate is nothing but people, what we decide on the first day of the year or before beginning of the year, we will decide no, how much we will be recovering this year as a overheads, which means that is based on the budgeted data. So we'll take budgeted overhead divided by budgeted output. We'll take budgeted overhead divided by budgeted output. In case of hourly basis, it is budgeted overhead divided by budgeted hours. Recovery rate will be completely computed on budgeted data. Okay, sir. Okay. But when it comes to hourly basis, sir, recovery rate will be absorbed on hour. What hours, sir? Actual hours, budgeted hours, standard hours. Not actual hours, not budgeted hours, but standard hour for actual production or actual output. We are going to recover it from the standard hours or actual output. This is your overhead. Overall overview of your overhead cost variance. And overhead, I told you it could be two, correct? It could be two. One is variable overhead, the other one is fixed overhead. One is variable overhead, the other one is fixed overhead. What do you mean by variable overhead and fixed overhead, sir? Variable overhead varies with production, whereas fixed overhead don't vary with the production. Variable overhead varies with the production, fixed overhead don't vary with the production. So moral of the story is, variable overhead is having a similar nature like a labor cost variance. Try to understand. Labor cost also, you produce more cost, produce less cost. Same way, variable overhead also, you produce more cost, produce less cost. So quickly we'll look into overhead, variable overhead variance. Variable overhead variance, people, first, it is nothing but just like a labor cost only, but in the labor cost idle time variance was there, no? That won't be there here, because it's not something like you are paying for it and you are not getting the work done. That is not possible at all in the variable overhead. One thing. Second thing, mix and yield variance won't be there. Basically two variance. There you did no labor rate variance. Like that we will do rate variance here. There you did no efficiency variance. Like that we are going to do efficiency. Rate variance is also known as expenditure variance. Okay. First, variable overhead cost variance. Variable overhead cost variance. I told you that is nothing but a difference between absorbed overhead and actual overhead. Absorbed overhead and actual overhead. Absorbed overhead, how to compute, sir? In a unit basis, it is actual output into recovery rate. In a hour basis, it is standard hour for actual production into recovery rate minus actual overhead minus actual overhead. Okay. Now, for this, reason could be two. That is, one, either you are paying more. That is, you thought variable overhead could be 10 rupees per hour. You might be paying more than 10 rupees or less than 10 rupees. One. Two, you thought you are going to produce few more units, but you are able to produce only less number of units. That is also possible. So variable cost variance could be divided into expenditure variance efficiency variance. Expenditure variance, efficiency variance. Expenditure variance is nothing but your labor rate variance formula only. That is standard rate what you decided and difference is actual rate. Standard rate what you decided and actual rate into actual hours. Actual hours. Whereas your efficiency ratio is nothing but based on the hours you are working. Based on the hours you are working. You thought standard hours will be used, but you are actually using actual hours, and rate will be standard rate. Rate will be standard rate. This is your variable overhead. This is your variable overhead. Now we are going to start discussing king of all the cost variance, or one of the tricky part of all the cost variance, that is fixed overhead cost variance. Fixed overhead cost variance. First you should understand the nature of fixed overhead here. Fixed overhead won't vary along with the production. Fixed overhead won't vary along with the production. That point you should keep in mind. That point you should keep in mind. Let's take a simple example. Later I will explain you guys with the numbers, then you can remember the formulas. Okay, simple it is, not that difficult also. Try to understand, easily scoreable. Try to understand. We'll take one data here. I will take the budgeted data. I will take the actual data. I will take the budgeted data. I will take the actual data. Direct labor hours. Direct labor hours. Budgeted, we thought around 12,000 hours we are going to use. But actual terms, we used 11,136 hours. We thought around 12,000 units we will use, but budgeted we use just 11,100 and 11,136 hours. Unit wise, let's say we thought we are going to produce around 12,000 units. Okay, we thought we are going to produce around 12,000 units, but we were able to produce just, let's say, around 11,000 units. You can tell this way. Yes, sir. You are able to produce 11,000 units. Try to understand one thing. You produce 12,000 units, you produce 11,000 units, you produce 1,000 units, you produce 1 unit, you produce 20,000 units. Fixed overhead is not going to change. Fixed overhead is not going to change. So, coming to the fixed overhead, we thought our fixed overhead could be around rupees 8 lakhs. Budgeted what, sir? 8 lakhs. But actually we incurred 8,50,000. Okay. One thing is simple here, people. Recovery rate will be computed. On the basis of recovery rate will be computed on the basis of budgeted data. Yes, sir. So how much is the recovery rate, sir? Recovery rate is nothing but, people, 8 lakh is what we estimated overhead is, and number of units or number of hours we estimated what's 12,000. So which will come to rupees 8 lakh divided by 12,000, rupees 66.67 per hour. Rupees 66.67 per hour. Correct, sir. First, very simple overhead. That is fixed cost or fixed overhead cost variance. Fixed overhead cost variance. Fixed overhead cost variance is nothing but people, nothing but absorbed overhead or recovered overhead, absorbed overhead or recovered overhead minus actual overhead, minus actual overhead. I told you one thing. Absorbed overhead, how we were going to do, sir? Recovery rate into standard R for actual output. Recovery rate into standard R for actual output, or you are going to take the actual outputs only. If the recovery rate is on output basis, we will take it on the hourly basis. That is easy. Minus actual overhead. Okay. How much is standard R for actual output, sir? Try to understand, people. For 12,000 units budgeted 12,000 hours. Correct? Now actual output is 11,000 hours. Sorry, 11,000 units. For that, how much it should be? Of course, it should be 11,000 hours. That is budgeted. We are converting it into standard. So try to understand. Recovery rate was around rupees 66.67 into standard hour for actual output is 11,000 hours. Yes, sir. Minus actual overhead we are incurring is rupees 8,50,000. What we are incurring is rupees 8,50,000. Okay, sir. Now what you are going to do, sir? Now 66.67 into 11,000. Which will come to rupees 7,33,333. This is what you are recovering. Minus rupees 8,50,000. This is what actually we incurred. So moral of the story is you are recovering less than what you incurred. So adverse or favorable, sir? Of course it's a adverse. So rupees 1,16,667 rupees is a adverse. This is adverse. 1,16,667 is adverse. Okay. What could be the reason, sir? What could be the reason? People, two reasons are there. What is it, sir? One, you might have incurred more or less than what you estimated. You might have incurred more or less than what you estimated. Point number one. Point number two, you might have recovered more or less than what you were supposed to recover. I repeat, one reason is you might have paid or incurred expense more than what you expected. Correct? Two, you might have recovered more or less than what you estimated. So this variance, what you are going to do, sir? I am going to divide it into two parts. One is relating to incurrence of expenditure, which is nothing but expenditure variance. One more is relating to you recovering, which means the more and more product you produce, you recover more. The less and less product you produce, you recover less, which is nothing but relating to production. So it is efficiency variance. Relating to efficiency variance. Yes, sir. or this efficiency could be also told as volume variance, because it is all about recovery. Yes, sir. Now, this expenditure variance is nothing but, people, how much you thought it would be and how much is actually it is. So it is planning error, no? So try to understand. This is nothing but you thought your expenditure should be 8 lakh. You thought your expenditure to be 8 lakh, but actually how much it is? 8,50,000. What you planned, because we are trying to find out a planning error here, expenditure. So you are incurring 50,000 more than what you estimated, which is adverse. You are incurring 50,000 more than what you estimated, which is adverse. This is your expenditure variance. So what was 8 lakh, sir? What was 8 lakh? 8 lakh was nothing but budgeted overhead. Okay. 8 lakh 50,000 is what, sir? Actual overhead. So what is the formula for expenditure variance? Budgeted overhead minus actual overhead. Okay. Now one thing is simple. One thing is simple. We have to find the difference between 7 lakh 33,000 to 8 lakh 50. We have to find the difference between reason for difference between 8 lakh 50 to 733. Now in that 50,000 is sorted out. 8 lakh to 850, it is your estimation error. That is sorted out. Now the tricky part comes, that is ascertaining the reason for difference between 8 lakh to 733, 333. You thought you are going to recover 8 lakh, but you are recovering just 733, 333. What is the reason? Volume, correct? Volume. You are producing more or less. You are producing more or less. To produce more or less, that is volume variance. I will write it as volume variance only because I will tell later. Efficiency will get later back. So I will write it as volume variance. Now to produce less or more, there could be two reasons. One, either you are not utilizing a complete factory capacity. Either you are not utilizing a complete factory capacity, or you are working less than expect, in the efficiency of less or more than what we expected. For example, in 1 hour we expected you to produce 1 unit. Now you might be taking 1.5 hour, no? So it is about your efficiency. And we thought you can produce 10,000 units, but you are able to produce only 9,000 units, which means you are utilizing less capacity. You are utilizing less capacity. So what you are going to do, sir? Volume variance is all about how much you are able to recover. How much you are able to recover. Try to understand. While doing a recovery rate, we thought we are going to recover for 12,000 hours. But actually, for how many hours we are recovering? We are recovering for the standard hours. We are recovering it for the standard hours of 11,000. So 11,000. This is the reason for volume variance. I repeat, 12,000 hours into 66.67. That is what you thought you are going to recover. But actually you are able to recover only from standard hours for actual output, which is 11,000 hours. So you are recovering less. Adverse. No. So what is this 12,000, sir? Budgeted hours. What is this 11,000, sir? Standard hours. And what is 66.67, sir? It is recovery rate. This could be due to two reasons. What are those two reasons, sir? Those two reasons are, one is could be due to your less efficiency, because you are paying more. You are recovering rate less, that we know. So efficiency should be either low. So either it could be due to your efficiency, or you not utilizing the full capacity of the factory. Either due to your less efficiency, or you are not using full capacity of the factory. Now first we'll discuss about efficiency. Efficiency is how many hours you are supposed to take, how many hours you have taken. How many hours you are supposed to take, how many hours you have taken. How many hours you are supposed to take in the given example? You must have taken 11,000 hours, because recovery is happening only on 11,000 hours. But actually how much you have taken? 11,136 hours. 66.67 is a recovery rate. Try to understand. Efficiency is all about how much you should have taken and how much you have taken. You should have taken just 11,000 hours to produce whatever you have produced. But how much you have taken? 11,136. What is 11,000, sir? Standard hours. What is 11,136, sir? Actual hours. What is 66.67, sir? Recovery rate. Now adverse or favorable, sir? Try to understand. You are recovering on 11,000 hours, but you have taken 11,136, which means you have taken more hour, less efficient, which is adverse. Which is adverse. Hope you got this. Yes, we got this. Yes. Next, capacity variance. Capacity variance is what, sir? Listen, boss. In the beginning, what we told you? We told you to utilize the factory for 12,000 hours. Correct? Correct? We told you to utilize the factory for 12,000 hours. But you are able to complete. But you are able to work only for 11,136 hours. We asked you to utilize the factory for 12,000 hours. But you are utilizing factory for 11,136 hours. Which means you are underutilizing the factory. Sir, good no, sir. Array, you underutilize, you overutilize, you utilize correctly. You have to give the same fixed cost. So, if you overutilize it, it is good no. You go to eat food under buffet. You paid 1,000 rupees. Now you try to eat more or less. You try to eat more, no. Because you paid more. You have to recover more. So it's not that, sir, if you eat more, spendings will be more. No, spendings will remain same. So you try to recover more. So again, this is also adverse only, because we gave you an option of utilizing 12,000 factory hours. But you are able to utilize just 11,136. So that is your capacity variance. That is your capacity variance. These are all about fixed overhead. These are all about fixed overhead, but bit of modification is there. What is that, sir? Now, when I told about this, or when I complained it to the production manager, boss, what the hell you are doing? We are not able to achieve that target, right? Why it is so? Why you are unable to produce? Correct. Now the production manager will tell, sir, wait. You told us you are going to give us 12,000 hours. Correct? Yes. For how many days, sir? 30 days. Yes. You told that our factory is going to work for 30 days. Sir, due to your problem, due to your management's problem, or due to strike, or due to some unforeseen reasons, we are able to work only for 28 days, sir. If at all, we work for 30 days, no, I would have easily made that recovery of 12,000 hours. We are like, boss, can you see the hibiscus here? No, sir. Why? To recover 11,000 hours only, it took you 28 days, sir. You are telling 1,000 hours you would have recovered only in 2 days. What nonsense you are talking. So what we will do is, okay, boss, okay, fine. That whatever 1,000 hours recovery we didn't do, no, fine, we don't put it on you. Don't worry. Provided the reason is only and only due to closure of our factory for 2 days. So what we will do is, now let's assume we gave you a target of 12,000 hours. We gave you a target of 12,000 hours for how many days? 30 days. Fine. Now we'll change our target. We'll give you target of 28 days only. Fine, no. We'll give you target of 28 days only. 12,000 for 30 hours. For 28 hours, it is 11,200 hours. We are asking you recovery, revised budgeted hour is 11,200. Other 800, fine. We will put it into different variance. Okay. Now, the question changes or answer changes when the calendar variance is given. Now, this is calendar variance. I mean, if they give a days in the question, then remember there is a calendar variance. Okay. How you are going to do, sir? Now, our cost variance is same. Pretty simple. How much you incurred, how much you recovered. you are able to recover how much, sir? 11,000 hours. That is standard hour for actual production into recovery rate of 66.67. How much you incurred, sir? Actually, we incurred 8,50,000. Correct? So what was 11,000, sir? 11,000 was your standard hour. 66.67 was your recovery rate. 8,50,000 is your actual overhead. Great. This we divided it into two parts. Yes, sir. You divided it into two parts. Remember, one was expenditure variance. The other one is efficiency variance. Efficiency variance, in simple I can write it as a volume variance. Volume variance. One is expenditure variance, one is volume variance. Expenditure is also pretty simple. How much you budgeted, sir? You budgeted it to be 8 lakh. How much you actually incurred? 8,50,000. Array, you are not work. Sir, budgeted, that also will change, no, sir? Budgeted, that also will change, no, sir? You are paying rent for 30 days. You plan to work for 20 days. You plan to work for 28 days, 25 days, 1 day. End of the day, we have to give our rent for 30 days only. So, budgeted other figures won't change. Budgeted other figures won't change. You thought 1 hour, 1 unit you are going to produce. Same, it remains same. Plus, in a month you are going to incur 8 lakh rupees as an expenditure. It remains same. Because you are planning to incur means it's not going to change based on the days you work. That will be variable then. So you are going to compare 8 lakh and 850 only. 8 lakh is what, sir? Budgeted overhead. 8,50,000 is what, sir? Actual overhead. 8 lakh is budgeted overhead. 8,50,000 is actual overhead. This is your expenditure variance. Now volume variance, earlier we divided into two parts, correct? One is due to efficiency, other is due to rate, or one is due to efficiency, other is due to capacity. Here the manager is telling not only those two problems, one more problem was you are unable to work for number of days what you planned. That is calendar variance. So volume variance could be divided into efficiency variance, okay sir, capacity variance, okay sir, calendar variance. Here we are telling our production manager, boss, listen. This thing is simple. We told you have to work for 12,000 hours, correct? We told you have to work for 12,000 hours, but now we are planning to change it to just 11,200 hours. Just 11,200 hours into 66.67. Now this 800 hours, we ourselves telling that we can't recover it, which means adverse, no. It will be adverse, no. Because first we thought we are going to recover on the basis of 12,000 hours. But now we ourselves recovery hours only we are reducing to 11,200, which means it's a adverse. So what was 12,000, sir? 12,000 was our budgeted hour. What is 11,200, sir? 11,200 is revised budgeted hour, and this is recovery rate. Done. Sir, capacity, sir. Now, of course, we agree. We told you we are going to give 12,000 capacity, but no. We didn't give you 12,000 capacity. We agree. We gave you a capacity itself as a 11,200. Max to max you can use is 11,200 if you work efficiently. But you are able to produce. Output relating to 11,136 hours. You are able to produce only efficiency relating to 11,136 hours. So 11,200 was revised budgeted hours, sir. 11,136 is actual hours you have worked. Recovery rate is 66. So if at all your actual hours is more than revised budgeted hour, then it is favorable because you are exploiting the factory. You are paying a rent for let's say 1,000 hours. You are working for 1,200. you paid a buffet charges of 1000 rupees, but you are able to recover a food costing more than 1000 rupees. Favorable, no? So if the revised budgeted hour is more than the actual hours, it's a favorable. Actual hours is more than revised budgeted hour, then it's favorable. Otherwise, it is adverse. In this scenario, it is adverse. Efficiency is, boss, you are supposed to use 11,000 hours for whatever you produce. Forget about how much we gave and all. That is not even in the equation. If you work for 28 days also you should work efficiently. Now, 11,000 hours we asked you to work. But how many hours we have taken? 11,136 hours. 66.67. So 11,000 is what, sir? Standard hour for actual production. 11,136 is actual hours. 66.67 is recovery rate. Recovery. Simple. Basically, your capacity is getting restricted. So that will be split into calendar variance and capacity variance. That's it. That's the reason or difference. So let me quickly write the formula of this factory overhead in a single format. Try to understand. Sorry, fixed overhead, cost variance, fixed overhead, cost variance. It is nothing but recovered overhead or absorbed overhead, absorbed overhead minus actual overhead. Recovered overhead is what, sir? Recovered overhead is recovery rate into standard R minus actual overhead. This could be divided into two. Fixed overhead expenditure variance and fixed overhead volume variance. Fixed overhead expenditure variance, fixed overhead volume variance. Fixed overhead expenditure variance is very simple. Budgeted overhead minus actual overhead. Budgeted overhead minus actual overhead. That is, if the budgeted overhead is greater than actual overhead, then it is favorable, because we thought our expense to be 12 lakh, but actually we are paying only 10 lakh, which is favorable. If at all actual overhead is greater than budgeted overhead, we thought it to be 10 lakh, but we are paying 12 lakh, then it is adverse. Done. Fixed overhead volume variance is nothing but budgeted hour minus standard hour into recovery rate. That is divided into two parts. Yes, sir. One is calendar variance, one is capacity variance, or efficiency variance and capacity variance. The answer is no. This could be divided into two. One is calendar information is not given. The other one is calendar information is given. In question, when the calendar information is not given, what will be the formula? And calendar information is not given, what will be the formula? Now, when the calendar information is not given, first case, it was only and only the reason was you not utilizing proper capacity or you not working efficiently. So one was efficiency ratio or efficiency variance. The other one is capacity variance. Yes, sir. Efficiency variance was what, sir? Was you are supposed to take standard hours, but you have taken actual hours. You are supposed to take standard hour, but you have taken actual hours. So if the standard hour is greater than actual hours, then it is adverse, favorable, because you taken less hours than the expected. If the actual hours is greater than standard, you have taken more than the expected, your efficiency is low, which is adverse. Your capacity variance is, boss, we have given you 12,000 hours, that is budgeted hours, but you have worked only to the extent of 11,136 hours in a factory, which means it is adverse. No. Now try to understand. If the budgeted hour is greater than the actual hours, then it is adverse because you are not exploiting the full capacity. If the actual RC is greater than the budgeted hour, it's a favorable because you are able to exploit the capacity. This is when calendar information is not given. Now when the calendar information is given, this could be divided into three parts. No. When the calendar information is given, this could be divided into three parts. What are those, sir? Part number one. Part number one, your efficiency variance. Same ditto. Efficiency variance. Next is your capacity variance. Next is your calendar variance. One extra. Correct? Efficiency variance, pretty simple. Boss, forget about 30 days, 28 days and all. For the 11,000 units, how much you should have used? Sir, 11,000 we should have used. Standard hours. How much you are actually using, sir? You are using 11,136. So, if the standard hour is greater than actual hours, favorable. If the standard hour is lesser than actual hours, it is adverse because in one efficiency is there, in the other one efficiency is not there. Okay. Capacity variance, sir. We have given you 12,000. That time the production manager will stop. You never gave me 12,000 capacity. 2 days you closed your business. So you gave me just 11,200. So what is 11,200? Revised budgeted hours. Okay, sir, we gave you 11,200. How much you worked? Just 11,136, which is nothing but actual hours you worked. Okay, so your mistake is also there, not only hours. In the given hours also you didn't utilize properly, idiot. So that is standard rate or recovery rate, people. Now, if the revised budgeted hour is greater than the actual hours, which is adverse. What is the reason, sir? You are not utilizing your full capacity. If at all your revised budgeted hour is lesser than the actual hours, you are utilizing a capacity, so it will be favorable. Calendar is what, sir? Okay, sir. So you are not ready to take a blame of difference of that 800. Fine. We are going to blame it as a calendar variance. That is budgeted hour minus revised budgeted hours into standard rate. Now, if at all you are restricting your revised budgeted hours from the budgeted hours, then it is adverse. No. You yourself paying full money but unable to work for that time. That is, if the revised budgeted hour is greater than budgeted hour, then it is favorable. Because you thought you are going to work for 30,000 hours, you are working for 34,000 hours, planning to work for 34,000 hours. You are increasing your standards, which is favorable. If the budgeted hour is less than revised budgeted hour, more than revised budgeted hour, then it is adverse because you are reducing your standards. This is all about your overhead cost variance. We'll do one thing. Actually, sales variance is nothing but just like a material cost variance only. Okay, that we will do later. First, we'll look into few questions of the cost variance. Okay, later we'll do the sales variance, revenue variance. Yes. So we'll look into few questions. Okay, now let's start with the illustrations. Okay, look at illustration number 1. ABC company uses a standard cost system and manufactures product Z. Okay, standard cost per 1000 kg of output is as under. So what is output? 1000 kg. For that they have given a data. Material A we use 800, material B we use 200, material C we use 200. So 1200 kgs of raw material we will use to get a 1000 kgs. Sir, but 1000 kg is output. Yeah, 2000 kgs. 200 kgs. Oh, sorry, wait. Yeah. 1200 kg is a loss, whereas company produced 2 lakh kg of output. 2 lakh kg of output. That's what the company has produced. So listen here. So what you should do, sir? You should find out ratio of it. The ratio of the raw materials are basically, try to understand, for 1000 kg, they are having 800 kg of product A. So for 2 lakh kg, how much it would be? For 1000 kg of output, for 1000 kg, they have 800 kg of input of A. So now they have an actual output of 2 lakh kg. For that, how much? 1,60,000. Okay. Next, for 1000 kg, they have B and C 200 kgs. Now we have 2 lakh kgs. For this, how much? For this, how much? It is 40,000. So try to understand. Standard quantity 160,000 A, 40,000 B, 40,000 C. Okay. Now standard rate is 2.541. 2.541. Actual quantity 157,000, 38,000, 36,000. This is your actual quantity. Actual rate is 2.4, 4.2, 1.1. Calculate material cost variance. So basically, we are going to calculate material cost variance. That is nothing but standard quantity into standard rate minus actual quantity into actual rate. Next, labor price variance. That is price. We ask you to get actual quantity at a standard rate, but you will get at a actual rate. So that is nothing but standard rate minus actual rate into actual quantity. Next is material usage variance. That is, we asked you to use standard quantity and at a standard rate, but you are using actual quantity. So that is standard quantity minus actual quantity into standard rate. Usage variance could be further divided into two: yield variance, mix variance. To find out a yield variance, mix variance, we need a RSQ, revised standard quantity. How to ascertain that, sir? Nothing but total of the actual quantity. Total of the actual quantity 157,000 plus 38,000 plus 36,000, 231,000. 231,000 we should divide it in the standard quantity ratio. That is 4:1:1 or 160 divided by 240, like that. 231,000 into 4 divided by 6. 154,000. So 231,000 into 1 divided by 6. 38,500. 38,500. So material mix variance, what to do, sir? Material mix variance is revised standard quantity minus actual quantity. That is, we are doing a mistake in mixing it. We are taking one item more, one item less, like that. So that is into standard rate. Yield variance means how much yield we are getting from the materials. If the revised standard quantity is more, it is better. If the revised standard quantity is less, it is correct. Sorry, if revised standard quantity is less, better, because we are trying to tell that, boss, we thought 1 kg will give us 0.9 output, but now we got to know that 1 kg is giving 1 kg of output. So which is better, no? So revised standard quantity should be less if it is favorable. If it's more, it will be adverse. This is all about illustration 1. Look at the illustration 2. Calculate the material cost variance. They are asking. They gave us standard output. See here, they have given standard output and actual output. They haven't given a input. They have given it as a output. Standard price is 2. Standard actual price is 3 per kg. Actual quantity is 2000 kgs. Actual quantity is 2000 kgs, whereas standard is 4 kg per unit. So 400 units is actual production into 4 kg, that is 1600 kg is standard quantity. Actual quantity is how much, sir? 2000 kg is actual quantity. Standard rate is rupees 2. Actual rate is rupees 3. Simple question. Okay. Illustration 3 you see. Standard material cost per unit. Material A 1 rupees, material B 2 rupees. This is standard price, standard price. Material issued for A 2050, material B 2980. Material A was purchased at the rate of 1, material B is purchased at the rate of 2.1. Calculate the material price variance. Basically, they are, for the sake of understanding they are doing, you can do everything in a same thing, like same manner. See here, standard quantity, standard price, actual quantity, actual price, and there are two materials, so there is a possibility of asking revised standard quantity also. So, material A, material B. What is the standard quantity, sir? Standard quantity is, they haven't given standard quantity here. They haven't given standard quantity here, so they are asking only price variance. Okay. Standard price they have given 1 and 2. Actual quantity they have given 2050, 2980. Actual price they have given 1 and 2.1. Okay. Now what you should do, sir? Difference between these two you should multiply with AQ. That is standard price minus actual price into actual quantity. See here, compute the material usage variance they are asking. Standard material cost per unit 2 rupees and 6 rupees. 2 piece of A, 3 piece of B is required per unit, correct? How many units completed? 1000 unit. So try to understand standard quantity. We have A, we have B. Standard quantity is how much, sir? 1000 into 2, 2000. 1000 into 3, 3000. Standard rate is how much, sir? Or standard price is how much, sir? Rupees 1, rupees 2 per kg. Actual quantity is how much? 2050, 2980. 2980. Actual price they are not telling because price is not required for usage variance. Okay. If you take the previous question price only, which is 1 and 2.1. Actual price 1 and 2.1. You might they might ask you to calculate yield and material this also. So what you should do, sir? Total of the actual, that is 2050 plus 2980, 5030. You should split it in the ratio of standard. You should split it in the ratio of standard. That is 5030 divided by 5000 into 2000s. 2012. 5030 divided by 5000 into 3000. 3018. Like this. Now what they have asked? Usage variance they have asked. Usage variance means how much is our actual quantity and how much is our standard quantity into standard rate. It could be divided further into mix variance and yield variance. So yield variance means what, sir? Yield variance means revised standard quantity minus standard quantity into standard rate, whereas mix variance is revised standard quantity minus actual quantity into standard. Sir, RSQ first, SQ first. That doesn't matter if you know the concept. You should know where to write adverse, where to write favorable. Try to understand. Standard quantity last time it was 1000 kgs. Now we revised it, or here only you see, standard quantity we assumed it to be 2000. But now based on the quality of the product, we are changing it to 2012. Then try to understand, no, you are planning to increase your consumption, adverse. Which means if at all revised standard quantity is greater than standard quantity, it is adverse. If the standard quantity is greater than revised standard quantity, it is favorable. Okay. See here, a product is made from two raw materials, material A and material B. 1 unit of finished goods require 10 kg of material. The following is the standard mix. Okay. So 1 unit require how many kgs? 10 kg of material. How much of A, sir? A 20%, which is 2 kg, B 80%, which is 8 kg. They only have given. Rates also they have given here. During a period, 1 unit of product was produced at the following cost. During a period, what we are doing? We are producing 1 unit. How, sir? 8 kg of A we are using, 4 kg of B we are using. Wow. 8 kg of A we are using, 4 kg of B we are using. So try to understand. Standard quantity is supposed to be 2 and 8. Standard price is 2 and 1. Actual quantity is 8 and 4. Actual price doesn't matter because it's the usage 2 and 1.25. 2 and 1.25. So revised standard quantity shall be 12. Actual quantity is 12. No, 12 should be divided in this ratio. 12 should be divided in the ratio of 2:8. 2 by 10. 12 into 2 divided by 10, which is 2.4 kg, and here it will be 9.6 kg. This is your revised standard quantity. Using this, you can find out a mix variance and yield variance. These all things are same. There is material cost variance. One more thing, listen here. They might give like this. What they will tell is material A and B is there. In the final product, the input of material A and B is, they are telling, let's say 3:7. The ratio of input is 3:7, they will tell. And also they will tell input 15% is wastage. They will tell input 15% is wastage. Now actual output, let's say they will tell 900 kgs. Actual output they will tell it as 900 kgs. Okay, output is 900 kgs, sir. Input 15% is a wastage. Now try to understand, people. In the standard ratio, you are not going to divide 900 because 900 is output. Standard, we are finding out the usage. No, raw material is usage, which means we should compute input. So what we should do, sir? We should calculate input first. How to calculate? Very simple. Input minus loss is equal to output. Which loss, sir? Standard loss, normal loss. Input is how much? We don't know. I will take it as I. Loss is how much, sir? 0.15 I is equal to output 900. Now it is 0.85 I is equal to 900. Now 900 divided by 0.85, which is 1058.8. Now this we are going to split it in the standard ratio of 3:7. This thing you have to keep in. Okay. Yes. Now we can go to illustration number 10, which is based on labor variance. Try to understand. Standard output is 400. Actual output is, standard output is 500. Actual output is 400. Great. Standard time per unit they have given. Then the standard output has no importance at all. So we need standard hours. We need standard rate. We need actual hours. We need actual rate. And if the idle time is given, idle time we need. Correct? Revised standard also might be requirement if there are two kind of material, but in the given question it is only one. Okay. How much is the standard hours, sir? Standard hours is actual units into standard hours. That is 2000 hours. 2000 hours. Standard rate is how much, sir? Standard rate 20 per hour. 20. Actual hours we have taken is 2200. Actual rate is 25. Okay. So there is no idle time. Now labor cost variance. Very simple. Standard hour into standard rate minus actual hour into actual rate. Standard hour into standard rate minus actual hour into actual rate. That could be further divided into labor rate variance, labor efficiency variance. Sir, 3 no, sir. Idle time is not given. So only 2. Rate variance is what, sir? Standard rate minus actual rate, and you are supposed to get actual hours. Whereas here it is usage. Usage means, or efficiency means, how much you are supposed to use, standard hours, how much you actually used, actual hours, into standard rate. Here in this scenario, if the actual rate is less than standard rate, favorable. If the actual rate is more than standard rate, unfavorable, adverse. Second scenario, if the standard hour is less than actual hours, adverse, because you are using more hours than expected. Whereas if the actual hour is less than standard, favorable. We are going to do that way. Same question here. See here, they have given actual hours, they have given actual direct wages. Using that, you can find out how much is the actual rate paid. That is 1800 divided by 5800, which is 0.31. So actual rate is 0.31, standard rate is 0.35, actual hours is 5800, standard hour is 6000. Using that, you can find out the certain things. Here also same question they continued. See here. The standard labor cost for producing 200 meter of cloth was predetermined as 20 skilled labor hours and 30 unskilled labor hours. So we have two kind of labors over here. Correct? One is skilled, one is unskilled. Now, we need standard hour, we need standard rate, we need actual hour, we need actual rate. As two are there, there might be a requirement of revised standard hour also. Correct? Now, standard hour, what they are telling, for producing 200 meters, you need 20 skilled and 30 unskilled. 300 meters of cloth is produced. So, they like convert that standard for standard into standard for actual. 20 for 200, for 300 question mark, it will be 30. 30 for 200, for 300 how much? It will be 45 hours, standard hour. Standard rate is how much, sir? For skilled it is 15, for unskilled it is 10. Actual hours is 30 skilled labor hours and 30 unskilled labor hours. So there is no efficiency variance in the skilled, because you expected it to be using at 30, you use 30. Great. Actual rate is how much, sir? Actual rate is 17 and 12. Now if they ask the revised mix and yield, what you are going to do? Total of actual, which is 60, that in the ratio of standard. That in the ratio of standard, that is 75. 60 into 30 divided by 75. 24 and 60 minus 24, which is 36. So we got this. Done. Now again, mix variance, how to do, sir? Mix variance is revised standard hours minus actual hours. If the actual hours taken is more than revised standard hours, adverse. If the actual hours taken is less than revised standard hours, favorable. See here, in the first case it is adverse. In the second case it is favorable. Correct? Yield variance, how, sir? Yield variance is revised standard hours minus standard hours or standard hours minus revised standard hours. But try to understand, if the revised standard hours is greater than standard hours, it's an adverse, because you are changing your standards, you are increasing your standards, so it is adverse. If at all your revised standard hour is less than the standard, then it is favorable. In the first scenario, it is revised standard hour less than standard, so it's a favorable. Second scenario, it is 40 and 36, again favorable. So yield variance is favorable, mix variance is adverse. All these things just go through once. See here, illustration 15. Standard labor cost of producing 40 units of product is 30 hours. Okay, by a skilled at a standard rate of 60, 90 hours of unskilled at a standard rate of 20. 40 units are produced. Oh, so basically you are producing exactly as a Standard only. So whatever is there, that only you take as a standard. Whatever is there here, you take it as actual. Accordingly, here, due to a machine breakdown, both skilled and unskilled workers lost 9 hours. So try to understand here, there is a idle time. Let's say standard hour, standard rate, actual hour, actual rate, actual hours paid. Okay, I will take actual hours paid, actual hours worked, idle time, actual rate, revised standard hours. So much I will take. Listen here. Standard hour is how much, sir? Skilled, unskilled. They are telling exactly for 40 only. So I am going to take it as it is. 30 and 90. Standard hour is 30 and 90. Standard rate is how much, sir? Standard rate is 60 and 20. 60, 20. 40 units of product were produced, which the skilled workers are paid for 20 hours. Actual hours paid is 20. Unskilled were paid for 130. Okay. Whereas both are losing 9 hours each, which means 11 hours is actual work there. Here is 121. And idle time is 9 and 9. And actual rate is, rupees 55 and rupees 24. So revised standard hours, now whether it's based on the total of actual hours paid or actual hours worked, sir, try to understand your efficiency will be calculated on the basis of actual hours worked, not paid. So it will be total of this. This we are going to do 132 will be split in the ratio of 1:3, 1 by 4. 132 divided by 4, which is 33 and 99. Revised standard hour is 33 and 99. And what are the different formulas? Come on. Cost variance is standard hour into standard rate minus actual hours paid into actual rate. That could be divided into 3 parts: rate variance, efficiency variance, idle time variance. Rate variance is what, sir? Actual rate or standard rate difference into actual hours paid. Because your responsibility is to bring how much ever labor we ask. Don't ask about efficiency and all. Next we have one is done. Next we have efficiency. For that we are going to consider standard hours and actual hours worked into standard rate. Idle time variance is difference between actual hours paid and actual hours worked. That is idle time into standard rate. Okay, sir, is it adverse or favorable? Always and always remember it is adverse. The efficiency variance further could be divided into yield variance, mix variance. What is the formula for yield variance, sir? Formula for yield variance is revised standard hours minus standard hours, both worked. I mean, here work doesn't matter. Revised standard minus standard into standard rate. Mix is revised standard hours minus actual hours worked, not paid. Okay, that's it. This was all about your material and labor variance. Now we'll see the few questions of overhead variances. Okay, we'll see few questions of overhead variance. Now let's look at this question of variable cost overhead. Budgeted production is 2000 units. Actual production is 1500 units. Budgeted variable overhead is 4000, whereas actual variable overhead is 2500. Standard hour per unit is 1 hour and actual hours worked is 1800 hours. Okay. So how much is the standard hour for actual output? Standard hour for actual output is 1 into 1500 hours. 1 hour into 1500 units, 1500 hours. Actual hours is how much, sir? Actual hours is 1800 hours. And how much is the standard rate? Standard rate is, or recovery rate is 4000 budgeted variable cost divided by 2000 hours, because budgeted hours is 2000 only, no? 2000 units into 1 hour, 2000 hours, which will come to rupees 2 per hour. Rupees 2 per hour. Done. So first variable overhead cost variance, that is absorbed overhead into actual overhead. So absorbed overhead is how much, sir? Absorption will be done on the standard hour. So 1500 into rupees 2 minus actual is how much, sir? Actual is 2000. So 3000 minus 2000, which is 1000, and it is favorable because you thought or you actually recovered 3000 rupees, but actually we incurred just sorry, it is 2500, no, sorry, not 1000, give me a second. Actual overhead is 2500. So 2500, 3000 minus 2500 is 500, favorable. Done. This could be divided into two: expenditure variance and efficiency variance. Expenditure variance is all about, boss, standard rate was how much? 2 rupees. Actual rate is how much? Actually you paid 2500 for 1800 hours. You paid 2500, okay, for 1800 hours. That is 1 point. Or I will do one thing, I will write the formula over here. Listen, standard hour minus actual hours into your expenditure variance is standard rate minus actual rate into standard hours, no, or actual hours is actual hours. Expenditure rate variance. So it is standard rate into actual hours minus actual rate into actual hours. Standard rate is your recovery rate, that is rupees 2. Actual hours is 1800 minus actual rate into actual hour is nothing but actual variable cost 2500. So 3600 minus 2500, which will come to rupees 1100. Favorable or adverse, sir? Favorable or adverse, sir? Favorable, no, sorry, favorable. Is favorable. Done. Now, because standard rate is more than actual rate. Next, it is efficiency. Efficiency is what, sir? Standard hour minus actual hour into standard rate. Standard hour is how much, sir? Standard hour is 1500, actual hour is 1800 into standard rate rupees 2, which will come to 300 into 2, 600. Adverse or favorable, sir? Adverse, because you are using more hours than expected hours. That is about your variable overhead variance. Now coming to the fixed overhead variance. Listen here. Detail of the fixed overhead production hours and production for a period are as follows. Budgeted hour is 10,000. Standard fixed overhead per hour is rupees 10. So this is nothing but recovery rate. They are only telling how much is recovery rate. Correct? So how much is the budgeted overhead then? Budgeted overhead will be standard recovery rate. How you got? Budgeted overhead divided by budgeted hours. Now, if you multiply recovery rate with budgeted hours, of course you are going to get a budgeted overhead, that is nothing but 10,000 into rupees 10, which will come to rupees 1 lakh. Budgeted overhead is rupees 1 lakh. Standard hours per unit of output is 5 hours. Actual production is 1920 units. So how much is the standard hour, sir? 1920 actual output into standard hour per unit is 5 hours, which is 9600 hours. Actual fixed overhead is 94,000. Calculate fixed overhead cost variance. So everything we can compute here. That is recovery. Recovery will be based on standard hours into recovery rate minus actual overhead, which is 94,000. Standard hour is how much, sir? Standard hour is 9,600. Recovery rate is rupees 10 minus 94,000. So 96,000 minus 94,000, 2,000 extra we have recovered, which is favorable. Here calendar information is not given, so we are going to divide this into two parts. One is expenditure variance, which is nothing but budgeted overhead minus actual overhead. Budgeted overhead is how much, sir? 1 lakh. Actual is how much, sir? 94,000. Of course it is favorable because you are spending less than what you estimated, so it is favorable. Okay. Next is your volume variance. Volume variance is nothing but based on your volume. Correct? It is based on your volume. That is, boss, how many hours you thought you are going to recover? 10,000 hours. Actually, how many hours you are recovering? Just 9,600 hours. So, that is budgeted hours minus standard hours into standard rate. So, budgeted hour is how much, sir? 10,000 hours. Okay. Standard hour is how much, sir? 9,600. Okay. Recovery is done at what rate, sir? Standard rate. How much is standard rate? Standard rate is rupees 10. So 400 into 10, 4,000 rupees, you are not recovering. You expected to recover around 10,000 into 10, 1 lakh rupees, but you recovered 9,600 into 10. Okay. Reason is what, sir? Reason is two. One is your capacity. The other one is your efficiency. Capacity is what, sir? Boss, we gave you an option of using budgeted hours, but you used actually actual hours. Correct? That is nothing but we gave you option of using 10,000 hours, but you used actually how many hours? They haven't given how many hours we are using. Correct? So give me a second. Continuation of question. Here that information is missing. Here that actual hours information is missing. So we can't compute that over here. Give me a second. Here they're asking expenditure variance. So here information is not there. Here they're asking volume variance. So volume variance, that is done. So for we'll do one thing for efficiency. Okay, we'll do one thing. For efficiency calendar, we are going to see the different question. See here. From the following data, compute a fixed overhead volume variance they are asking. Volume variance. Okay. Budgeted output is 30,000. Budgeted fixed overhead is 30,000. Standard production per hour is 15 units. So, how much is our budgeted hours? How much is our budgeted hours, sir? In 1 hour, you are going to produce 15 units. So, to produce 15 units, you are planning 1 hour. So, to produce 30,000 units, how many hours is what you are expecting? That is 30,000 divided by 15, which will come to 2,000 hours. Correct? Your budgeted hours are 2,000 hours. 2,000 hours. Done. Budgeted fixed overhead is 30,000. So recovery rate is fixed overhead divided by budgeted hour. Budgeted fixed overhead is 30,000. So it is rupees 15 per hour. Standard rate is rupees 15 per hour. Okay. Actual output is how much, sir? Actual output is 2550. Okay. Actual overhead for the month is 3,000. Actual overhead is 3,000. They are asking volume variance. What is the formula, sir? Budgeted hour minus standard hour into recovery rate. Actually, to produce 30,000 units, you thought your budgeted hours to be 2,000. Now you are actually producing 2550. You are actually producing 2550. For that, how much, sir? That is 2550 into 2000 divided by 30,000. 170. Your budgeted R is required to be 170. Okay. Standard R is how much, sir? Standard production per hour is, sorry, sir. Budgeted R is not 170. Standard R is 170. Correct? Sorry, I wrote the 170. Budgeted R is how much, sir? That we have to compute. Sir, what to compute, sir? We know, no, sir, 3000. But 2000 is, sorry, 2000 is per year. 2000 is per year. But here they have given production relating to a month. So we want to convert it into month. See here. The year is budgeted to 50 working weeks on 40 hours week basis. So in a year, how many weeks will be there? 50 working weeks will be there. So 2 hours in every week are lost due to abnormal idle time, which means 38 hours is what you are working actually. The month consists of 4 working weeks. So what you are going to do, sir? This month you are going to divide 2000 hours. You are going to divide 2000 hours divided by how many weeks? 50 weeks. In a month, how many weeks? 4 weeks. 2000 divided by 50 into 4. So around 160. So your budgeted R is 160. Your recovery rate is how much, sir? Recovery rate is rupees 15. So around 10 into 15, rupees 150 is under or over, adverse or favorable, sir? Favorable, because you are able to recover more. 150 favorable. 150 favorable. Hope it is clear. Now listen here. ABC company records reveal the following data for the month of June. You are required to calculate the fixed overhead efficiency variances for the month of June. Budgeted output is 1000, actual output is 700. Budgeted fixed overhead is 4000, actual fixed overhead is 3500. Standard hours per unit is 2 hours. Hours available during June is 500. Actual hours worked is 450. They are asking you to compute efficiency variance. Now try to understand. We budgeted it to be a 1000 units. Correct? We budgeted it to be 1000 units. And how much is the budgeted hours, sir? Then into 2 hours is what we expected per unit. So we were budgeting around 2000 hours. What was the fixed overhead? 4000. So recovery rate or standard rate is how much? 4000 divided by, that is budgeted overhead divided by budgeted hour 2000, that is rupees 2 per hour. That is rupees 2 per hour. Done. Next up. This is your standard rate. Your standard hour is how much, sir? Actual output is 700 hours, 700 units into 2 hours, which will come to 1400 hours. Will come to 1400 hours. Your actual hours worked is how much, sir? Your actual hours worked is hours available during is 500. In that you actually worked 400. Available was how much? 500 during June. Correct? During June. But you worked how much, sir? You worked 450. So what we are going to do, sir? Actual hours is 450. What it is how many hours actually we worked. Now they are asking what, sir? They are asking efficiency variance. What is the formula for efficiency variance, sir? Standard hours minus actual hours. That is efficiency. How much you allowed, how much is worked into standard rate. You allowed how much, sir? Standard hours 1400. Actually worked how much, sir? 450. Correct? into recovery rate is 2, which means around 950 into 2. Rupees 1900. Adverse or favorable, sir? Adverse or favorable? Try to understand the work which is supposed to be completed in 1400 hours. You are completing in 450 hours. Of course, it's a favorable. Is favorable. Okay, here they have given it as adverse, but write it as favorable. Here, one more question. See here, from the following data, compute a overhead capacity variance. Capacity variance means what, sir? Capacity variance. How much budgeted hour we have given, how much actual hours we have worked into standard rate. Correct? Standard rate. Budgeted output for the year is 30,000. Budgeted fixed overhead is 30,000. Standard production per hour is 15 units. So how many hours we estimated? 30,000 divided by 15. 30,000 divided by 15, which is 2000 hours. So budgeted hours was 2000 hours. So recovery rate or standard rate is how much, sir? Rupees 30,000 divided by 2000, rupees 15 per hour. Okay. Actual output for the month is 2550. So standard hour is how much, sir? Standard hour is 2550 into divided by 15 per hour. No. So 2550 divided by 15. 170 hours per month. This 2000 is per year. 2000 is per year. This is per month. Done. Actual overhead for the month is 3000. Actually we incurred 3000. Let it be. The year is budgeted to 50 weeks, 40 hours week. 2 hours in every week is lost due to abnormal idle time. The month consists of 4 working weeks. So try to understand 2000 divided by 50 into 4. How much is your budgeted, sir? 2000 divided by 50 into 4. 160 hours. 160 hours is your actually budgeted hours. Actually, how many hours you worked, sir? It was 40 hours week. Correct? How many weeks you worked? 4 weeks. In a month, I am telling. 4 weeks. So it will come to 160 hours. However, 2 hours in every week are lost due to abnormal idle time. So last time is how much, sir? 4 weeks into 2, which will come to 8 hours. 8 hours. So net actual hours worked is 152 hours. That's it. Actual hours worked is 152 hours. So try to understand. Budgeted is 160. Actual is 152. Recovery rate is rupees 15. 8 into 15. Rupees 120. Adverse or favorable, sir? Adverse or favorable, sir? Adverse. Because you are using less. 120 adverse. Look here. Last question of your cost variance. A company has a normal capacity of 100 machine working 8 hours per day of 25 days in a month. So normal capacity means budgeted 100 into 8 hours into 25 days. How many machine hours we have in a month? In a month we have 100 into 8 into 25, which is 20,000 machine hours. The budgeted fixed overhead for the month is 150,000. So budgeted overhead is how much, sir? 150,000. The standard time required to manufacture 1 unit of product is 4 hours. So you need how many hours to produce 1 unit? 4 hours. In a particular month, company work for 24 days. Company work for how many days, sir? Just 24 days. But actually you can work for 25 days, which means calendar variance is there of 750 machine hours per day. So you are not even working at 800 machine hours per day. You are working at 750 machine hours per day. So actual hours worked is how much? Actual hours is 24 into 750. 24 into 750, which is 18,000 hours. Actual hours worked is 18,000 hours. Okay. 4,500 units is produced. 4,500 units is produced. So to produce 4,500 units, how many standard hour is required, sir? 18,000 is the standard hour. 18,000 is the standard hour. Actual overhead is 1,45,000. Actual overhead is 1,45,000. We'll do one thing. For this, we'll compute all the overheads. For this, we'll compute all the overheads. What are the overheads required for? Try to understand here. Calendar they have given. So we need a revised budgeted hour also. Correct? First, we'll take a budgeted hour. Budgeted hour. That is overall. We thought we are going to work with 100 machines for 8 hours a day for 25 days, which will come to 20,000. But in revised budgeted hour is what is happening, sir. 20,000 we thought in 25 days, but we are working only for 24 days. So revised budget will be 20,000 divided by 25 into 24. 19,200. Okay. Standard hour is how much, sir? We are producing 4,500 units and each and every unit need 4 hours. So it will be around 18,000. Standard hour is around 18,000. Okay. Recovery rate is how much, sir? Or standard rate is how much, sir? Somewhere here. How much is our budgeted fixed overhead? Budgeted fixed overhead is 150,000. Budgeted hours was 20,000. So around rupees 7.5. Rupees 7.5 is what we expected. Rupees 7.5 is what we expected. So from the beginning we'll start. Fixed overhead cost variance. Give me a second. So fixed overhead cost variance, that is nothing but absorbed. Absorbed means standard hour into recovery rate minus actual overhead. Standard hour was how much, sir? Standard hour we estimated it to be 18,000 hours. Okay, great. 18,000 hours into recovery rate is 7.5 per hour minus actual overhead is how much, sir? Actual overhead is 145,000. Please mark it as LMR. Please mark this question as LMR, last minute revision, because everything could be computed here. 18,000 into 18,000 into 7.5. 135,000 is budgeted or recovered and 145,000 is actually incurred. So you can tell that 10,000 you incurred extra, which is under absorption adverse. This could be divided into two parts. One is expenditure variance, one is volume variance. So fixed overhead expenditure variance is what, sir? Fixed overhead expenditure variance is how much is your budgeted? Your budgeted was 150,000. Yes, sir. How much is your actual? Just 145,000. Congratulations. You are saving rupees 5,000 than what you expected. Favorable. Next is volume variance. How much is you plan to recover? Total hours. But you are recovering in how many hours? Correct. Budgeted hours were 20,000. Okay. You are able to recover only for 18,000 and the standard rate is 7.5. So 2,000 into 7.5 will come to 15,000. So rupees 15,000 adverse. Rupees 15,000 adverse. Why is it so, sir? Because you thought you were going to recover for 20,000 hours, but you were able to recover only for 18,000 hours, which means under recovery again 15,000. Now you can see here 5,000 favorable, here 15,000 adverse, net 10,000 adverse. Great. Done. Next is what, sir? This volume variance could be divided into three parts: efficiency variance, calendar variance, capacity variance. First we'll go for efficiency variance. It is pretty simple. Boss, how many hours we asked you to work? for the required production, how many hours you actually worked into recovery rate. So standard hours we had given you is 18,000, but actually how many hours you are working? How many hours you are working? You are working for 18,000 hours. Great. You are also working for 18,000 hours. Recovery rate is how much, sir? 7.5, which means efficiency variance is nil. You are working exactly 100% efficiency. Done. Next is capacity variance, not capacity, it is capacity. That is, boss, we have given you budgeted hours. You will tell, no, sir, you have given us budgeted hour, but one day we are not working. No. Okay. We have given you revised budgeted hour. But how much you worked? Actual hours. So, how much is it, sir? Revised budgeted hours, what we have given him was 19,200. Yes, sir. Actual hours, what we have given him was 18,000. Yes, sir. Recovery rate was 7.5. 1,200 into 7.5. 1,200 into 7.5, which is rupees 9,000. 9,000 adverse. Next is calendar variance. Boss, how much is you are losing calendar variance because you are not working extra? If you work extra, favorable. If you don't work extra, adverse. So you thought you are going to make like use of how many hours? Whole 20,000 hours. But due to some reasons, you are changing it to 19,200. 19,200. Recovery rate is 7.5. So 800 into 7.5. 6,000. Adverse or favorable? Adverse. Now you can see here, if you go to the volume variance, 15,000 adverse. Efficiency nil. This is 9,000 adverse. This is 6,000 adverse. Together it is 15,000 adverse. With that, cost variances, different cost variances are done. Of course, we are going to discuss some more illustration on this if the time permits. Okay, will be after completion of other chapters. If at all time permits, we are going to do the much more in-depth discussion on all the questions of clear. Yeah. Now we'll discuss about revenue variance, that is nothing but sales variance. Actually, sales variance we can discuss on two bases. One is on the basis of turnover, other thing is on the basis of margin. One is on the basis of turnover, other thing is on the basis of margin. Okay. Now on the basis of turnover, pretty simple, people. Ditto like material variance. Try to understand. First, what was the material cost variance formula? Material cost variance formula was standard quantity into standard rate minus actual quantity into actual rate. Here also ditto. Standard quantity means how much you estimated to sell. Standard rate means at what price you thought of selling, whereas actual quantity is how much you actually sold, and AR is how much is actual rate or actual price. But one thing you have to remember, in the material cost, if the standard was more than actual, it used to be favorable, where the standard was less than actual, it used to be adverse. But when it comes to revenue, people, you expect to overachieve your target. Standard is your target. You thought you are going to make a sale of 10 crore. Now actually if you are making 11 crore, it is favorable, not adverse. So in this scenario, if the actual is more than standard, it is favorable. If the actual is less than standard, it is adverse. So what is the sales value variance? Their material cost variance. Here it is sales value variance. Formula is standard quantity into standard rate minus actual quantity into actual rate. However, here if the actual is more than standard, it's not adverse, it's favorable. Then that material cost, we used to divide it into two parts. One is price variance, the other one is quantity variance. Here Price variance, we call it as price variance, but quantity variance, we call it as volume variance. What was the price variance formula then? Standard price minus actual price into actual quantity. Ditto here. How much we thought, at what we sold, and what is the actual quantity. Okay, sir. Which is favorable, which is unfavorable? If the actual price is greater than standard price, in cost it used to be adverse because you used to pay more. Here you are going to receive more, which means it is favorable. If the selling price is, standard price is greater than the actual price, it is adverse. It is adverse. That is your sales price variance. Coming to sales volume variance, there what we used to do, we used to take standard quantity minus actual quantity into standard price. No, here also same thing. How much we thought of selling, how much we actually sold. There, sir, there, if the standard was greater than actual, it used to be favorable. But here, if the actual is greater than standard, it will be favorable because the more and more unit you sell, it is better to you. Okay, sir, got it. Now, volume variance further could be divided into mix variance, quantity variance. Quantity variance is nothing but yield variance. Mix variance, what we used to do? RSH, that is revised standard quantity, RSQ minus AQ, actual quantity, correct? Into standard rate. That is here also again, if the actual quantity is greater than revised standard quantity, it is favorable. If the actual quantity is less than revised standard quantity, it is adverse. Here it is RSQ minus standard quantity into standard rate. Here also, if the RSQ is greater than SQ, it is favorable. There it used to be adverse. Here it is favorable. That's it. That is on the basis of value. You can see one example over here. They manufacture and sell how many product? 3 product. It provides the following data. Units sold. Can I tell it as AQ? Yes, sir. Selling price. Selling price. It is budgeted. Based on budgeted. Oh, okay. It is budgeted figure. So it is not a actual quantity. It is standard quantity and it is standard price. This is standard profit. That let it be. That margin we'll discuss later. Going here, actual quantity. Here we have actual quantity. Actual price we don't have directly, but we can compute. How, sir? You paid 14,300. You paid 14,300 for how many units, sir? For 1,100 units. Per unit you paid 13. Next, you paid 17,100 for 1,900 units, which means you paid 9 rupees. You paid 27,000 for 3,000 units. Per unit you paid 9 rupees. Correct. Now calculate the sales price variances, not sales margin variance. Now cost, first let's find out, not cost, first let's find out value. Here it is not cost, here it is value. That is AQ into AP minus SQ into SP. Correct? How much is SP into SQ? First let's calculate. 1,500 into 15. 22,500. 15,000. 1,500 into 8. 12,000. Together it is 34,000. 49,000. 49,000. This is SQ into SP. AQ into AP is how much, sir? AQ into AP is 14,300 plus 17,100 plus 27,000, which is 58,400, which means, try to understand, you estimated your sales to be 49,000, but you are getting 58,400. So 9,400 is the favorable. 9,400 is favorable because you are selling more than what you estimated. Done, sir. This could be divided into two, price and volume. First, price. Price is nothing but actual price minus standard price into actual quantity. So actual price of A was 13, whereas whereas standard price was 15 and actual quantity is 1100. Sir, favorable or adverse, sir? Adverse. Why, sir? You thought you are going to sell it at 15 rupees, but you are selling it just 13 rupees. It is adverse. B, how much, sir? You thought you are, you are selling at 9 rupees, but you thought it is going to be 10 rupees at 1900. So again, 1900 also adverse only. C is how much, sir? You are selling it at 9 rupees, but you thought you are going to sell at 8 rupees. So 3000 units. So it is 3000 favorable because you are selling at a price more than expected. So net you can tell 2200 plus 1900 minus 3000, 1100 adverse. Price variance 1100 adverse. Next, sir. Next, volume variance. Volume variance is nothing but actual quantity minus standard quantity into standard price. A. How much is actual quantity? We are selling 1100, but we thought of selling 1500 at the rate of 15. So 400 into 15 is 6000, correct? But it is adverse because you thought of selling 1100, but you were able to sell just you were thought of selling 1500, but you were able to sell 1100, adverse. B, you are selling 1900 where you thought of selling 1500, great. So around 4000 rupees is favorable because you are selling more than what you expected. C, it is you are selling 3000 where you thought of selling 1500 at the rate of 8 rupees. So 1500 into 8 is 12,000. Favorable or adverse, sir? Favorable because you are able to sell twice what you planned. So 16,000, 10,000 is favorable. 10,000 is favorable. Just check whether it matches or no. 1,100 adverse. 1,100 adverse in the price variance. And here it is 10,000. Just let me check one second. 58,400 minus 49,000. 9,400. Okay. Here let me check. 400 into 15. 6,000. 400 into 10. 4,000. 1,500 into 8. 12,000. So around 16,000. 10,000. Here it is 1,100. Give me a second. Check volume variance. Volume variance we are getting 10,000. Volume variance 10,000 favorable, correct? Check once again. 1,500 into 15, 22,500, 1,500, 10, 1,500 to 8, 12,000. So 22,500 plus 15,000 plus 12,000. 49,500. Correct? $49,500, whereas your actual is 14,300 plus 17,100 plus 27,000, 58,400. So 9,400 favorable. Here, if you add these two, you should get same answer, no? But 10,000 is positive and 1,100 is negative. We'll get around 8,900. Here we are missing. Let it be. We'll proceed. Next is on the basis of your volume variance, we can divide it into sales mix variance and sales quantity variance, which is nothing but a yield variance. Mix variance, what is the formula, sir? Mix variance is revised standard quantity minus actual quantity into standard rate. Revised standard quantity is how much? Actual quantity is 1,100, 1,900, 3,000. Total it is 6,000, correct? revised standard quantity, total will be 6,000 only, but in the ratio of this one, which is 1:1:1, that is 2,000, 2,000, 2,000. Okay. So, what is the formula? Here, revised standard quantity for everything is 2,000 only, 2,000, 2,000, 2,000. But when it comes to actual quantity, it is 1,100, 1,900, 3,000, correct? 1,100, 1,900 and 3,000 into standard rate. Standard rate is nothing but 15, 10 and 8. 15, 10, 8. Which is basically here 900 into 15. 13,500. Here it is 100 into 10. 1000. Here it is negative 1000 into 8. 8,000. So try to understand. First one, your new estimation is more than actual. So again it will be adverse only. Second one, again it will be adverse. But third one, it will be favorable because you are able to sell more than what is your new estimation is. So 13,500 plus 1,000, 14,500 minus 8,000. So 6,500 adverse. 6,500 adverse. Mix variance. Yield variance or quantity variance. Sales quantity variance or yield variance is nothing but revised standard quantity minus standard quantity into standard rate. So revised standard quantity is 2,000, 2,000, 2,000. Whereas standard quantity was 1,500, 1,500, 1,500. And rate is 15, 10, 8. So 1,500 into 15, 22,500. 22,500 new standard is greater than old standard, which is adverse. 500 into 10. 500 into, here 500 into 15 is 500 into 15, no? 7,500. Favorable or adverse, sir? Favorable actually. Favorable. Why is it so, sir? Try to understand what is happening. Try to understand what is happening. You are increasing your standard. Based on actual, which means you are trying to sell more, which is favorable in nature. So 7,500 favorable. Next one 5,000 favorable. Next one 500 into 8, 4,000 favorable. Together how much it is, sir? 16,000 favorable. Now if you see, it will be around 9,500 favorable. Correct? Together. This one. So this was about your variances. So 16,500 done. Here you got around mix variance. You got around 6,500 adverse, because of which you got volume variance around 10,000. Correct? Here. This 16,500. So 16,500, 6,500, 10,000 favorable you got. Same thing you got over here also. Okay. Now, sir, on the basis of margin, try to understand. Quantity remains same, people. Quantity remains same, but you are not going to take the price. You are going to take the profit. You are not going to take the price. You are going to take the profit. So sales margin, that is instead of volume we call it as margin, that will be standard quantity into standard profit what we expected minus actual quantity into actual profit. If the actual is more than standard, it is favorable, otherwise it is adverse. Sales margin price variance and sales margin volume variance. Sales margin price variance, sales margin volume variance. Here what we are going to do, sir, here instead of our price, what we used to do, we used to compare actual price with the standard price, multiply by actual quantity. Here also standard profit minus actual profit multiply by actual quantity. Margin volume variance, sir, volume. Standard quantity minus actual quantity into standard profit. Margin mix variance, sir, revised standard quantity minus actual quantity into standard profit. Margin volume variance, revised standard quantity, basically volume, instead of this you can tell it as quantity. Sales margin quantity variance. Margin here, not sales value, margin, which means profit. So revised standard quantity minus standard quantity into standard price, all other thing remains same. See here, they have given budgeted here. Standard margin here only they have given. This is nothing but SP. This is nothing but SP. So how much is standard cost? 15 rupees. They are expecting profit to be 8 rupees, which means cost is 7 rupees. 10 rupees, they are estimating 5 rupees, which means cost is 5 rupees. 8 rupees, they are estimating 2 rupees, which means cost is 6 rupees. Here, actual price was how much, sir? Actual price what we are charging to customer, 9,600 divided by 800, rupees 12. This is actual price. Okay, this is actual, not actual profit, actual price. And 10,800 divided by 1,200, which will come to rupees 9, and 1,500, 13,500 divided by 1,500, which will come to again 9. Okay, have they given a cost information? The answer is no, sir, they haven't given cost information. So we are going to consider standard cost as the cost for computation of actual profit. So actual profit will be how much, sir? 12 minus 7, 5, 9 minus 5, 4, 9 minus 6, 3. So first one is what, sir? First one is sales margin profit. Sales margin profit or sales margin price variance. How much it would be? Or volume variance? How much it would be? Sales margin, total margin variance. How much you estimated? How much you estimated your margin to be? 1,000 into 8, 1,000 into 5, 1,000 into 2. Correct? You estimated 8,000, 5,000, 2,000, 15,000. How much you are actually getting? You are actually making 800 into 5, 1,200 into 4, 1,500 into 3. So it is 8,000 minus 4,000, which is 4,000. You thought it would be more, so it's a adverse. Yes, sir, it's a adverse. Done. Next one, sir. 5,000 minus 4,800, again 200, adverse, because you thought you are going to make more profit. You estimated profit to be 2,000, but you are getting it as a 1,500 into 3, 4,500, 2,500 favorable, because you are making more profit than estimated. So 4,200 minus 2,500, 1,700 adverse. 1,700 adverse. Done. This is your profit margin variance. This could be divided into two. One is One is margin price variance, the other one is margin quantity variance or margin volume variance. So margin price variance will be what, sir? Margin price variance will be, people, margin price variance will be standard profit minus actual profit into actual quantity. In case of A, it is standard profit estimated was 8 rupees. Yes, sir. Actual profit you are getting is 5 rupees. And actual quantity is 800. So 800 into 3, 2400. Adverse or favorable, sir? Uh, 800 into 3, adverse or favorable, sir? It's a adverse because your estimated profit was more. Done. Next one. Your estimated profit is how much, sir? Your estimated profit is 5. Actual profit is how much, sir? 4. 5 minus 4 into actual quantity is how much, sir? 1200. So 1200. Adverse or favorable, sir? Adverse. Adverse or favorable? Adverse. Next. Your estimated was how much, sir? 2. How much you are getting actually? 3. 2 minus 3 and actual quantity is how much? 1500. 1500. So it will be 1500 favorable. Correct? So 2100 adverse. 2100 adverse price. Next is what, sir? Next is volume variance. Volume is how much? Standard quantity minus actual quantity into standard profit. So A, standard quantity was 1000, correct? Standard quantity was 1000, actual is 800 into standard profit estimated is 8. So you are selling 200 unit less than estimated. So it's adverse. How much, sir? 200 into 8, 1600 adverse. Next, B. You estimated to sell 1000. You sold 1200. Estimated profit was 5. So 1000 rupees favorable because you are selling 200 more. C. Estimated to sell 1000. You are selling 1500. Great. And 2 rupees is the margin you estimated. 1000 rupees favorable. Net you can tell 400 favorable. 400 favorable. Now you can see here 400 favorable. Here 2100 adverse. 1600 should be adverse. Sorry, 1700 should be adverse. Yes, 1700 is adverse. Further, this volume could be divided into mix and quantity. So mix and quantity. Let's do mix and quantity. Sales mix margin mix variance. Sales margin mix variance profit wise. There is revised standard quantity minus actual quantity into standard price. Revised standard quantity, the other question we did know, revised standard quantity was supposed to be 2000. Actual was 2000, no? Revised standard quantity somewhere we did here. 2000 each, I feel. Yeah, 2000 each. So, yeah, 2000 each. So here it will be 2000, 2000, 2000 minus actual quantity is 800, 1200, 1500. 800 give me a question. I think your total quantity is changing. Give me a second. Give me, yeah, total quantity is changing. You can't take that as a RSQ. RSQ is changing. RSQ is changing. I will tell how much. 800, 1200, 1500, which will come to 4500. RSQ is 1500, 1500, 1500 in the ratio of standard. 4500 you should divide in the ratio of standard, which is 1:1:1 again. The ratio didn't change, but the amounts has changed. So it is 1500, 1500, 1500. Here it is 3000 and 2500. No, wait. 2000, it is 3500. Sorry. RSQ is changing. Give me a second. RSQ I will compute. 800 plus 1200, 2000, 3500, not 4500. 3,500. Now I'm going to divide this 3,500 in the ratio of 1:1:1. That is 1166, 1166, 1167. Let's take, I mean, or 66 only you take, no worries. So I'm going to take that one. 1166, 1166, 1166. Here it is 1,500. Done. Into standard profit, estimated profit is 8, 5 and 2. 8, 5, 2. 1166 minus 800 into 8. 2928. Adverse or favorable, sir? Adverse or favorable? It is adverse because your standard is 1166 into 1200. Sorry, 1166 minus 1200 into 5. 170. Adverse or favorable, sir? Favorable. Because your actual is more. 1166 minus 1500 into 2 is 668. Adverse or favorable, sir? Favorable. Net how much, sir? 170 plus 668 minus 2928. 2090 adverse. 2090 adverse. Next is sales quantity margin variance. That is nothing but RSQ minus SQ. RSQ minus SQ into standard price or standard profit here. So RSQ is how much, sir? 1166, 1166, 1166. Standard quantity is 1000, 1000, 1000. Standard price is profit expected is 8, 5 and 2. So 1166 minus 1000. 166, correct, into 8. 1328. We are expecting or we are increasing our standard, which is favorable. 1328 favorable. Next one, divided by 8 into 5. 830 favorable. One divided by 5. 332 favorable. Total it is 1328 plus 830 plus 332. 2490 favorable. So 2490 favorable, 2090 adverse, which means 400 favorable. Somewhere we computed 400 favorable. With this, your margin variance is also done. Hope you guys understood. So with that, even standard costing chapter is also done. With that, standard costing chapter is also done. The remaining questions we might discuss based on the time availability. Okay, we'll go to different chapters, and if time is available, later we'll come back to this particular chapter again. Okay. Yes. Now it is next section relating to forecasting, budgeting and budget. Correct? Forecasting, budgeting and budgetary control. Sir, what is it, sir? Again, this is also technique of cost control. Okay, this is not the method, this is a technique. What do you mean by forecasting, sir? We are estimating what might happen in future. We are trying to get a data regarding what might happen in future. That is forecasting. That is forecasting. What is budgeting, sir? Setting a quantitative standards or setting a quantitative standards or limits for the to the cost, to the sales, giving certain targets, quantitative in nature, not qualitative in numbers. Quantitative we are going to give based on the forecasted information. Okay, that setting standards is known as budgeting. That is using a forecast, how much my sales should be, how much my cost should be, how much my profit should be. Like this, we are going to give a target. That is budgeting. Remember one thing, budgeting starts where forecasting stops. That is, once you estimate now, yes sir, we estimate. After estimating, we are going to use that estimated data to set a standard data. That is your budgeting. Now after that, you keep checking what is your actual performance, what is your budgeted performance. What is your actual performance, what is your budgeted performance, and taking the corrective actions when and where necessary, when it is required. That is your budgetary control. That is your budgetary control. Okay. And the person who takes care of the budgets is known as budget controller. Usually budget controller will be CEO of the company, or CEO will give that work, or CEO will delegate that work to someone else. Okay. What are the different features, sir? Features are, it is financial or quantitative statement. Okay. It won't be having any qualitative information. It will be purely quantitative. How much sales I should make, how much purchase cost it should be, how much labor cost it will be, like that. And it is futuristic. You are going to prepare it for a future period, not for the past. Goal oriented. That is, it will expect you guys to achieve it. It will be having some objective, and it will be having different components like income, expenditure, capital, etc. Okay. So these are the certain aspects. What is budget center, sir? A section of the organization which are into the purpose of budgetary control. A group, a department in the organization which are into that budget controlling, those are known as budget center. What is budget committee? The committee which set the standards, budgets, and the person who controls it is known as budget controller. Who is budget officer, sir? Usually the senior member of the organization. He don't prepare the budget himself, but he coordinates the budgeting activity, and he ensures that decisions are communicated properly to the people. Basically, he works as a coordinator. Budget manual is manual regarding how the budget should be. Okay. Budget period is that budget, for example, sales for next 3 months. Then that 3 months is a budget period. Okay. So these are the certain things you have to keep in budget. You can classify the budget on 3 bases. This is important. You can classify the budget on 3 bases: on the basis of nature, on the basis of content, on the basis of functional aspect or functional budgets. On the basis of nature, it can be divided into 2: fixed budget, flexible budget. For example, my capacity is 10,000 units. My capacity is 10,000 units. Now I'm operating at 70%. Now if I prepare budget for 80%, it's not going to change. It's not going to change on my actual figures or my performance. It will be 80% only. Material cost for 80% how much, labor cost for 80% how much, revenue 80% how much, variable overhead how much for 80%, fixed overhead how much, everything will be for 80%. You can't change it. That is your fixed budget. That is, it will be, budget will be calculated for particular limit or particular level of activity, and it will be stagnant. It's not going to change. Flexible means, now for 80% I calculated, now this can be converted into 70% if you want, this can be converted into 60%, this can be converted into 90%, which means flexible. If you want to check for the other level of activity, you can check it. Sir, but why, sir? Try to understand. In fixed, we are not going to divide the expenses on the basis of variable, fixed. We are going to keep it general. But in flexible budget, what we will do is, fixed expense will take, semi-variable cost we are going to divide between fixed cost and variable cost and variable. Now variable will vary with the level, whereas fixed will not vary with the level. That's what we are going to do. So basically, in flexible budget, what is the important factor, sir? Flexible budget important factor is dividing variable cost and fixed costs. On the basis of content, you can tell it as in monetary terms, in physical terms. For example, sales budget. I have to sell 10,000 units in January, 20,000 units in February, 30,000 units in March. Now, this is unit based, quantity based. Now, I want to make 1 lakh rupees sale in January, 2 lakh rupees sale in February, 3 lakh rupees sale in March. Like this, then it is in monetary terms. Okay. Functional basis, sales budget. Sales budget. That is how many units, how much units I have to sell. What should be my sales value? Purchase budget. When I should purchase. At what rate I should purchase. Production budget. How many units to produce in which period? Production cost budget, that is your material budget, labor budget, factory overhead. That is how much material I should incur per unit. How much material should be consumed in which month? What should be the price of purchase of such material? Labor, how much labor I should use? Factory overhead, administration overhead, selling, like this. These are the few expenses we are trying to find out how much it should be. Okay. Cash budget means we are keeping, if we keep extra cash, that will be idle. If we invest everything, then you are in a risky situation. So you are going to fix one level of cash. So much I will keep always. So over and above this, what I should do? When the cash should receive, all those things we are going to see in the cash budget. When we see the example illustrations, you will understand all those things. Straight away jumping into illustration. See here. Draw up a flexible budget for the overhead expense on the basis of the following data and determine the overhead rate for 70%, 80%, 90%. Now try to understand. They have given it a 80%. They are asking you for 70% and 90%. So what you are going to do, sir, or how it is done, sir? See here, these are variable, which means directly varies with the level. So listen here, this is for 70, this is for 90. Anyhow, 80 it's there. For 80 it is 12,000. For 80 it is 12,000. Correct? For 80 it is 12,000. For 70 how much? 12,000 divided by 80 into 70. 10,500. For 90 how much it is? 13,500. Correct? 12,000 for 80. For 90 how much? 12,000 divided by 80 into 90, 13,500. 4,000 for 80, for 7,000 it will be 3,500, for 9,000 it will be 4,500. Then these are variable. Semi-variable means what, sir? It will include both variable as well as fixed portion. So try to understand. There is 20,000 and 2,000. Correct? This I am going to divide between variable and fixed, variable and fixed. Try to understand. Power, 30% is fixed in it, 70% is variable. 30% is 6,000. Yes, it is fixed. Variable is how much, sir? 14,000. Done. Repair, 60% is fixed. 1,200 is fixed and 800 is variable. 800 is variable. So try to understand power, what is happening. 14,000 for 80%, because that varies, no? So variable I will take. 14% for 80%. For 70, how much it will be? It will be 12,250. So variable cost is 12,250 plus fixed won't change along with the level. So it will be 6,000 only. So it will be 18,250 for 70%. Okay. Next. For 90. Try to understand. 14,000 for 80%. For 90% how much? It will be 15,750 variable. To this add the fixed of 6,000, which will come to 21,750. Will come to 21,750. Now going to repairs. 800 is variable. 800 is variable for 80%. For 70% how much it would be? 700 plus fixed of 1,200. Fixed of 1,200, which is 1,900. Next, 800 for 80. For 90 how much it will be? 900. 900 plus 1,200, 2,100. 2,100. What do you mean by semi-variable, sir? Semi-variable is nothing but it will have both fixed as well as variable in it. Now, sir, if we don't know how much is fixed, how much is variable, what we should do, sir? Change in cost will be relating to change in cost will be completely relating to variable only. That we will divide by change in units. So we'll get to know how much is variable cost per unit. Simple. Once we get a variable cost per unit, then all other things will be easy. Here fixed cost, it will be 11,000 only for all the 3 levels. Insurance 3,000 only for all the 3 levels. This will be 10,000 only for all the 3 levels. Total overhead they are telling. Here it is 62,000 for 80%. For 70% it will be 10,500 plus 3,500 plus 18,250 plus 1,900 plus 11,000 plus 3,000 plus 10,000, which will be 58,150. 13,500 plus 4,500 plus 21,750 plus 2,100 plus 11,000 plus 3,000 plus 10,000, which is 65,850. Correct? Estimated labor hour is around 124,000. Now if you divide that with 150,000, labor hours also will change, no? Because now try to understand. At 80%, if you are operating at 124,000, so at 70%, you will operate at 108,500. At 90%, you will operate at 124,000 divided by 80 into 90. You will operate at 139,500. Now, rate, how to calculate, sir? Overhead rate, very simple. First one, it is 62,000 total overhead divided by 124,000, rupees 0.5 per hour. Second, it is 58,150 divided by 108,500, which will come to 0.53 or 54 per hour. Sir, why it is increasing? Because of the fixed. I told you already. The less and less the production, the more and more the cost per unit fixed. The more and more, less and less. Correct? So here it is decreasing, no, 70% means, that's why. Now it is 65,850 divided by 139,500. It will be 0.47 because the unit is increasing, which means fixed cost per unit will decrease. That's how you are going to do it. You can see here. Hope you people understood this particular thing. See here, they have given few sales budget also. Illustration number 2, concentrate here. XYZ Limited produces 2 product X and Y. They are into production of 2 product X and Y. Operates in 3 sales division. Okay. Prepare a sales budget for the 6 month from the following information. Product X, there are 3 division, division 1, division 2, division 3. Okay. So, last year sales budget they have given. Last year sales budget they have given, or last half year sales budget they have given. 1,600 units we plan to sell. Product X in division 1, 2,400 in division 2, 2,400 in division 3 at the rate of 10, 10 and 10. Product Y, 800 in division 1, division 2, 4,800, division 3, 2,000 at the rate of 9, 9 and 9. But actually, we sold 2,000, 3,200 and 2,800 at the budgeted rate itself. Whereas product Y, we sold 400, 4,000 and 1,600. Okay. In the management meeting, following decisions have been taken. What is it, sir? The price of the product X should be increased by ₹1 as there is a high demand. So we have to add ₹1 to our price. So it won't be 10 rupees anymore. It will be 11 rupees. Product Y is not selling at the expected rate as it is overpriced. However, if the selling price is reduced by 1, it is expected that market would pick up. Therefore, divisional sales manager has made the following estimate. So we are planning to reduce it by ₹1. Which one? Product Y's selling price. Percentage increase over the previous budgeted figures. Previous budgeted figures, not actual figures. Okay. Product X, division 1, we are assuming our sales will go plus 20%. Last time we estimated 1,600. This time 1,600 plus 20%, which is 1,920 units. Done. Division to 30% increase we are expecting 2400 plus 720, it should be 2400 plus 30%, 3120. We are expecting it to go by 3120 and price will be 11. Okay, price will be 11 in all the three situations. Next, 2400 plus how many percentage increase we are expecting? 10%. We are expecting 10% increase. That is 2640 units. Coming to product Y. We are increasing 5%, expecting increase of 5%, 800 plus 5%, 840. Second one, 4800 plus 5%, 5040. Third one, 2000 plus 5%, 2100. Units wise. Price wise it will be 8, 8 and 8. So you have to give that itself. Here 11 and 8. This is for the period. No, this is for budget and actual. This data if you want you can give, otherwise you can ignore and you can give only this. No worries, you can give only these factors. Okay, 11 8 11 8 11 8 11 8 11 8. Quantity will be 1920 3120 2640, 1920 3120 2640. Y will be 840 5040 2100, 840 Y 4800 plus 10%, 4800 plus 10%, which will come to 5280. Sorry, it is 5280. Next one is 2000 plus 8%, 2000 plus 8%, which is 2160. Sorry, 2160. So 2160 5280. So we are going to multiply, we are going to get this. This is your sales budget. Okay, production budget is all about how much to produce. How much to produce? Very simple. Basic for any functional budget is sales budget. That is, based on the sales, we'll try to get a information regarding how much to be produced. Based on the how much to be produced, we will get a information regarding consumption. Based on the consumption, we'll get a information regarding how much to purchase, because opening stock, closing stock things also will be there. No, that's why. So base is always and always remember it is sales budget. It is sales budget. You should exactly know how much you are going to produce. How you are going to find, sir? I have to sell certain number of units and also I am planning to keep some closing stock. So I will find out how much unit I need in that particular period. Units needed. However, there will be opening stock also, no? So that we will reduce. Then we will get to know how much to be produced. Now to produce, we are going to find out how much is the requirement of raw material. Based on the requirement, we are going to check how much opening stock is available. Correct? So, and also how much we are planning to keep the closing stock. So basically, requirement plus closing stock is what is required in that period. From that, if you reduce the opening stock, you will get to know how much to be purchased. This is all about your other budgets. We'll do one thing, don't worry. We'll look at the questions. You will get a clear picture of it. Okay. And there is a master budget and all. I will explain that. Master budget is nothing but basically you are like a P&L. It will consist of everything. Now only production will do, only sales will do, only purchase will do. No. But master budget is something like consist of everything. It will consist of income. From that we will reduce expense. It will show the budgeted profit also. That is the master budget meaning. All those things we will see. Don't worry. Yeah. Yes. Now look into this particular question, illustration number 3. Okay. From the following information, prepare a production budget for ABC Co Limited, assuming that there is no loss in the production. So there is no loss in the production. So whatever input is going, that is coming as an output. There is no loss in between. Okay, sir. Normal loss in production is 5% and 10% for the product X and Y. So abnormal loss is not there, but normal loss is estimated as 5% and 10%. Now, sales budget tells that in division 1, we are planning to sell 2000 units of X and 1000 unit of Y. Division 2, 3000, 6000. Division 3, 2500, 2250. Total 7500, 9250. Opening stock and closing stock of products they have given. Stock on 31st December estimated to be 10% more in quantity. So whatever you had in opening, you are expecting it to be more than that. So they are asking you how many units to be produced. Try to understand. First, let's go to product X. Okay. Opening how much, sir? Opening is 1500. Correct. During the year we want to sell 7500. Also we want to keep the stock of 1650. We want to keep the stock of 1650. Okay. So how many units do we need? How many units do we need? We need 7500 units to sell, 1650 units as a closing, which means we need almost 1650 plus 7500, which is 9150 units. Okay. Everything to be produced during the year, sir? The answer is no, because there is an opening stock of 1500, which means stock is already available with us to some extent. Okay. That is 9150 minus 1500, which will come to 7650. We want a final product of 7650. Okay. Next, Y we have a opening of 2000. Great. So we are planning to sell 9250 units. We are planning to sell 9250 units, and we are planning to keep the closing stock of 2200 plus 10%, 2200. So net we need how many units, sir? We need 9250 plus 2200, 11450. So sir, we have to produce 11450. The answer is no. Why, sir? Because 11450 is what we need. Opening already we have 2000 in this. So net we have to produce 9450. We have to produce 9450. Hope it is clear. This is when there is no loss. Now when there is a loss, sir, when there is a loss, then try to understand. In first case, we got to know that we have to produce 7650. Finally, we are planning to final product. After loss, everything we need 7650. So let's say units to be produced as X. Units to be produced as X minus whatever unit you are producing, in that 5% is loss. So 0.05x, which means 0.95x is equal to 7650. X is equal to 7650 divided by 0.95, which will come to 8053 almost. So you have to produce almost 8053 units to make sure net you will be getting final product of 7650. Coming to product Y, let's say units to be produced as Y. From the Y, around 10% will go as a loss, and final product you need is around 9450. Correct? Now 0.9y is equal to 9450. Y is equal to 9450 divided by 0.9, which will come to 10,500. So we have to produce 10,500 units in the second scenario. Okay. Hope it is clear. Now, next illustration is based on purchase budget or direct material budget. Concentrate. From the following figures, prepare the raw material purchase budget for the January 2021. Okay. They have estimated stock of so much. Opening is this, closing is this. Estimated opening stock is this, estimated closing stock is there. Estimated consumption they have given, standard price they have given. Okay. So they are asking you to prepare a raw material purchase budget. So try to understand. your closing stock and your consumption. That is what we needed in that particular period, correct? For example, material A. For the January month, to consume we need 120,000. Okay, sir. To consume we need 120,000. Also, as a closing we are planning to keep 20,000. Net we need around 140,000. That is closing stock plus consumption. So, everything to be purchased, sir? The answer is no. Why? Already there is 16,000. So, reduce the opening stock. Reduce the opening stock. So, 120,000 minus 16,000 will come to 104,000. This is units to be purchased. In units. Units, okay. Purchase cost is how much, sir? In rupees, 104,000 into 0.25, which will come to 26,000. Okay. Coming to the second one. You need around 44,000 plus 8,000, 52,000, but you already have a 6,000 with you, which means you have to purchase just 46,000. So 46,000 into 0.05. 2,300. 2,300. Okay. Now, third scenario. 132,000 is what you need to consume and 28,000 is what you are planning to keep, which means around 160,000. But you have 24,000 with you already, which means around 136,000 is what you are planning to purchase. So 136,000 into 0.15, 20,400. 20,400. Next one, you are consuming 36,000 and you are planning to keep 4,000. Net you need 40,000 units. However, as a opening you have 2,000, which means around 38,000 will be your purchase at 10 paisa, which means 3,800. Here you are planning to keep 16,000 stock, 88,000 consumption, which is basically 104,000. Already we have 14,000, which means you have to purchase just 90,000 at the rate of 20 paise, so 18,000. Okay. Next one, sir. Closing you estimated is 32 and you actually have to consume 172,000, planning to consume. So net you are planning for 204,000. In that 28,000 is 176,000. This is what you are planning to purchase at the rate of 0.3. 52,800. This is your purchase budget for the period. Hope it is clear. Done. Going to the labor, sir. Direct labor budget. A factory works 8 hours per day. Great. 6 days in a week. Fine. And a budgeted period is 1 year. During each quarter, last hours due to leave, holiday and other causes estimated to be 124 hours. So during the quarter, your estimated loss is how much? 124 hours. So generally how much it is, sir, in a quarter? In a quarter it will be, a factory works 8 hours per day. Okay. 6 days in a week. Okay. And how many weeks we estimated in a year? 52 weeks. So 8 into 6 into 52. Around 2,496 hours is what we are expecting in a year. If you divide 2,496 by 4 per quarter, you are estimating it to be 624. In that they are telling 124 is a loss. Net you are anticipating around 500 hours per quarter, or per annum you can tell around 1,000 hours. Okay. Product A, product B. Direct labor per unit. To produce product A, you need 2 hours in the department P, 1 hour in the department Q. And how many units you are producing, sir? 10,000 units. Sir, labor can you stock? The answer is No, you can't stock the labor hours, correct? So there is no opening and closing stock here. You can't stock the labor hours. It's a service. So 2 hours and 1 hour, you need almost around 3 hours, correct? You almost need 3 hours, or you can tell in precise. Uh, Department P's we need around 20,000 hours. Okay. Department Q's we need around 10,000 hours. Rate is 1 and 3. Okay. Next one. Product B. 1 hour in department P, which is 4,000 hours, and 1 hour in department Q, which is 4,000 hours. Done. Required. Prepare a manpower budget. That is, what is the requirement? That itself, right? That is, department P we need 24,000. Department Q you need 14,000. So 24,000 and 14,000. So done. Next. Showing a direct labor hour and number of workers. So try to understand. Hours during budgeted hour. Hours during budgeted period. How much you are expecting, sir? Look into the notes. Budgeted working is 8 into 6 into 52, correct? Minus 124 into 4. Basically, in a year, how much we are estimating, sir? In a year, 500 into 4, 2000 hours we are estimating, correct? 2000 hours. Here we need 14,000, 2000. So in department P, overall in a year, we need 24,000 hours of labor. Each and every labor will give you 2000 hours. How many workers you need? You need 12 workers. In this scenario, around 14,000 hours of Q is required in a year, whereas the labors will be giving us 2000 hours. So how many employees? 7 employees is required. Next, what they are asking, sir? Manpower budget showing labor cost. So all you have to do is just multiply those hours with 1 and 3, 2 and 3. See here. For product A, department P, 20,000 hours is required, rate is 1. For product B, 4,000 hours, rate is 2. Done. Department Q, 10,000, 4,000, 3 and 3. Okay. This is what it is all about. Simple. Whatever data they have given, all you have to do is you have to just segregate it in a kind of format. That's it. Nothing else. Okay. Next we will go to the next one. That is illustration number 6. Yes. Now look into this. The budget manager of Y Limited is preparing a budget for accounting year starting from 1st April 2022. So budget manager is preparing a budget for accounting year 1st April 2022. Okay. As a part of the budget operation, some item of factory overhead have been estimated by him under the specified condition of volume is as follows. Under 60,000 volume, under 75,000 volume. Done. Now, indirect material is estimating. You are required to calculate the cost of factory overhead item for the 80,000 units. They are asking for 80,000, how much it would be. Try to understand. Indirect labor, it will be 132 when it is 60, which means 2.2 per unit. It will be 165 when it is 75. 165 when it is 75. 2.2, which means it is varying at the same rate, which means it is a variable. So what I am going to do, 80,000 into 2.2, around it will be 176,000. Indirect material is 176,000. Going to the next one, indirect labor, 75 when it is 60, that is 1.25, and 93,750 when it is 75,000, which is 1.25, correct? So 75 when it is 60 also 1.25. It is also completely variable in nature. So 80,000 into 1.25, which will come to 1 lakh. Which will come to 1 lakh. Now going to the maintenance. See there, 42,000 it was when it was 60,000, which means 0.7 per unit. It is 51,000 when it was 75,000 unit, 0.68. It is not varying at the same rate, which means it is not completely variable cost. If it was completely variable cost, then it would have included a variable, like if it's reducing, then it includes fixed cost also, because fixed cost is the one which reduces as more and more product we will produce. In this scenario, what we call it as, sir, semi-variable. Semi-variable, how to segregate, sir? Pretty simple, people. See here, when it was 75,000, when it was 60,000, it was 42,000. Yes, sir. When it became 75,000, it became 51,000, which means one thing is pretty simple. Along with the units, whatever varies, that is nothing but a variable cost. Variable cost. So we know the total variable cost for changed units. That is, see here, 51,000 it was and 42,000. Correct? Divided by 75,000 units and 60,000 units. What do you mean by this, sir? This means the cost is changing by 9,000 when you produce 15,000 units, which means variable cost per unit is how much, sir? 9 divided by 15, which is 0.6 per unit. So variable cost is 0.6 per unit. Either you can take 42,000 or 51,000 now. This total cost, no? Let's say 42,000. So when you got 42,000, when you multiplied 60,000 into 0.6, this is total variable cost plus fixed cost, which I am taking it as F, will come to 42,000. So F will be how much, sir? 42,000 minus 60,000 into 0.6, 36,000. So F is equal to rupees 6,000. So fixed cost is 6,000. So now for the 80,000 units, variable cost is 0.6, 48,000 plus 6,000 is fixed cost, which will come to 54,000. So for 80,000 units, maintenance is 54,000. Going to supervision now. Try to understand. Let's check whether it's a variable or what. 99,000 divided by 60,000, 1.65. 117,000 divided by 75,000, 1.56. Moral of the story is, it is not varying at the same rate, so it is not only variable, it will include fixed cost also. Now we have to segregate it. How to segregate, sir? Change in expense, as I already explained you guys, which is 18,000, is a result of change in output, correct? Because variable cost. Change in expense happens only because of variable cost. Divided by change in output, which is 15,000. So 18,000 is for 15,000, that is 18 divided by 15. Rupees 1.2 per unit is a variable cost. Now either take this level or this level. Let's take 117. Now when 117 will come, when you produce 75,000 units at the variable cost of 1.2 plus some fixed cost will be there, because of which the total cost will be 117,000. Now 75,000 into 1.2, which is 90,000, will go that side. It will become 117,000. It will become 27,000. Correct? Fixed cost is 27,000. So now supervision, try to understand. Variable cost is 1.2. So 75,000 into 1.2, 90,000 plus fixed cost of 27,000, which will come to 117. 80,000. No? So 80,000 into 1.2, which will come to 96,000 plus 27,000, 123,000. So supervision is 123,000. Done. Engineering service, sir, for both the levels 47. Moral of the story, for this also 47, as it is a fixed in nature. So total overhead is how much? Total overhead is 176,000 plus 1 lakh plus 54,000 plus 123,000 plus 47,000, 5 lakh. Total overhead is 5 lakh. Total overhead is 5 lakh. Hope it is clear. Look at this one. You are required to prepare a selling overhead budget from the estimate given below. Advertisement rupees 1000. Salaries to the sales department 1000. Expenses it is fixed completely 750. Salesman remuneration 3000. Great. Salesman and DA allowance commission is 1% on sales excluding agents sales. So other than agent sale, whatever the actual sale is there, no, on that 1% is the salesman's commission. Okay. Carriage outward is 5% on sales. Agent's commission 7.5% on agent's sale. So sales during the period were estimated as follows. They have given three things. You have to estimate for different things. First one, let's say 80,000 is the sales they are telling. Correct? This could be divided into two parts. Agent sale, normal sale. Normal sale, agent's sale. Normal sale is how much, sir? Agent sale is 8,000. So normal sale will be 72,000. Correct. Now try to understand all these things are fixed in nature. Correct? All these things are fixed in nature together. How much it is? 5,750. Done. 5,750. Either you make a sale of 80,000, either you make a sale of 90,000, either you make a sale of 1 lakh. It will be 5,750 only for all the three situations. Okay. Now coming to salesman's DA and commission is 1% on sales excluding agent sale. That is 72,000 into 1%. That is 720. That is 720. Done, sir. Next. Carriage outward is 5% on sale. Carriage outward is 5% on sale. That is 72,000 into 5%, which is 3,600. 3,600. Done. And agent's commission is 7.5% on agent sale. So 8,000 into 7.5%, which is 600. Together it is 720 plus 3,600 plus 600, which is 4,920. Which is 4,920. Salesman commission was 720. Yes. Agent's commission was 600. Yes. Carriage outward was how much, sir? Carriage outward. Okay, carriage outward we calculated only to this. We have to calculate for this thing also, no? So carriage outward is 5% of this. So 80,000 into 5%. 4,000. Carriage outward is 4,000. You will get a total of 5320 as this one, and this will be 11,070. Going to the next, that is 90,000 sale. 90,000 sale, out of which agent's commission is 10%, or agent's sale is 10,000. So try to understand 90,000. I am going to divide it into two parts. 10,000 agent sale, 80,000 normal sale. Now this thing remains same, 5,750 only, no doubt in that for both the situation, this only. But when it comes to salesman's DA, 1% on sales excluding agent sale. So on this 80,000, 1%, which is 800. Okay, this commission. Next, carriage outward 5% it is. So it will be around carriage outward will be for both. No, carriage outward will be for both. So 90,000 into 5%, which will come to around 4,500. Correct. Next, agents commission 7.5% on agents, which is 750. Correct. Which is 750. Now how much will be the expense, sir? 4,500 plus 1,550, which will come to 1,550 plus 4,500, 6,050. 6,050, 11,800. Now going to 1 lakh sales. 1 lakh sales. 1 lakh could be split into 89,500, 10,500. Correct? It could be split into 89,500 and 10,500. Now this 89,500 on this we have to give a commission of 1%, which is 895. On this 10,000 it is 10,500 into 7.5 percentage, 787.5. okay, and here we have to give a 5% carriage outward, so which is 5,000. Net total expense will be 895 plus 787.5 plus 5,000, which will come to 6682.5, which is 6683. Simple question. What is master budget, sir? It consists of everything, correct? It consists of each and every aspect, like a P&L only, but estimated P&L. So much you can keep in mind. Master budget is which is the collaboration of all the budgets. Prepare a cash budget for 3 months ending on 30th June 2022 from the information given below. So February, March, April, May, June, sales they have given, materials they have given, wages they have given, overheads they have given. Credit terms. Sales or debtors. 10% sales on cash, 50% of the credit sale or 50% of credit sale are collected in the next month and a balance in the following month, remaining 50% in following month. Creditors, they are giving 2 months period for the material, 1/4 in the following month, wages, overhead half in the following month, which means remaining things you have to pay immediately. Done. Cash and bank balance as is expected to be 6,000. That is 1st April. Opening is 6,000. Great. Other relevant. Plant and machinery will be installed in February at a cost of 96,000. When it is installed? February, which means for which we are doing 3 months ending 30th June, which means June, May, April. So this installation is happening in Feb. It won't come under cash budget. The monthly installment of 2,000 is payable from April. So this will come. This is coming as an outflow. Dividend at 5% on preference share capital of 2 lakh will be paid on 1st June. This will also come as how much, sir? 2 lakh into 5%, which will come to 2 lakh into 5%, which will come to 10,000. Advance to be received for sale of vehicle 9,000. So this will also be coming as a inflow, whereas this was outflow. This is inflow. Dividend from investment amount 1,000 are expected to be received in June. This is also inflow 1,000. Now listen here. Opening balance was how much, sir? Opening balance was 6,000. Now cash sale, what they are telling? Cash sales, they are telling 10% is a cash sale. 10% is a cash sale. So out of this 16,000, we are going to collect 1,600. And also they are telling credit sale collected in the half of that is collected in the next month, balance in the following month. Try to understand. February month, 10% of this 1,400 was cash sale. Correct? Which means 12,600 was credit sale. In this 12,600, 6,300 is collected in the month of March, 6,300 is collected in the month of April. 6,300 collected in the month of April. So revenue you can tell it as 6,300 plus 1,600, which will come to 7,900. Will tell 7,900. Correct? 7,900. March month, you are making a sale of 15,000. In that 1,500 is what, sir? In that 1,500 is credit sale, sorry, cash sale, which means around 13,500 is a credit sale. Now in this 13,500, in the month of April, we are going to receive how much? We are going to receive half of this, that is around 6,750. 6,750. So much is what we received in the month of April, that is 6750 plus 6,300 plus 1,600, 14,650. 14,650. Going to the month of May. Try to understand. May, whatever February was there, we received in the March, April. So February thing is gone now. Now only March, April and May thing will be there in the May. Try to understand. In May, 1,700 is a cash sale. Correct? Now, March month we sold 15,000, which means in that 13,500 was credit sale. In that 6,750 was collected when? In the month of April, which means other 6,750 is collected in the month of May. Correct? Okay. Also, April month sale, 1,600 it was. In that 16,000 it was. In that 1,600 was cash sale. Remaining 14,400 was credit. In the 14,400, in May month, we are going to receive half, 7,200. Other half will be received in the month of June. So how much we are receiving in the month of May? 7,200 plus 6,750 plus 1,700. 15,650. 1,700 plus 13,950. 15,650. Done. Now going to June. So February month we paid in March and April. March month we paid in April and May. Now April months 1,600 was cash sale. Yes sir. 14,400 was credit sale. In that 7,200 is paid in the month of May. Remaining 7,200 will be paid in the month of June. Great. Here 1,700 was cash sale, which means credit sale was 15,300. So in this around half, that is 7,650. 7,650 will be in the month of June. So in the month of June it is 7,650 plus 7,200 plus 1,800, which will come to 16,650. That is 1,800 plus 14,850. 16,650. Done, sir. What else is there? Sales is done. Going to the materials. Materials, what they are telling? Creditors, materials 2 months, which means February month you are paying in the month of April. So in the month of April, payment is 9,600. March you are paying in June. April you are paying in March you are paying in May, that is April and May. April you are paying in June. So 9,600, 9,000, 9,200. 9,600, 9,000, 9,200. Okay, sir. Done. Next, what information they have given? Wages 1/4 in the following month. So try to understand. February month, 3/4 will be paid in February. Remaining 1/4 will be paid in March. So no effect on the budget. March, 1/4 will be paid in the month of March. 3/4 will be paid in the month of March. Remaining 1/4 will be paid in the month of April. That is 3,000 divided by 4. 750 rupees is paid in the month of March. Correct? 750 rupees will be paid in the month of April. 750 rupees of March month. April month's wage is how much? 3,200. In that 3/4 is paid in the month of April only, which is 2,400 plus 750, which is 3,150. 3,150. Next. April months 1/4 will be paid in the month of May, 800, and May months 3/4 will be paid in the month of May only. 2,700. So around 3,500. Done. Next. June month, May month's 1/4, that is 3,600 divided by 4. 900 will be paid in the month of June, and 4,000 3/4. 3,000 will be paid in the month of June. 3,900. 3,900. Done. Next, what they are telling. Overhead half in the following month, which means overhead half will be paid in that month only, half in the following month. So straight away going to April, 2,000, 1,000 will be paid in the month of April. Remaining 1,000 will be paid in the month of May. 1,100 will be paid in the month of May. Other 1,100 will be paid in the month of June. So June 1,150 will be paid in the month of June. Other will be in the July, that you leave. Now in the April month, you are receiving your April, you are paying your April months. Also March month's half, 1,900 divided by 2, 950. So it is 1,950. Overhead 1,950. 1,000 plus 1,100, 2,100. Yes. Next, 1,100, 1,150, 2,250. 2,250. Done. Next, what they are telling, sir. Plant and machinery will be installed at a cost of 96,000. We have zero effect on it. The monthly installment is 2,000 payable in the April month onwards. So every month 2,000, 2,000, 2,000. We will show it as outflow payments. Then next, what they have given, sir. Dividend of 5% on preference share, that is 2 lakh rupees. 5% will come to 10,000 rupees. Will be paid on 1st June. So in June month, we are going to show it as an outflow. June month, we are going to show it as an outflow. Done. Next, advance to be received on the sale of vehicle, 9,000. Inflow, 9,000 in the month of June. Dividends from investment amounted to rupees 1,000 are expected to receive in June. So rupees 1,000 as an inflow in June. This is how we have done our budget. Now try to understand. For opening, we added a receipts, we reduced the payment, we got a closing. Now April month's closing will be May month's opening. Do the same drama. May month's closing will be opening of June month. That's it. Simple. Sir, what do you mean by zero-based budget, sir? Generally, budget what we will do? Plus 10% to last year, plus 15% to last year. Like this we will do. But zero-based means we are going to vanish out everything. I mean, we are going to take out all the data. We are going to start from the scratch. The work starts from the collection of data. Everything we consider it as new. Scratch, zero. From zero we will start it. That is your zero-based budget. Okay, but it is costlier budget and time consuming budget as you are starting everything again. Okay, these are the few illustrations of your master budget. Means everything will be there. That's it. You can go through that. Whatever we have done, that only, nothing extra will be there. Everything will be like this. Sales we will take. From that, cost we will reduce. In that, you should know what is fixed, what is variable and all. Accordingly, we can change it. One level they will give, we have to change it. Nothing. With that, budget is done. If you have any doubt and all, you can drop a message. You can drop it in Instagram. That is better because I will be checking it. So you can drop it to CA_Rastrith. Okay, you can drop it to this Insta. Yes. This is all about your budgeting. Once it is done, we are moving towards our last chapter. Revision of last chapter in the sense revisions last chapter, because decision making I don't think so we are taking. Okay, that is divisional performance measurement. We are going to discuss about this particular unit now. Small unit, small chapter, not a big chapter. Okay. Yes, now we'll start with this 8th chapter, divisional performance measurement. Basically, it is going to talk about why divisional performance measurement, DuPont analysis, different measurement tools like ROI, RI, EVA, learning curve effect, balance scorecard for variable pay management, like this. Okay, done. Now, what is this division, sir? Basically, people, what we are going to do is we are going to, for the better control, what we are going to do is whole organization we are going to split into different divisions. Now, when the different divisions are made, don't you think the responsibility of the division is given to some managers, the divisional managers? The answer is of course yes, sir. The responsibility will be given to divisional managers. Without reward, do you think they will agree? Without reward, do you think they will agree for the risk of the division? The answer is no, sir. They are not going to agree. So you have to reward them, no? Yeah, reward will be on what basis? Will be on their performance basis. If they performance well, reward. If you don't perform well, punishment. So now we are going to measure the performance of these divisions. There are different measurements we are going to use. That is all about this chapter. First way of that is DuPont analysis that we are going to see now. Okay. See, you can't measure your business only on the basis of how much asset you have, how much asset turnover you have, or how much leverage you have. So DuPont analysis, what we will do is return on our investment or return on our equity, return on our capital. How we are going to compute is we are going to consider profit. We are going to compute our consider our total asset. At the same time, we are going to consider our leverage, financial leverage. What do you mean by leverage, sir? For example, there are two terms. One is levered, one is unlevered. Okay. Levered means your firm is, your organization is having debt also, equity also. But unlevered means your organization is having only equity. There is no outsiders money in the organization. Only owner's capital is there, equity. But levered means debt is also there, equity is also there. That is your leverage. Now, how to ascertain the net profit margin, sir? Array, this you are learning from your 5th standard. What is the formula for net profit margin? That is nothing but net profit divided by sales or turnover. Okay. Asset turnover is what, sir? Your sales is how many times of your asset. Your sales is how many times of your asset. That is sales by total asset. Financial leverage is out of your total asset, or your total asset is financed how many times by your equity. That is total asset by total equity. We are going to consider all these three. If you multiply all these three, you are going to get return on equity on your DuPont analysis. That is net profit margin into total asset turnover into financial leverage. Net profit is what, sir? Net profit by sales. Total asset turnover is what, sir? Sales by total asset. Financial leverage is what, sir? Total asset by total equity. Got it? Yes, sir. Now see here, there is one illustration. Company A, company B. Okay. Net income is 2000, 2500. Revenue is 8000, 20,000. Average asset is 5000, 8000. Average equity is 2000, 1000. Now, what is the DuPont analysis formula, sir? Net profit margin into asset turnover ratio into leverage. Net profit margin is net profit by sales. For A, net profit is 2000, sale is 8000 into asset turnover is turnover by total asset. So 8000 divided by 5000, and leverage is your total asset by your total equity, which is 5000 by 2000. Now if you cancel, then you will get around try to understand. It will be how many times, sir? It will be around 2000 divided by 8000, which is 1 by 4, 0.25, 8,000 divided by 5,000, which is basically 8,000 divided by 5,000 is 1.6, okay, into 5,000 divided by 2,000. 5,000 divided by 2,000 is 2.5. Is 2.5. Correct? Yes, sir. Into 2.5. What will be the answer, sir? Basically 0.25 into 1.6 into 2.5, which is basically 1. So here it is 1. Return on equity is 1. When it comes to the second one, your profit percentage is 2,500 divided by 20,000. Your asset turnover is 20,000 divided by 8,000. Your this leverage is 8,000 divided by 1,000. So basically 2020 88 2,500 divided by 1,000, which is basically 2.5. Which is basically 2.5. Okay. So you are going to consider it as DuPont analysis 1 and 2.5, which is better. Company B is having higher return ratio than company A. So basically company B is better. That's how you are going to do. Sometimes you might expand your ROE formula. That is, you took your net income divided by pre-tax income. Yes, that is your PBIT or PBT, you can tell, profit before tax. You will take net income. I mean, each and everything you keep on splitting. Net income divided by profit before tax. So try to understand, we are considered about only tax. So we will call it as tax burden. Later, PBT divided by PBIT. Here we are concerned about interest. Later, PBIT or profit before interest and tax divided by sales. Here we are concerned about gross profit or operating margin. Later, sales by asset, here it is turnover, and asset by equity, here it is financial leverage. So basically there we considered only and only net income by or net profit by income. Correct? Here this we are going to split into 3 different divisions. That is, we'll take profit after tax by profit before tax, profit before tax by profit before interest and tax, profit before interest and tax by sales. We're going to consider this. And normal after that, sales by asset into asset by equity. This thing we will do. That is it. Okay. You can solve based on that ones and check it. That is your DuPont analysis. We have 2 more measurement, that is ROI and residual income. ROI means what, sir? Return on investment. Return on investment, residual income. Sir, what is the difference between these two, sir? ROI gives you the things in percentages, whereas residual income will gives you a result in amounts. Residual income will give you results in amount, whereas ROI gives you a result in percentage. Now, if the 2 divisions are there, which will you choose, sir? Division with the highest ROI percentage. If it's a residual income basis, division with the more money. So, we'll see few examples straight away. Illustration. See here. We'll start with this illustration itself. Concentrate. Sales is there 4,80,000. COGS is 222. Gross margin is 258, and selling and administration is 210. Net profit is 48,000. Correct? January, your operating asset was 277. December, it is 323. Can you tell how much is our average asset? Average asset is nothing but average investment. Average asset is nothing but average investment. That is 277,000 plus 323,000, which will come to 6 lakh divided by 2. on an average, you have invested a money of 3 lakh throughout. You have invested a money of 3 lakh, whereas your expected return is 12%, which means your cost of capital, your cost towards the money what you bought, this 3 lakh you have to get from someone, no? If it's a equity shareholder, you have to give them dividend and all. If it's a debt, you have to give interest. So like that, it is a 12% is our cost. Whatever we earn, whatever we make profit, if it is more than this, then it is better to accept a project. Otherwise, don't, because you have invested 3 lakh. Every year you are spending 12% on it. So what is your cost of capital? What is your cost of capital? 3 lakh into 12%, which will come to 36,000. Whereas actually how much you earned? You earned 48,000. So 48,000 is what you have earned, and 36,000 what you are incurring as a cost on that investment, which means net 12,000 rupees is what you are getting extra. So you can tell 12,000 is a residual income, as it is a positive, which means you are earning more than what you are spending. Then it is better to go for this particular project. Look at this one. Acme division has a asset of 225, operating income of 55. Asset means basically investment. What is the division's ROI? They are asking. How much you are earning, sir? 55,000. How much you invested, sir? 225,000. Okay, into 100. So it is 55 divided by 225 into 100. 24.44%. Your ROI is how much, sir? Your ROI is 24.44%. That is, you are going to get a return of 24.44% on your investment. Okay. If the minimum rate of return expected is 12%, what is the division's residual income? How much you invested, sir? 225,000 you have invested. On that you are expecting minimum how much? 12%. So 225,000 into 12% will come to 27,000. Okay, 27,000. How much you are getting? You are getting 55,000. Moral of the story, you are making 28,000 extra, which means residual income is 28,000. Hope it is clear. Going to the fourth illustration. Consider the following. Division A, operating asset is 50 and 125 lakhs of division B, which is basically your investment. Operating income is 10 lakh and 2250. This is your net profit. Return on investment is 20% and 18%. Okay, return on your investment, now what you are getting is 20% and 18%. Which is the more successful division in terms of ROI, sir? Division A is more successful in terms of ROI, because you are able to get 20% of profit on your investment. If you have invested 10 lakh, you would get 2 lakhs. Whereas division B is able to get you only 18%. So on ROI terms, division A is better. Now, using 16% as a minimum required rate of return, compute the residual income for both and which division is more successful in ROI basis. Try to understand. ROI basis. How much you invested, sir? 50 lakhs. Okay. How much they are expecting you to get minimum? 16%. Correct? So 50 lakhs into 16% is basically 8 lakhs. Division A, it is 8 lakhs. Is minimum what you are expecting. How much you are getting? 10 lakh. You are getting 10 lakh. Moral of the story, your residual income is 2 lakhs. Positive. Your residual income is 2 lakh positive. Going to the second one. You are investing 125 lakhs and you are expecting 16% from that. So 125,000 or 12,50,000 into 16% will come to, sorry, not 12,50,000, it is 1 crore 25 lakhs, correct? 1 crore 25 lakhs into 16%, which will come to 20 lakhs. So here you are expecting 20 lakhs where you made a income of 2250, correct? So your RI is 2,50,000. Residual income means what is left over. that is 2,50,000. So in the RI basis which you will select, division B you will select. On a RI basis, division B you will select because it is giving you more income in terms of money. Answer. Look at the fifth one. The following data are given for the Delhi division. ROE is 20%, sales is 12 lakh, margin is 10%, MRR is 18%. Compute the division's operating asset, compute the division's RI. So try to understand. They have given ROA how much. Also they have given how much is the profit. Profit is how much, sir? 12 lakh into 10%, 120,000. So now try to understand. ROI is what? ROE is net profit divided by operating asset or net asset. Now ROI is how much, sir? They are telling it as 0.25. Okay. Net profit is how much, sir? 120,000. So operating asset is, you don't know. So OA is equal to 120,000 divided by 0.25, which will come to rupees 480,000. Your operating asset is rupees 480,000. Done. Compute your residual income. So they are expecting a minimum return of 18%. So 4,80,000 is your investment. On that 18% if you are expecting, net how much you are expecting, sir? Rupees 86,400. How much you are making, sir? 120,000 as a profit. So minus 120,000. Around 33,600 rupees is your RI. Going to sixth one. XYZ Corporation has 3 divisions whose income statement and balance sheet are summarized as below. They have given sales. Okay. They have given a sale. Here they didn't give any information. They have given a operating income, which means net income. Operating asset they have given. Asset turnover they have given for few. Margin they have given. ROI they have given. Okay. Now supply the missing data in the table above summarized. Okay. First one. Asset turnover. Asset turnover. Sir, can we find out asset turnover? Can we find out asset turnover? Of course, yes. What is the formula for asset turnover, sir? Asset turnover is nothing but total sales or revenue divided by average asset. Now operating asset is 1 lakh. Your sales is 5 lakh. Can I tell it as 5 lakh by 1 lakh? Yes, sir. Which means 5. So your asset turnover is 5, which means your sales is 5 times of your investment, 5 times of your asset. Done. Next they are asking a margin. Margin is pretty simple, people. Here you know the operating income. How much? 25,000. Sales you know 5 lakh. So how many percentage it is? How many percentage it is margin? 25 divided by 500, which will come to 5%. Simple. It will be 5%. Return on your investment is how much, sir? Return is 25,000. Okay. Your investment is 1 lakh, which will come to 25%. Done. Going to the second one. They have given you margin and return on investment. They have given you margin as 0.4%, which I can write it as 0.004. Correct? Which I can write it as 0.004 because it is 0.4%. Now is nothing but your profit of 30,000 divided by sales, which is D. So sales will be 30,000 divided by 0.004, which will come to 75 lakhs. Your sales is 75 lakhs. Done. Also they have given return on your investment. They have given return on your investment. So that is 2%, it seems. So 0.02 is equal to return is 30,000. Investment we don't know. That is, let's say E. They have given it as E. So E is equal to 30,000 divided by 0.02, which will come to 15 lakhs. Which will come to 15 lakh. Asset turnover. Asset turnover is turnover by operating asset, that is 75 divided by 15, which will come to 5 times. This is also 5 times only. Done. Now going to the next one. They have given how much is asset turnover. They have given how much is the asset. So using this, what they are telling, 0.4 is nothing but turnover, that is G by 2,50,000. So 2,50,000 into 0.4 if you do, you will get 1 lakh. Your sales is how much, sir? 1 lakh. Also they are telling margin is 5%, which means your operating income or net profit will be 5,000. Okay. They are asking return on investment. Your return is 5,000. Investment is 1 lakh. Right? Sorry, 2,50,000. 2,50,000. You will get it as 2%. That's it. Simple. You can go through that comment and all. Now, an investment center has reported a profit of 28,000 net profit or operating income. It has the following asset and liability. They have 1 lakh non-current asset and around 50,000 of current asset and around 8,000 of current liability. Got it? Calculate the ROI of the division. State any additional information would be useful when calculating. See, ROI you can calculate it as how much is our profit? Profit is 28,000. How much is our net investment? Net investment is after reducing the current. Basically, our equity. Asset minus total asset minus current liabilities is nothing but your total investment through capital and long-term financing. So 28,000 divided by 142,000, we will get percentage. Eighth one here. Look at the eighth one. Nelson Limited has 2 divisions with the following information. Profit they have 90,000 and 10,000. Capital employed 3 lakh and 1 lakh. Okay. ROI is 30% and 10%. Profit 90 and 10. Capital employed 3 lakh and 1 lakh. ROI is 30 and 10. Division A has been offered a project costing 1 lakh and giving an annual return of 20,000. So you are offering Division A investment of 1 lakh where they are going to make a profit of 20,000. Division B has been offered a project costing 1 lakh giving an annual return of 12,000, which means 12%. The company's cost of capital is 15%. That is minimum required rate of return is 15%. Divisional performance is judged by ROI and ROI related bonus is sufficiently highly enough to influence the managers. So basically your division performance is based on ROI. The more and more ROI it is, the more and more bonus to you. Okay. What decision will be made by the management if they act in the best interest of the division? That is, when I am concerned about division, boss, I am least bothered about company. I am least bothered about company. Whether my division is able to make the more profit, good to go. If my division is not going to make more ROI, then I don't accept. Okay. What should be the manager if they act in the best interest of the company? Let's see. Now first their interest. Try to understand A. Division A. Okay. Division B. Division A, if at all they accept that investment, their returns will be increased by 20,000. It will become 1,10,000. Division B, if at all they accept that, their income will be increased by 12,000, which means around 22,000 will be your profit. New profit will be 22,000 and 1,10,000 for B and A respectively. Then capital employed, right now 3 lakh is there. In future it will be 4 lakh because 3 lakh plus 1 lakh, 4 lakh. For division B it is 1 lakh and 1 lakh, which will be 2 lakhs. Great. Now ROI. We will calculate. How much is the ROI for the first case, sir? ROI for the first case will be 1,10,000 divided by 4 lakh. 27.5%. ROI for the second one is 22,000 divided by 2 lakhs. 11%. Now try to understand new ROI. New ROI of A will be 27.5. new ROI of B will be 11%. As a manager, thinking only about the division A, will you accept it or no? Without accepting, your ROI is 30%. After accepting, it's going to be 27%. Of course, you are not going to accept this offer because it's going to reduce your ROI, decrease in the ROI, decrease in the bonus. I am not the idiot to accept it. I will tell boss I am not accepting it. Going to division B, it will be around 11%, whereas earlier it is 10%. Wow. 11% and 10%. Now our performance is increasing. So division B manager will be jolly, ella jolly. So he is going to accept it. Done. If they act in their interest. Now, company's point of view, you think if you invest in project A on 1 lakh, you are able to make 20,000, which means return is 20%. If at all you invest in the B, this 1 lakh will give you return of 12,000, which is basically 12%. Now, from the company point of view, whether it is better to invest in A or B, from the company's point of view, of course, it's going to be A, because that is giving you more than what is given by B. Okay, done. 9th one. An investment center has a net asset of 8 lakh and made a PBIT of 160,000. How much is their net asset? 8 lakh. PBIT 160,000. The notional cost of capital is 12%. That is notional cost of capital, your minimum required rate of return, capital employed, interest on capital employed, everything is same. Basically, what you are expecting, cost of capital. Correct? So how much they are expecting? 12%. So rupees 8 lakhs into 12% will give you 96,000 rupees. 96,000. Okay, sir. Done. Whereas you are making 1,60,000, which means around 64,000 you are making extra. So residual income is 64,000. So it's better to invest. 10th one. An investment center has a net asset of 8 lakh and made a profit before interest and tax is 160. Notional capital is 12%. The company's target return. Okay. An opportunity cost has arisen to invest in a new project is 1 lakh. So they got one opportunity cost of arising a new project is rupees 1 lakh. The project would have 4 years life and would make a profit of 15,000 each. What would be the ROI with and without the investment? So they're asking with investment what would be the ROI and without investment what would be the ROI. Try to understand. First, without, you are making 160,000, you have invested 8 lakh. So you are making how much ROI? 160,000 divided by 800, 160 divided by 800, which is 20%. Right now you are making 20%. After investment, that is your investment will be 8 lakh plus 1 lakh, which is 9 lakh, correct? And 9 lakh, and your profit will be 160,000 plus 15,000, 175,000. So 175 divided by 900, which will come to 19.44. So 19.44, will you accept? The answer is no. Would the investment center manager wish to undertake the investment? The answer is of course no, because it is falling. Correct? What would be the average annual RI with or without investment? So they are asking RI now. So in first scenario, RI will be 8 lakh into 12% is what you are expecting. 8 lakh into 12% is minimum what you are expecting, which is 96,000. And how much you are making actually? 160,000, which means your return is 64,000. If at all you accept, your investment will be 9 lakh. And on that, how much you will be expecting, sir? You will be expecting around 12%, which will come to 1 lakh 8,000. That's what you are expecting. Okay. How much you are making, sir? You will be making 160,000 plus 15,000 because yearly based it is 175,000. So 108,000 minus 175,000, which is coming to 67,000. So RI basis, of course, you are going to accept this because you are able to make 3,000 more profit. 3,000 more. Hope it is clear. Look at the 11th one. A company had the best year ever with a sale of 45 lakhs. Congratulations to them. And operating profit of 950,000. So this is like net income, or you can tell it as a operating income or a net profit, whatever you want to call it as, call. Least bothered. Sales. Income is how much? 45 lakhs. The balance sheet at the beginning of the year showed asset used in the production as 2 crore and depreciation as 250. So accumulated depreciation is there, provision for depreciation is there, which means that is not deducted from the asset. So value of the asset is not actually 2 crore. Net depreciation, it will be 1 crore 50 lakhs. 2 crore is without reducing depreciation because provision for depreciation is there. If at all provision for depreciation is not there, then the assumption would be depreciation is already reduced from it. So no need to reduce again. But here depreciation is not reduced. Instead, it is created as one provision. The company didn't buy any asset during the year. Great. Whereas additional depreciation expense is 10 lakh. So it will become how much at the end of the period? 1 crore 40 lakhs. Done. Calculate the ROI by dividing the operating profit by the average book value. So calculate the average book value. Come on, 150 plus 140 divided by 2, 145 lakhs. 145 lakhs is your average investment. So basically your income was 950,000. Yes, sir. Divided by 145 lakhs, you will get a ROI, which is 950,000 divided by 145 lakhs. Will come to into 100 around 6 point. I am getting it as 1629. Basically, if you do it in decimal, 16 by 29, around 6.55. You're getting 6.55 percentage. ROI is 6.55 percentage. Sir, will you accept it or no? Sir, depends on my required return. If my required return is 10%, if it is giving me ROI of just 6.55, of course I won't accept it. Minimum I want 10% if I invest. Instead of taking a loan at 10% and investing at an income, basically, very simple task or very simple thing it is. You are taking a loan at 10%, you are doing an investment in FD at 5%. End of the day, you pay the interest of, let's say, 10 lakh if you take on 1 crore, and FD interest you will get 5 lakh. Are you an idiot to do this? The answer is no. So basically, if your cost is 10%, if your income is less than 10%, of course you won't accept. So always remember, your ROI to be accepted, it should be more than your required rate of return or marginal return. Yeah. With that, your ROI and RI is done. We are going to next unit, that is EVA. Yes. Now, it is EVA on the basis of economic value added. How we are going to compute? Very simple, people. We are going to compare NOPAT and cost of capital. NOPAT and cost of capital. What do you mean by NOPAT, sir? Net operating profit. Operating profit, which means before deduction of interest. Net operating profit, but after tax, which means your earning before interest tax. Earning before interest and tax, but after tax. Your earning before interest and tax. Without reducing interest, you have to reduce tax. Or you can tell this way also, that is profit after tax. Profit after tax, but we are going to add back the interest after tax adjustment. That is after deduction of tax, net interest what we pay, no? Because of the tax benefit, net interest what we pay, no? That interest we are going to add back to the PAT, profit after tax. This is how we are going to get NOPAT. COC is what, sir? COC is what, sir? Cost of capital. How much capital you employed and what is the return you are expecting. how much capital you employed and what is the return you are expecting, just like previous one only. And one more thing here, when you compute EBIT and EBT, all those things, they might give depreciation two ways. Normal depreciation will give, economic depreciation as per economic value added they will give. Then what you should do is, you take out the effect of this depreciation, give this effect. What do you mean by that, sir? For earning before interest and tax, add back this depreciation because you already reduced. So it will become EBITDA, EBITDA and reduce this one. Reduce depreciation as per EVA. Let's look into few questions. But see here, a person made a capital investment of 2 lakh. Great. Operating profit after tax is 28,000. Net operating profit after tax. That's what we want. No PAT. That's what they have given. The opportunity cost of capital is 10%. So their KE is 10%. So how much is they're expecting? 2 lakh into 10%. Basically like ditto like residual income only. But few factors you have to consider relating to the depreciation. And in the residual income we used to consider net profit after tax, everything. Net profit. Here we are going to consider net operating profit after tax. Operating profit we consider, but after tax. So which is 20,000, whereas your no PAT is 28,000. So your EVA is 8,000. EVA is 8,000. So it's better to invest. 13th one, see here. A following information is available of a concern. Following information is available of a concern. Calculate a EVA. 12% debt of rupees 2,000 crore. Equity capital is 500 crores. R&S is 7,500. RF is 9%. Beta factor is 1.05. Market rate of return is 19%. Equity risk premium, that is 10%. Operating profit after tax is 2,100. Tax rate is 30%. Great. Operating profit. So we got a no PAT. All we want is our return on our capital employed. Capital employed, do we know? Debt 2,000, equity 500, reserves and surplus 7,500, which is 2,000 plus 500 plus 7,500. Try to understand here. Profit after tax they have given. It is no PAT. It's a PAT. Okay. To this we have to add back the interest to arrive at a no PAT. Interest means direct interest, sir. The answer is no after giving tax effect. We'll show that. Now, how much is the capital employed? 2,000 plus 500, 2,500 plus 7,500, 10,000 crores. 10,000 crores. And what is the marginal, required rate of return, sir? They have given one information here. Using the CAPM model, we can compute. That is risk-free plus beta into RM minus RF. Correct? RF, how much they are telling? 9%. Beta is 1.05. RM is how much, sir? In the market, 19% is there, whereas you are getting risk-free at 9%. So the premium, the market premium is how much? 10%. So how much it will be, sir? 10 into 1.05. 10 into 1.05, which will come to 10.5 plus 9, which will come to 19.5%. It is 19.5%. What is this, sir? What is this, sir? This is KE, cost of equity. Cost of debt is also there, which is 12%. Which is 12%. But 12% before tax, that is, then KD is what, sir? KD is interest into 1 minus T, 1 minus 0.3, which will come to, because that's what you are paying. No, you're not paying 12% because of the tax effect. 12 into 0.7, which will come to 8.4%. Now, when you have KD and KE, then KO, that is cost of overall capital. How to compute that, sir? Weighted average. So try to understand. Total fund is 10,000. In that, ratio is 2,000 and 8,000. 2,000 and 8,000, which is 1:4. Which is 1:4. Debt is 2,000, equity is 8,000. So KO, try to understand. 1:4 in the sense 0.2 and 0.8. So 0.4, that is your sorry, give me a second. 1:4, 0.2, not 0.4. 0.2 into KD is how much, sir? 8.4. Okay, plus 0.8 into K is 19.5. How much is overall, sir? 0.2 into 8.4, which is 1.68, plus 0.8 into 19.51. Sorry, 19.5. 0.8 into 19.5, which will come to 15.6. Total it is 15.6 plus 1.68, which is 17.28. 17.28 percentage is your KO. So capital employed is 10 lakh, 10,000 crores. So 10,000 into 17.28 percentage, 10,000 into 17.28 percentage, which will come to 1,728 crores. Okay. Your NOPAT is, this is what? This is your investment. I mean, cost on your investment, cost of capital. How much is your NOPAT, sir? NOPAT, try to understand, 2,100, that is profit after tax, plus interest into 1 minus tax. Correct? 2,100 plus interest, how much you are paying? 12% on 2,000. 12% on 2,000, that is 2,000 into 12%, which will come to 240. 240 into 0.7, that is 1 minus tax, that is 240 into 0.7, which is 168, plus 2,100, which will come to, 240 into 0.7, 168, plus 2,100, which will come to 2268. So which is 2268. You can consider NOPAT, this 2,100 as NOPAT, or you can consider 2268 as NOPAT. So 2268 minus 1728, you will get this one. Here they have considered operating profit after tax as 2,100 only. Okay, they are considering it as NOPAT. I considered it as net profit after tax. Look at the 14th one. Estimated current financial income statement is 15 lakhs. Marginal tax rate is 40%. Net income. Tax is how much? 40%. Interest is 15 lakh, which means this is NOPAT. No, this is net profit after tax. You have to find out NOPAT by adding the interest after giving adjustment of tax. The company has 1 crore of investment capital, of which 60% is debt. So you are going to divide this. And maintained average cost of capital is, they only have given how much is the cost of capital? 12.6%. So straight away you are going to apply it on whole 1 crores only. Compute the operating income. This could be done easily. Okay. These are the certain things. Please go through all these illustrations regarding EVA. We are not going to discuss it much, but that is important factor. Please go through that, all the sums. If you get any doubt in these sums and all, please let me. Okay. Now we will go to learning curve. Okay. Now it is learning curve. What do you mean by learning curve? Try to understand, people. When you are keep on doing the same thing again and again and again and again and again and again, you will become a master in that. Which means first time you might have taken 10 hours, next you might take 9 hours, next you might take 8 hours, next you might take 7 hours. Like that, your efficiency increases. Correct? So that increase in efficiency is known as effect of learning curve, because you are learning to do the things much faster way, learning to do the things efficiently, because you are well versed with that. That thing is known as learning curve. Trying to find out that learning curve effect will be known as learning curve in this calculation. Okay. See here. Number of units. When you produce 1 unit, you might have taken 100 hours. Correct? So average is 100. When you produce 2 units, you might have taken 80 hours per unit. So which is 160. Now learning curve you can directly calculate it for next double. That is, you can't calculate it for 3. You can't calculate it for 3 units. You can calculate it for 4 units. That is, see here, what is happening is 80% effect it is. 80% effect. That is, when you took first unit, you took 100 hours. But for doing the same unit again, you just took 80 hours. Now for 2 units, you took 80 hours. For the next 2 units, you took per unit 80 minus 20% or 80 into 80, that is 64. Now, for 4 units, you took on an average 64 per unit. For the next 4 units, on an average, you took 51.2. Try to understand here one thing. it will be in the multiples of like double of that. You can't calculate for something in between, like using this. Using this is very simple. All you have to do is apply multiplication of that percentage. However, in this scenario, if you want to calculate it for the third unit, if you want to calculate it for the fifth unit or fourth unit, fourth unit you can calculate 1, 2, 4, 8, 16, 32, 64, 128. For those things you can calculate, but not for the something which is there in between. Correct? For that, you have a formula called y is equal to ax to the power of b. Y is equal to ax to the power of b. Y is what, sir? Y is the average time per unit for x units. Y is the average time per unit of x units. To produce x units, how many times you have taken? For example, you are trying to calculate for 3 units how much it is, or third unit how much it is. For third unit, how much you have taken? Listen here. So, y is that? A is what, sir? Time taken for the first unit. Let's say 100 hours. Okay. X is what, sir? Third unit you are calculating. So, 3. B is what, sir? B is learning coefficient. Learning coefficient or learning coefficient. How to calculate that, sir? Very simple, people. Very simple. All you have to do is, they will only give how much it is. They will only give how much it is. For example, let's say 80% they gave. They gave it as 80%. Then B will be log of 0.8 divided by log of 2. Log of 0. Log 2 is a base, no? So log 0.8 divided by log 2 is the B. So B is always, remember, B is equal to log of learning curve coefficient divided by log 2. Okay. We will solve few questions here. Look at the 19th illustration. The learning curve as a management accounting as of now become or going its application. Illustrations here. 4 machines, 8 machines, using the given data you have to find out. Okay. To prepare 4 machines, to prepare 8 machines. Direct labor are needed to make first unit is 1000. For the second unit, you might take how much is the learning curve effect? 90%. So you will take 900. First unit you will take 1000. Average, this is average time, not total time. This is average time per unit. So you took 1000. For the second unit, you might have taken 900 together. Done. Later. For the fourth unit, you have taken 900 into 90%, which is 810. For the eighth unit, double of that, you might have taken 810 into 90%, which is 729. 729. Total, how much you have taken, sir? Total, how much you have taken, sir? Total, for the first unit, you have taken 1000 only. For 2 units, you might have taken 1800. For 4 units, 810 into 4, you might have taken 3240. For the 8 units, you might have taken 8 into 729, which will come to 5832. You might have taken so much. You might have taken so much. Now, what they are asking? Expected average unit cost for making. For making 4 units, it is 810 hours. For 8 unit, it is 729 hours. And what is the cost per hour? Cost per hour is 15. So 810 into 15, 12,150, and 729 into 15, which is 10,935. This is labor cost, and direct material cost is 1,50,000. For both also it will be same only, 1,50,000, and fixed cost is 60,000. See here. Fixed cost, when you produce 1 unit, it will be 60,000. When you produce 2 units, fixed cost per unit will become 30,000. When you produce 4, it is 15,000. When you produce 8, it is 7,500. That's what you should do. Total fixed cost divided by number of units. Okay. Material, it will remain same. Labor cost, we have computed here. I told you, 12,150 and 10,935. 12,150 and 10,935. You will get a total cost. Simple. 20th one. Try to understand. A firm received an order to make and supply 8 units of a standard product, which involves intricate labor operation. I mean more of labor oriented. It is the first unit was made in 10 hours. So first unit was made in 10 hours. It is understood that this type of operation is subjected to 80% of learning curve. The workers are getting wage rate of 12 per hour. Great. What is the total time and labor cost required to execute the above order? How many units? 8 units. So 1, 2, 4, 8. Average time for the first one you are taking 10 hours. Next one you will take 8. To make 4, on an average you will take 8 into 80%, which is 6.4. For the next, while making 8, you will take 6.4 into 80%, which is 5.12 hours. Total is 10, 16, 6.4 into 4, 25.6, 5.12 into 8, 40.96. Done, sir. This total time taken. What is the total time and labor required to execute the order? Total time is 40.96 hours. Okay. And rate, I mean labor cost is into 12. Into 12, which will come to 491.52. 491.52. 491.52, 40.96 hours. Done. Next. If a repeat order of 24 units is also received from the same customer, what is the labor required? Repeat order. Repeat order is also required. So, what is the labor cost necessary for the second order? Try to understand. Next, it will be 16. Next, it will be 32. Next, it will be 16. Next, it will be 32. 5.12 into 80%, which is 4.096. And 4.096 into 80%, which will come to 3.2768. On an average, that is the one. But to produce 16 units in total, you need 4.096. Sorry, 16 into 4.096, which will come to 65.536. 3.2768 into 32. 104.8576. Try to understand one thing here. To produce 32 units, you are taking 104.8576. Sir, cross multiplication should we do? The answer is no. Why, sir? Try to understand. Out of 32, 8 units you already supplied, which took 40.96. Now, additional 24 units, how much it took, sir? 104.8576 minus to 8 units, how much it took? 40.96. Around, it took around 63.8976. It took around 63.8976 hours. And what is the cost of this? Into 12, which is 766.77. This is how we are going to solve this. Okay. Same thing again they solved here. I am not going to see all these things. But using that formula one, I will show it one or two questions to this one. Listen here. Listen here very carefully. Sir, when you use a formula, you told no log of that learning coefficient divided by log 2. How to calculate that, sir? Pretty simple, people. You don't have to calculate. They will give in the examination all those values. You should know to use that. That's it. The usual learning curve model is y is equal to so and so. And they have given learning curve coefficient, that is log 0.8 divided by log 2 is minus 0.322. Okay. Great. Now, for a learning, given that A is 10 hours and learning is 80%, you are required to calculate average time for 20 units, total time for 30 units, the time for unit of 31 to 40 units. Try to understand. Y is equal to A to the power of B x. Y is average time required to produce, x to the power of B. Y is nothing but average time required to produce that unit for which you are trying to calculate. For example, average time for 20 units. Now, for 20th unit or for 20 units per unit, how much is the average time? That's what Y is. Okay. A is what? For the first one, how much you took that one? That is nothing but 10 hours. Okay. Into X is for which you are calculating average for how many units? 20 units. Okay. B is what? B they already calculated and gave. That is 0.8 divided by 0. Log 2 is 0. Minus 0.322. Okay. Done. Now what we can do, sir? Again, power is there. When power is there, again, you can't calculate the power of 0.322, no? So again, you have to go for the logarithm. So what you are going to do, you are applying log on both the side. So log y is equal to, try to understand, or log y is equal to, I will apply here, log 10, correct? And if you know this, log, for when m and n is there, if you apply the log, it will become log m plus log n. So it will become log 10 and log 20. Now, when it is log m to the power of n, it will become n log m, correct? N log m. Now try to understand, log 20 to the power of minus 0.322, it will become minus 0.322 log 20, correct? So now it is minus log plus log 20 to the power of minus 0. Now it becomes minus. So it will be log 10 minus 0.322 log 20. Now what you should do is, you should try to make something from here. See here, log 10, whether they have given a value? Log 10, they haven't given a value. What and all values they have given, sir? Log 2, they have given a value. Okay. Log 3, they have given a value. Log 4, they have given a value. What and all they have given? Log 2, they have given a value. Log 3, they have given a value. Log 4, they have given a value. One thing you have to remember, that is log 10 is equal to 10. That you have to remember. Log 10 is equal to 10. Okay. Now try to understand. Log y, great. Log 10, we know that it is 1. Okay. Minus 0.322. Log 20, we don't know. But can I write it as log 2 into 10? Yes, sir. Log mn, again we can split into, try to understand, log y is equal to 1 minus 0.322 into log 2 plus log 10. Log mn is log m plus log n, no? So that's what we have done here. Now, log y is equal to 1 minus 0.322 into log 2, how much it is? You know, they have given log 2 is how much? Log 2, they have given it as 0.301. Okay. Plus log 10 is 1. Now, log y is equal to 1 minus 1.301 into 0.322. 0.4189, correct? Log y is equal to 0.5811. Now how to compute log y, sir? Now how to take out, you want y, not log y. Now you got log y. How to take it out, sir? You have to anti-log from both the end. Now if you apply anti-log to this, anti-log to log y, anti-log of 0.5811. How much they have given? Anti-log of 0.5811, 3.812. So y is equal to 3.812. So average R for the 20th unit is 3.812. This is how you are going to compute the learning curve effect. Okay. All other answers you can do it on your own ones. Yes, sir. Now last unit is there, guys. That is your balance scorecard for variable pay management. Try to understand. Balance scorecard means what, sir? Now it is not like the traditional business. Now the doing a business is not like a traditional business where earlier you used to concentrate only on the basis of your organization, only from the point of view of making more and more profit. Earlier you used to concentrate more on your organization, only organization motive, plus making lot and lot of profit. That's it. But now you can't just concentrate on that. So what balance scorecard tell is you should think the business from four perspective. One is financial perspective, one is customer perspective, one is internal business process perspective, one is learning and growth perspective. So financial perspective, you are trying to add a value to your investors. You are trying to add a value to your stakeholders. That is your financial perspective, giving more profit, giving them a good returns, expected returns. When it comes to the selling price, increasing selling price, decreasing cost, all these things. Customer perspective. Now you should think from the point of view of customer also. You should think from the point of view of increasing their satisfaction level, increasing the number of customers, acquiring more and more market, gaining the space in the customers mind, so that this product is good, giving them a quality what they ask for, giving them a value for what the money they pay. That is customer perspective. Internal business process is you trying to improve a lot. You are trying to create value by the improvement in your organization. Certain things you are bringing, innovations and all you are bringing, so that your customer feel like, okay, these products are really good. For example, Apple products. Now what we feel, oh, no innovations are there. But earlier, that was the innovation which used to come first. Anything, any feature, Apple product used to come up with that. Correct? That innovation thing. That point also you should think. And last is learning and growth perspective. Here you should think from the point of view of employees. You should give them a growth opportunities. You should increase their skills. You should extract their capabilities properly, right? So that is learning and growth perspective. That is employees perspective. See here, there is one table. Customer. What is the question? What do existing and new customer value from us? Explanation. Given rise to targets that matter to customer, like cost, quality, delivery, inspection, handling, so on. So first one is what? Customer. Next one is internal growth, etc. Here it is what process must we excel to achieve at the financial and customer objective. Basically aims to improve internal process and decision. So process, it's all about process, trying to improve our process what is there right now. Innovation and learning, that is can we continue to improve and create a future value and giving a lot of new skills, etc. to our employees. Financial, what does our stakeholders accept from us, right? That is your financial perspective. What are the four perspectives you should remember? In the balance scorecard, you can't now only concentrate on making profit. You should think from four perspectives. Financial point of view also you should think. Customer point of view also you should think. Business process point also you should think. And employee point also you should think. First, from the stakeholders point of view, it is financial perspective, giving them more returns. Customer point of view, customer perspective, giving them a good quality product, value for the money, right? Internal business process, trying to improve the process, and learning and growth effect, trying to give your employees the more and more skills, extracting their skills, giving them a growth opportunities. That is your learning and growth. Financial from shareholder point of view, customer from customer point of view, business process, trying to grow our business through nice good product process and all, and learning and growth, employees point of view. With this, we have completed this chapter, and also we are not going to take up decision making chapter in this particular marathon. Hope you guys enjoyed the marathon. If you liked the marathon, if it helped in your studies, if it helped in you revising in your studies, please leave us a comment and please subscribe to our channel so that you will be getting more and more of videos in this particular channel relating to your studies. Okay, we will be coming up with the other subjects also. Few subjects are already uploaded. Please go and watch. And one more thing you should keep in mind, that 1.5 what you are going to use, 1.5 days, that's going to play a major role as your management accounting. Management accounting is the last paper of your group, no, so I don't mind you spending your sleepless night, because next day you can come and sleep. But if you lose by 2 or 3 marks, it will be hurting you very much. So try to understand, people, it is the right time to crack anything. If you keep for many days, it will start hurting you, right? If you keep any weight for many days, it will start hurting you. So as soon as possible, get away from that particular weight. So yes, we'll see you guys in the finals. Till then, take care and please study. If anyone is watching on the last day of your examination, boss or madam, all the best, and everyone, all the best, but make complete utilization. Bye bye, take care.